difficult.
Welcome back. Hope you're having a good morning. Well, we kickstart a new series today. We weren't short of action towards the end of the series yesterday, and the last couple of series actually have been good. How do things pan out from here on? Well, we have Mitesh who joins us for a quick technical check on the markets. Hi, Mitesh. Good morning. Good to see you. And as always, April was good. May was good. June's going to be good or not? What's the trade on the Nifty?
I think the good morning. The overall direction still is on the positive side, but on an immediate basis, I've been calling for a consolidation. I think 25,050 on the upside is the level which the Nifty needs to break. It might do that in the next couple of days, but till that happens, I think we are slightly cautious on the index, waiting for intraday declines to buy into. And on the downside, 24,500, 550 is a very strong support zone. That's the lower end of the range. In case you get it there, I suspect that will be the case. But in case we do get a decline over there, that's the best entry point. So the bias is positive, but on an immediate basis, I think the market could be spending a few more days into consolidation.
Okay, all right. That's good advice, Mitesh. In terms of specific stocks, what would you recommend?
Morning, Prashant. I have more of buy calls today, very clearly in line with the belief that eventually the markets will break on the upside. So a buy on a couple of metal names, which is Hindustan Zinc. Keep a stop at 458. Look for targets of 480. JSL, Jindal Stainless. That's a buy with a stop at 657 for targets of 695. Also a buy on Crompton with a stop at 354 for targets of 370. And one sell call. I think both MRF and Apollo Tyres gave some kind of a negative breakdown yesterday. So I've chosen Apollo as a short-term sell call. Keep a stop at 487. Look for targets of 460.
Okay. All right. Got that, Mitesh. Thanks very much. Coming to Shrikant now. Shrikant, what's the approach that you will take? Index, stocks?
Good morning, Surbi. Good morning, everyone. For Nifty, it is in the range. It is not crossing 25,150. It is not breaking 24,500. In between also, we are seeing the markets are trading at equilibrium level. So broadly, I am of the view that we need to be more and more stock specific. But in case today market breaks the level of 24,650, then in that case, the chances of falling to the levels of 24,500 or 450 would turn bright. So we need to be careful, or what we can do is that we can trail our stop loss to 24,650 for holding any long position. But yes, there are a number of stocks which are really doing well, and a few of them have crossed their important levels, like Cummins India. It was under the levels of 3,000 for a longer time. Now it has broken that. Based on its technical setup, I am expecting this stock to move towards 3,700, 3,800 in next few weeks. It will take some time, but it's a positional trade to buy. But with a short-term view also, even at this level, 3,170, it's a buy with a stop loss at 3,090, and we can keep a target of 3,500. The other stock which we like is Maruti, which is around 12,400. There also we can keep a stop loss at 12,200 for the target of 12,750, 800 on the higher side.
Okay. All right. Got that, gentlemen. Thanks very much for the trading calls. We do have to take a very quick break. Come back on the other side. We'll have the pre-opening rates, and also Jay Kale of Elara Capital will be joining in. We'll discuss Bajaj Auto's performance in the fourth quarter. Welcome back. Well, let's go back for a couple of ideas with Siddharth. Siddharth, so you tell us it's been a whirlwind earnings season, winding down finally. So give us one or two top ideas.
Sure. So going with the recent updates, yesterday Suzlon came out with strong numbers. We recently initiated the stock, strong set of numbers, above much ahead of our expectations. And what is also important is that management has maintained its positive outlook and has guided at least 60% growth in terms of deliveries for the next year. So we believe that the strong delivery could continue, and that could again lead to re-rating. Stock had corrected from its previous highs and now looking attractive, both in terms of business as well as in terms of valuation. So that is something that we believe can continue to do well in the mid-cap space. What also looks interesting is that some of the companies, so for example, the hotel sector, that continues to do well. Lemon Tree in the mid-cap space, that came out with strong numbers. Again, we believe that within the discretionary spending, the hotels or the leisure travel in India, that continues to be pretty strong. And in that space, in the mid segment, Lemon Tree has a strong positioning. Some of its newer initiatives, the Orica brand, that is picking up now and is contributing to the overall profitability. So that's another stock in the mid-cap space that we believe can do well. So Lemon Tree is a buy with a target price of 190. Suzlon, as I said, we have a buy rating and a target price, revised updated target price of 83.
Okay, all right. Sid, before we let you go, any view on Welspun Living? The textile business, there is hopes out there. The flooring business actually is not able to scale up. Just looking at the past numbers. But there could be an opportunity out there with the India-UK FTA being signed. Hopefully, India gets a favorable deal from the United States as well. Any view on the stock?
Nigel, unfortunately, we don't cover this space.
From the textile space, you all don't have any pick at all. Okay, all right. Just one more quick question. From the pipe makers, you know, we have all sorts of pipe makers. I think APL Apollo is the one that you like, right? The pick of the pack?
Yes, Nigel.
Got it. Okay.
So within the pipe segment, APL Apollo is the only one that we cover. Astral is the largest one. But if you look at APL Apollo, is more into the structural pipes and not into the PVC pipes. After a very long time, numbers have started coming in strong. Q4 led by a healthy volume growth of 25%. We are expecting demand to recover, margins improvement to be supported by capacity addition across geographies, and also higher exports. So that's a stock in the mid-cap space. Again, we have a target price of 1920 on APL Apollo.
Okay, all right. One more before we let you go, Sid. The cement pack, you know, delivered actually a rather good set of numbers, little better than what the street was estimating. And things were looking up for first quarter. However, the early onset of monsoons could spoil the party. From there, what do you like?
Yeah. I think cement has been a mixed bag in that sense. Some of the larger ones, Ultratech, JK Cement, JK Lakshmi Cement came out with pretty strong numbers. Monsoon this year expected to be much ahead of the normal, and that could lead to some impact in the near-term volumes. But the long-term trend, we believe, will continue to be pretty strong. We like JK Cement. We have a buy rating with a target price of 6,000. We believe that, again, while Q4 numbers has been pretty strong, JK is one of our preferred picks in the cement sector. We are expecting a good growth in volumes, better profitability. Even the UAE plant for JK Cement is picking up pace, and that is also contributing positively to the overall profitability. We have forecast a revenue CAGR of 15% and a net profit CAGR of 30% over the next 2 years. And that remains our top pick within the cement pack.
Okay, all right, got that. So that lots of ideas today. Thank you so much. You have a great Friday, and we'll connect again soon. Thanks for joining in. Okay, that's a view coming in from Motilal Oswal Financial Services. Right now, we're putting the spotlight on the auto space, and specific Bajaj Auto. The company came out with a very steady set of numbers for the fourth quarter once again, and the margin continues to be above 20%. I think it's the 6th quarter in a row. But what's the outlook ahead? The issue is growth and the top line. Let's discuss this with Jay Kale, Executive Vice President Research at Elara Capital. Jay, great to have you on. And that's the thing, right? I mean, it's fantastic that Bajaj is managing to hold on to its margins. Great. But what about growth? I mean, I think numbers for this year, top line is up about, 5.5% or so, 6% nearly. And the last couple of months, in terms of just the sales volumes, they've been patchy. It's if anything, it's actually exports that have been driving the performance. The story is quite turned compared to where we were, say, 2 years back. Your sense?
Yeah, absolutely. Good morning. We've seen, in terms of margins, if I have to look at Bajaj, I think probably very few companies who are so resilient in terms of margin delivery, especially in the last 1 or 2 years. So I think, that seems to be one thing that, Street would be taking for granted, that, 20% margin is a given for Bajaj. Yes, the top line is an issue, especially in the domestic motorcycle segment. Now, what has happened in the last 1 year is that in the two-wheeler industry, a majority of the growth for the industry has been led by the ICE scooter segment, where Bajaj is absent, whereas motorcycle segment in the domestic market has kind of been muted. And within that also, Bajaj has lost some bit of market share. So I think that market share loss in the motorcycle segment also continues in the last few months, and we need to see when that gets arrested. Management did highlight of certain new launches coming in where they believe that will aid some bit of market share gains for them going forward. They've guided for an above industry average growth for themselves in FY26. While that needs to be seen, the new launches need to be key. The problem with them has been that, Freedom CNG bike, where a lot of hopes were built in for market share gains in the last 8-10 months, hasn't fired as much as expected. So that has really tempered down expectations for the domestic growth. And I think it's the exports which will be, give them the cushion of overall volume growth, as will the three-wheelers product interventions that they'll be doing.
Jay, sorry, just to come in over here. What is your estimate for volume growth, domestic motorcycles for Bajaj? Maybe, I don't know, first half or full year, maybe full year is too long. But give us some sense. What are you expecting in the next couple of months? Pure volume growth on domestic motorcycles, the bread and butter, the big domestic business.
I think, our growth estimates are more on the full year side. So we're expecting around 4 to 5% motorcycle growth for themselves. Largely in line with the industry for FY26. And of course, what will also drive growth for the domestic two-wheeler for them is the EV Chetak. EV two-wheelers, I think they've been doing pretty well. That growth will be much higher than this, but overall domestic motorcycle segment will be in the mid-single digit kind of growth rate for them.
Jay, stay with us. By the way, we'll of course speak with the Bajaj Auto management a little later on the program. But Jay, wanted your views on another space, the electric vehicle space specifically. But before I come to you, let me just go across to our colleague Sud, who covers the auto space closely. And the Ola numbers came out, and I think there is the street is making of it as well. So take us through that.
So for Q4 of FY25, it was an operationally very weak quarter for Ola Electric. Losses have expanded both on a sequential basis, also on YOY basis. But outlook given for Q1 of FY26 is looking healthy. Company is saying that adjusted revenue growth sequentially in Q1 of FY26 might be in the range of 23 to 31%. Also, deliveries may increase by 28% sequentially. And it believes that in FY26, it will achieve break-even in auto segment EBITDA. But commentary from brokerages is looking mixed. Kotak Institutional Equities has downgraded the stock to sell, and target has been cut to rupees 30 per share, which is 60% lower than its listing price of rupees 76 per share, and almost 80% lower if you compare from the live high that stock had hit. Now, Kotak says Q4 EBITDA loss came in much above expectations. Also, EBITDA loss is driven by higher warranty provision and weak volume print, and it expects EBITDA losses to continue, and company's future hinges on scaling up volumes and successful motorcycle foray. Goldman Sachs, though, maintains buy call with a target of rupees 70 per share. It says company's decision to bring vehicle registration in-house has impacted volumes in Q4 FY25, but also as per GS, outlook given for Q1 of FY26 is looking healthy.
Okay, all right, got that. Thanks very much. For the time being, reacting to those mounting losses, 870 crores of a loss at the bottom line. Thanks for that, Sud. Very quickly, going back to Jay. Jay, you were just talking about this, that even for Bajaj, you were saying it's not so much the motorcycles, but maybe the EV side. Chetak is going to, drive volumes better this time around. Come in on Ola. I don't know if you have coverage on the stock or not, but it's just not getting better for the company. What's the advice?
I mean, we don't have official coverage, but our view had been, even 1 year back that when we had written a note that the incumbents, at that point of time had not ramped up their distribution network as well as their product portfolio. And once that happens, obviously there will be some shifts of market share happening. We have seen TVS and Bajaj ramp up quite well on the EV two-wheeler side, as has kind of Ather with its strong product positioning. But I think TVS and Bajaj, our view is that they will outperform in terms of EV two-wheeler growth rate going forward in the next 1 to 2 years. I wouldn't be able to comment specifically on Ola as it's not on the official coverage.
Okay, you told us that for Bajaj, expect about 4-5% growth for the motorcycle business this year. What about the overall portfolio? I mean, what is the total top-line estimate that you have for Bajaj? Because the margin is not a problem at all. We're only discussing top-line growth. So what are you expecting this year?
Yeah, I think, double-digit growth for the exports. So that Bajaj does get a decent amount of almost half of its volumes and revenues coming in from exports as well. So I think that will kind of push up revenue growth to double digits for Bajaj. And with stable margins or marginal increase in margins, you could expect a healthy mid-teens kind of an EBITDA growth for Bajaj.
Your top pick, since we're discussing two-wheelers, very quickly, top pick or picks in the space?
TVS Mahindra, followed by Maruti and Bajaj. Yeah.
Okay. All right, Jay, I got that. Thank you very much for joining in. So that's a lowdown on the auto space and some ideas going by the earnings analysis that we've got for you. Let's quickly go back to Mitesh, 9:10 call, and let's also take stock of where the market is, where the pre-open is settled 21 points lower, so not too bad for the Nifty. Mitesh?
I'll go with the buy on JSL or General Stainless for targets of 695.
No, absolutely. Got that. By the way, any thoughts on Ola here, Mitesh?
Not much, Prashant. I think, the stock has been clearly showing signs of declines. I think if the stock manages to bounce back on this bad news, or reverse will happen only if the stock starts getting past 57, 58. Otherwise, a retest of 46, 45 is very likely.
Mitesh, by the way, I have another stock for you. Let's pull up Mazagon Dock. This is a real disappointment because of what's happened. Remember, the top line growth is just 2.5%, 3%. And the margin has collapsed from 17%, nearly 17%, to 2.8 or 2.9% this quarter. And that's the disappointment that's reflecting on the screen. Well-celebrated stock, but running into some rough weather today at least. Mitesh, levels to watch now. What to do with Mazagon?
Should be one thing, before I go into Mazagon. All the defense stocks are extremely overbought in the short term. So expect any bad news to see, a strong profit booking. Similarly with Mazagon Dock, I think the first target should be around 3,500 zones. In case we break below that, maybe some more pullback is possible because the stock has rallied from 2,200, 2,100 to about 3,700 now. So, 20-30% kind of retracement can easily happen of the entire rise, which is roughly about 300 to 400 points.
By the way, Surbhi, last editors roundtable, I put that piece on the earnings upgrades and downgrades. The number one downgrade was another defense, actually not completely defense, but in the same space as Mazagon, Cochin Shipyard. Cochin
Shipyard,
I
remember that. Correct.
Over the last 1 month, and this piece was 4 trading sessions old, so it's not that old. Basically, over the last 1 month, Cochin has seen about a 36% downgrade for its FY26 earnings. It's not stopped the stock though. I mean, the stock has been. I just looked at it over this week as well. It's been inching higher. But that's it. I mean, those are 2 shipyards, and what a move they've had. Garden Reach, Cochin, Mazagon, all of them really through the roof. Actually, on that note, let's just quickly bring in Ria as well to revisit the Mazagon numbers. Ria, take it away.
Well, yes, good morning. The Q4 numbers have been quite weak for Mazagon Dock, although the full year performance has remained healthy. First, looking at the Q4 numbers, the profitability has been sharply impacted this time around. EBITDA and net profit are both down by around 83% and 51% respectively on a year-on-year basis. EBITDA margins have also contracted by over 1,400 basis points on a year-on-year basis, and they've contracted by 2,300 basis points sequentially as well. Now, this profitability was impacted by significantly higher expenses in this quarter. The subcontracting expenses have gone up by over 9 times on a year-on-year basis, and even the provisions have gone up by around 5.6 times compared to the previous year. Now, in the Q3 earnings call, the company had said that these provisions have been created for excess inventories for ships with expired warranties, and while the components are still in good shape and may be used in future projects, these provisions will be reversed upon utilization. Apart from this, though, the full-year performance has remained healthy. Revenue and margins have been above the company's guidance. And another thing to highlight here is that today the stock is going to enter the F&O segment, so it will also garner some increased trading interest today.
All right, Ria, thank you very much for that. So that's Mazagon, which is at least starting lower. The other one is Birlasoft. Now, Birlasoft has seen a very steep Q-on-Q revenue decline. The numbers came out Wednesday evening, 28th evening. It didn't react in a big way yesterday, but I think there is a call from Macquarie this morning. Rima has got that. Rima, morning.
Indeed, Birlasoft numbers were out 36 hours back, but we're highlighting it today because Macquarie has sharply downgraded Birlasoft's target price, lowered it by 45% to 350, which is lower than the current market price of 412. They've now downgraded it to an underperform versus an outperform. They said that way back in August of 2024, that's less than a year ago, the company, Macquarie, had upgraded Birlasoft to an outperform from a neutral on expectations that revenue will accelerate and margins will improve towards 15 to 16%. But both the metrics have disappointed. Now Macquarie has lowered the revenue forecast. And just to recap your memory, in Q4, revenues for the company declined by 5-6% on a quarter-on-quarter basis. And even on a year-on-year basis, revenues were sharply lower. And they're saying margins will remain under pressure in FY26. Recovery will take place only in FY27. So therefore, target price slashed to 350 rupees. And now they're saying the fair value should be 15 times in terms of a multiple versus 27 times. The stock is down 32% in the last 1 year, but this month itself, it went up by nearly 5%. And in the last 3 years, the return has been fairly meager, just about 16%.
All right, okay. Rima, thanks very much for that. Mitesh, Birlasoft, any thoughts as it starts this morning?
In fact, yesterday or the day before, I think I had a buy call which hit the target of 440, and the stock isn't looking bad. But I think with the news which has come in, I think a good chance that we might see the stock head towards 380, 385 zone, which is where a good support comes in. In case we break below that on the closing basis, we'll look at further declines.
Okay. All right. Just one more point, guys. Later today, there'll be the MSCI rejig that takes place. And India on the whole will see net outflows of close to around $350 to $400 million. This is as per a Nuvama alternate research note. So we'll keep an eye out on that. In terms of flows, it'll get skewed because of that. Zomato is one of the stocks that I pointed out earlier today as well that is expected to see some outflow. So India, as a basket, will see net outflow. So that's what could skew numbers on the flows picture and also maybe particularly towards the end of the trading session.
All right, Najil, thanks for that. So just a couple of seconds to go for market open, and we'll just look at indices and we'll get down to stocks very quickly. So what do we have? 24,812 is the pre-open end. It's slightly higher, 24,840. So absolutely flat. Nifty Bank is up about 0.25%, 55,680. Sensex is again flat like the Nifty. The small cap index is better, 1/3% higher, 17,946. And I think you will have the small cap index, the mid cap index will come up on your screens. So it's actually neither here nor there. It's almost unchanged, at least on the headline indices. Mid and small caps, much better start. 1/3% of the mid cap index as well at this stage. Look at the advanced decline. It's 2:1, comfortably 2:1. But this is stuff right out of the gates, and things will settle, and there'll be reversals and reversal to reversals. So I think 30 minutes out, market breadth will be a better indicator. That's the Nifty heat map. 20-odd names are higher. Everything else is starting the day down. Surabhi.
Okay, let's look at what's working and what's not. Index is completely flat. On the downside, Infosys about 1.5% lower. HCL Tech slightly lower. Tech Mahindra lower. So Tech, it's a down morning. Bajaj Auto is reacting negatively to the numbers. Remember, it's what we've been discussing with Jay throughout. That margin being at 20% is nothing new for the market. We've gotten used to it. It's volume growth, it's top line growth, and that seems to be a little sluggish. So about 2% lower on Bajaj Auto. Eicher Motors, Hero Motocorp also lower, to be fair, along with Mahindra & Mahindra. So all of Auto is seeing some profit taking. So Tech and Auto is lower. On the flip side, Coal India, 0.5% higher. Geo Finance is seeing a little bit of traction. Adani Ports, Apollo Hospitals, and ONGC. But it's very, very quiet out there. There's not much moving. On the banks, HDFC Bank is keeping the flag flying for the bulls for what it's worth. About 0.3% higher, but it's not really enough. Axis Bank is a little lower. ICICI Bank has got a little bit of red tinge on it. And State Bank of India is absolutely flat. Banks are totally undecided. Basically, the Nifty is again doing what it's done the whole week, consolidate with zero direction. Nigel.
Well, that's right. A few numbers, though, are standing out. You have Suzlon that's flying away in today's trading session. It's up more than 10%. So that's the blockbuster earnings of the day. You have Lumax Auto. Well, that stock as well is up close to around 8-9% as we speak. So that is well reacting to its numbers. EIL, Engineers India. Well, that one, in fact, has spiked up. Good move is what we're seeing on that particular name. So let's get that stock as well up for you on the screen. And Equinox. So quite a few winners actually that we're seeing on the screen. Many of them doing very, very well. On the flip side, you have Jagran Prakashan. That's down close to around 8%. So that's coming for a hard knock. You have Landmark that's down close to around 6% as we speak. Popular Vehicles as well down close to around 5%. Ola Electric, I think you already pointed that one out. That as well is under some pressure. And Shalby, that's another one that's lower in trade. Vectors, it has seen a good run, I think, of late, but that in fact is down close to around 4%. So those are some of the big movers in today's trading session. Plenty of winners, though, and that's why the number of stocks advancing are more than the number of stocks that are declining in the breadth of the market in favor of the number of stocks advancing. But BSE, that's another one that's up close to around 5%. So BSE has pulled back, I think, all of those losses that we saw. That one's on its way to make a fresh 52-week high yet again.
All-time high, Nigel.
Yeah.
BSE is at all-time high, so it's a 5% pop. Number 2 volume-led gainer on the NSE today, across the board. I think people like Gurmeet, etc., have been telling us that the NSE, the unlisted NSE shares have also, there's a fuse under the NSE shares as well. But that's unlisted. But this is listed. You can see what's happening here.
I'll give you a data point on that. NSE now, you look at global exchanges, the total market cap has gone to around $65 billion. So currently it's in 5th position, behind the top names. But in terms of profitability, actually NSE is quite up there because of the recent run from that 1,600 to around 2,200. I'm just pulling out some data. So that's around $65 billion now in terms of market cap. If it lists, it will come in the top 10 stocks here in India as well. So
5 lakh crores in market cap.
Yeah.
Last year they did about 12,000 crores in net profits.
Yeah.
40 times earnings.
Yeah.
So it's not
cheap.
It's not cheap anymore.
Yes.
But the thing is, people are looking at it's like
When it lists,
no, it's like both one looking at the other looking back, and then it's. But in any case,
Rising together. In any case,
a much bigger exchange in that sense. But yeah, BSE of course is doing very, very well. Suzlon is up about 10%. Swiggy is up 2%, 335 on Swiggy. That's a very large volume-led gainer this morning. EIL is up about 5%, 230 on EIL. Concord Bio has been doing well, and Concord Bio is up another 4% this morning. Zentech is up 3.5%. Inox Wind and Sobha. Techno Electric has seen a bit of a rocket-like move this week, I think. It's up 25% this week. Oh boy, it's a big one. Coromandel is up 1.5%. Senco is up about 3.5%. So yeah, it's lots happening as far as the broader space goes. Mazagon is down 7. Garden Reach is down 3.5. Bajaj is down 2. Infi is down 2. Cochin Shipyard is down 2.6. So, I was just talking about Cochin earlier. Numbers, the earnings have been brought lower by the street. People who cover, analysts who cover, the stock's gone the other way. Today it's taking note, I guess, after the Mazagon numbers. So that's the start. Birlasoft, Rima was pointing out, 3.5% lower. And Nibe, which is a defense company, is down 5%. It's coming out with volumes. And I was reading they've got some order with from an Israeli company, tie-up order. So that's some 60,000 shares, 5% down. We have Karthik Kumar, who's with us, fund manager at Axis Mutual Fund. Karthik, good morning. Great to have you with us here. Thank you for your time. We've been in a bit of it's broadly been good. There's no two ways about it. I think, 6 weeks now? At least broader markets with breaks in between, a week or two, but otherwise steady, and the direction has been north. What's your sense, Karthik, from here? Is there enough in the tank for the market to sort of keep pushing up, pushing higher?
I think what's happened is while the earnings season has started on a good note, where we have the number of stocks beating estimates have been substantially higher, but that comes with the caveat that the earnings estimates were kind of well managed going into the season. Our estimates were, the expectations were quite low. So that helped. Also, the fact that we had a correction previously, which meant that we had room for a rally. So now we are back to valuations close to peak valuations, what we saw in September 24 across large, mid, and small. So I think for this to keep going, we would need improvement in earnings sentiment. We would need upgrades in earnings for FY26 and 27, and I think that will come a bit down the line when things improve for multiple reasons. But in the interim between now until earnings improvement kicks in, I think the market is more likely to be range bound. Having said that, we've seen risk appetite improving, which is why the breadth of the market, as you pointed out, has been doing well, and small and mid cap in general have been outperforming large cap. So the risk appetite has improved, but for the entire market to move to a next level, I think would require earning support from here on.
Okay, all right. Hi, Karthik. Good morning and good to see you. One theme that I think you were quite overweight on was the pharma as well as the healthcare sector. That continues to remain your top weight?
So pharma, healthcare, we continue to remain overweight. I think there it's a case of expectations as well. The sector had underperformed previously, given the uncertainty, especially policy-induced global uncertainty coming from US. And I think as that clears up and expectations there is more visibility around that, I think that sector should continue to do well, which is why we continue to remain overweight pharma in general.
Overweight on pharma. Got that. Karthik, hi, morning. Thanks for joining in. So, what's the sense, if I talk about a broad strategy from here, because the global picture is still very, very murky. In general, the sense is that domestic macros are looking very good, whether it's the liquidity conditions, expected rate cuts, a bountiful monsoon. So, what's the best way to play the market, say, over at least the next 6 months, if you are to gear your portfolio to capture some of this, positivity? What would be your top plays or top sectors?
From a style perspective, I would say what's happened over the last 4-5 months is essentially markets kind of penalize growth, because there has been growth stocks, however you look at it in terms of expected growth, or if you look at earnings revisions, markets not really rewarded these stocks because market has been skeptical of the growth picture in general, given the uncertainty, especially emanating from US and tariff related uncertainty. But I think as things clear up, growth as a style will be worth looking at, because at the end of the day, the markets will reward growth, especially in an environment where FY26 and 27 numbers as of today still continue to be cut. As we've gone through the earnings season, the earnings has been cut by around 1%, which is not a lot to put it in context compared to some of the previous quarters, but still, I think markets will continue to value growth. So that's an area that I'd continue to look at. Growth along with quality is something that I would continue to look at from a purely style perspective. From a sector perspective, I continue to remain overweight pharma. We also have good exposure to financials. Financials, if you break it down into components, be it banks, NBFCs, or capital market plays, each of these buckets offer their own strengths in terms of be it valuation comfort or growth in case of capital market names. So those are the two areas we will remain overweight. And areas where we would remain slightly underweight would be consumer names, be it consumer staples or discretionary, largely because the earnings environment continues to remain tepid. The growth outlook also continues to remain a bit soft in the near term. We expect it to improve later down the year, given the various steps that you mentioned, the reasons that you mentioned. But when it happens, we'll relook at it. As of now, we continue to remain underweight those sectors.
Okay, all right. Karthik, just hold on to that thought. We have some news coming in on Kiri. They'll be looking to sell the entire 37% stake in Dystar Global. The stock actually is seeing profit taking. You'll be interested to see how things move from here. They're stated to get close to around $697 million. But keep in mind, yesterday it saw massive delivery-based buying, and the stock ended at the high point of the day as well. So that's why I think sustaining that up move that we saw will be interesting. In fact, as we speak, the stock is selling off. Because of the big move that we have seen in the last few days, it seems the street is already sniffing some kind of good news. And as we speak, a sharp downtick. I think if we can pull up a bar, you'll see that the stock has cracked big time just in the last 3 or 4 minutes from the time that piece of news did come up for you on the screen. Initially, it was read positively, but that bounce has got sold into. Get an intraday chart, just today's chart. That will tell you a perfect picture of the way the stock has corrected, because it seems, just take a look at that. Yesterday, massive delivery-based buying, and the stock ended at the high point of the day. So it seems, at least as of now, there's a sell-on news that's playing out on Kiri Industries. Well, that said, Karthik, coming back to you, I think tech was a space that was looking encouraging a couple of months or so ago. But now there's plenty of uncertainty there in the United States. And also, we've seen that the rupee actually has stabilized. Normally, a weaker rupee is something that makes you more inclined towards tech. How are you all positioned now on tech?
Depending on the funds, we are around neutral to slightly underweight tech. Obviously, the positioning would depend on the individual mandates as well, but that's largely how we are positioned. It's more a bottom-up allocation within tech where we have comfort around some of the mid-cap names within tech and specific plays in large caps as well. So it's more of a bottom-up stock play. The catch there is that while there is uncertainty, the sector has already corrected a fair bit through the year. And the expectations are also not very rosy. So in that context, things at least have a low base. So that's something worth looking at over the next few months.
Okay. Finally, just a word, Karthik, because next week it's the RBI policy and, one is still expecting more rate cuts this year, right? On financials, what do you like the most? And are there any segments that you would avoid? I mean, for instance, let's say capital market plays. I don't know if you still think there's more upside, but just give us a broad overview of what you're doing here. Lenders and non-lenders, both.
Okay, so within financials, we like large private banks, and we also have exposure to NBFCs. And within capital marketplace, as you touched on, we are quite selective because valuations in some of the cases are quite rich. So it is very specific at this point, and it is not as broad-based as, let's say, 3-5 months back within the capital market space.
No, absolutely, and it's a space which, of course, has done so well, and really a consensus kind of overweight for many in the market out there. So I just want to quickly look at a few other names. Seems like it's turning out to be a bit of a PSU move as well, right? I mean, so just look at these names. EIL was not there in the mix when we started. In the morning, it's up 8% now. EIL, it's got large volumes for this point of the day. I don't see it very often here. The other one is MMTC, 8% up. It's the fourth largest volume-led gainer. That's why I'm saying these are not names you're used to seeing at 920, 925 with these kind of volumes. So EIL and MMTC are two names which are coming through with large-sized volumes and gains as well. Olectra saw a bit of a dip on adverse news flow. It's back up about 4% right now. There is Newgen, which is up about 3% or so as well at this point in time. So that's the broader kind of picture that we are working with right now. Within Karthik, within the pharmaceutical space, and we had one company from the CDMO API, Cohance, earlier on earnings. Anything you like in particular?
We are looking at more generics and APIs focused on US, and there are a couple of companies there where we have reasonable exposure domestic markets. So that's the space that we are looking at, and some hospital names in there as well.
Okay. We'll leave it there. Thank you very much, Karthik, for joining us. Appreciate it, and good speaking with you. Now, the Finance Ministry has told the Reserve Bank of India to ensure interest of small gold loan borrowers are not impacted by the new draft guidelines. My colleague Sapna from Delhi is joining in with this important story. Sapna, good morning.
Yeah, morning, Prashant. So I think this is a kind of not exactly a pushback by the ministry, but it's important to note that their internal views to the regulator have actually been put out in the public domain. I suppose the sensitivity of the matter is such because there are so many small ticket, borrowers under the scheme that the government has deemed it fit to bring it out in the public domain quickly and ensure that whatever guidelines are finally formed up by Reserve Bank are in sync with the kind of feedback that the government has received. And very important, Prashant, all of this has been reviewed at the finance minister's level. So the feedback is actually coming right from the top. And as we have seen in the earlier draft discussions as well, when the LCR issue came up and there were certain other aspects also that were there in the public domain, the feedback of the government has been taken on board by the Reserve Bank. So here, basically, what they're trying to ensure is that whatever restrictions or changes or new ways of borrowing or new terms and conditions that are imposed, that should not impact the small borrowers, basically the borrowings with their ticket size of around 2 lakh rupees. And this is also a common kind of a benchmark if you look at a lot of other government schemes which are ongoing. For example, the Kisan Credit Card say, loans up to 2 lakh rupees should have, a higher interest subvention, for example. Government is just trying to ensure that, whatever the guidelines that come in the final shape, sorry, excuse me, they should not impact the small customer. That is
the small borrowers.
That is their exact focus, and that's what they're trying to ensure.
All right. Okay, Sapna, thank you. Thank you very much for that. That's an important update, and thank you for putting that on the table early up in the morning. So watch this space for more regulatory action on the gold lending side.
I want to say one thing, Surabhi. So the thrust of what Sapna put out seems to be, I mean, if you had to really simplify it through the stock market lens, this is positive for gold finance companies. Because, they're saying, what are they saying? They're essentially saying, do not impede on the small borrowers who use gold as collateral.
And they form the bread and butter of the customer base of a lot of the gold finance.
So for gold finance companies, I mean, actually, if anything, if you had to sort of, distill it down to incremental positive or negative, I mean, this is positive. Go on.
Okay. All right. Well, back to earnings then. And the next company on our radar is Bajaj Auto. Q4 results were very steady. They were in line with street estimates, and margins continue to remain above 20%. And this is actually for the 6th straight quarter. Let's take the discussion forward with Mr. Rakesh Sharma, Executive Director at Bajaj Auto. Mr. Sharma, good morning. Thank you very much for joining in. And let me start by complimenting you and the team. I mean, 20% plus margins, 6 quarters in a row, through all the ups and downs of the economy and, currency and whatnot. So kudos to you. Now, that's the good. But my first question is going to be on the challenge, which everyone's talking about in the market. And that is, volume growth and market share. Market's very happy with your margins, no problems. Everyone's saying, what about more volume growth, more market share? Because in your bread and butter segment, the 125cc plus, there has been, a couple of basis points dip in market share in FY25. So what are you doing about it now? And what's your expectation on both volumes and market share in FY26?
Good morning, and yes, thank you very much for your generous comments, and to also keeping the margins steady when the electric business is growing from like 10% to 20% of our domestic revenues also required some management. And you have rightly highlighted one of the important areas which the management is focusing, which is the market share in our core focus area, which is the 125cc plus segment. We are hungry for more. There is no doubt about that. But let me put it in perspective. This segment started to really grow, surge forward just around post-COVID and the post-regulatory things which had happened. And at that time, let's say about 3 years back in FY21, our market share stood at around 20%. These are estimates based on registrations. And that by FY24 end went up to 25.5%. And we feel that in FY25, we have probably, particularly in the second half or the middle of the year, lost about 1.5 percentage points. So that's the perspective from 22, I would say right now about 24. But we would rather look squarely in the mirror and be hyper about even, a decimal loss, because our intention is obviously to strive for leadership in the segment. We are a steady number 2, at least 50% ahead of the number 3, number 4, and behind the number 1 by at least about, I think, 5-6 percentage points. So we are striving. We would continue our thrust based on new products. We've got a good pipeline based on new products, both in the 125cc and the more sporty 150cc, 160cc plus segments.
So I don't hear some kind of price action coming in from you in that reply to kind of bump up the volumes? And also just tie in the volume picture, sir, because I know that in your call you've guided for, I mean, the overall industry is saying 5 to 6% growth in two-wheeler volumes this year. How much better can Bajaj Auto do over and above that? And I'm talking about the domestic business. Exports are again firing up. They've turned around very well for you. But let's talk domestic two-wheeler volumes.
Yeah, let me take it one by one. We don't think that the pricing card is a sustainable card, because competition always has the right to drop their own prices. We will use pricing only to calibrate with competition, because if we find that there is a competitor move and their pricing goes beyond whatever premium or discount we can justify in our portfolio, then we will adjust. But we do not subscribe to the option of using pure pricing to acquire market share, as it is not sustainable. And as you know, we are always balancing between growth, market share, and profitability. Going forward, I would say from an industry outlook, it's looking like what it was in FY25, which is about 6%. Quarter one last year was 11%, then that dropped down to 2% growth. Then the festive was very, very bright, particularly October. And quarter four was, mildly negative, minus 2% or so. Registrations came in negative. But overall, the year was about 6%. I think the same pattern is going to continue. We are going to see this kind of a growth, but that growth might come in very, very different shapes and in very different regions.
But how much above industry, sir, will Bajaj Auto grow at in terms of volumes this year in two-wheelers?
Yeah, I was coming to that. One thing is, which has held steady, is that the 125cc plus segment has outperformed this 6% growth. It'll probably be between 8 to 12% growth, and we would be looking at growing faster than that.
Okay, so 125cc industry-wide is growing 8 to 12%, and Bajaj would want to grow even better than that. So one more point on
125cc plus. That means
125cc plus. Yes, which is your core segment, which is your target addressable segment. So you should be growing more than 12%. 12% is industry growth. Bajaj should be growing above 12% this year in that particular segment. Got that point, sir? Just very quickly on KTM, because that's a sort of strategic move that seems to be shaping up as well. Since we're talking, motorcycles, I think the intent is very clear that Bajaj Auto wants to take now, ownership. You've made several moves towards that. What should we expect in the turnaround from KTM? I think this particular quarter, you had stopped your exports, as far as this JV is concerned. What's the expectation from KTM in FY26, and what happens in terms of taking that ownership control?
Yeah, so there are two sets of actions. One is, of course, to solve the liquidity issue and pay off the pared down debt. As you know, that the creditors took a 70% haircut, and there was a court supervised process which required this commitment to be made by 23rd May, which has been made. And the second aspect is the intention of Bajaj Auto to take majority control. I must say that this is subject to regulatory clearances, both in India and overseas. This is our intention. We have made that clear, and we are in the middle of the process. Till these clearances are secured, everything is at standstill, in the sense that management structures and management is being conducted the way it was. Once these clearances are gained, and we will truly then start to put shoulder to the wheel along with the KTM to make the turnaround happen. The exports, you're right, because of the liquidity situation, were curtailed last quarter, even though there's some very, very healthy demand. But with the liquidity improving, exports has got unlocked. We have already started exporting April onwards. And, April, May, and June. So we will have exports this quarter and, of course, next quarter. Our exports to KTM in normal times would be about 6% or so, but they dropped to nil.
Okay.
And so therefore you will see, this positive support to our exports growth ATM this quarter onwards.
Okay, so just a 20-second answer. I'm apologizing. We have other managements waiting as well. Just as the EV portfolio ramps up, will you manage to retain margins at 20%? And what's the ramp up in EV volumes? Just very quickly.
Well, the EV volume should ramp up. The margins are a consequence of many things. We will have to, our intent is to keep managing dynamically, but the dollar is the rupee is appreciated against the dollar. There is some marginal headwinds when it comes to the commodity and the material cost inflation, and we have to watch competition. The intent is to keep the margin steady, but there are some headwinds, particularly from the currency side going into the quarter.
Okay, so we'll watch out for them. Thank you very much, sir, for joining in. Good conversation. Thanks for giving us an overview for the year. Need to take a very quick break right now. Come back on the other side, and the management of Welspun Living will join in to give us their perspective on FY26.
Welcome back. This is Corporate Radar, and as promised, let's get straight to our next management. Welspun Living reported a muted showing in the past quarter. The year on the whole as well was a little bit subdued, a little lower than what the management had guided. Ms. Dipali Goenka, the Managing Director and CEO at Welspun Living, joins us on the show. Good morning, Ms. Goenka. Thanks a lot for joining in. Well, let's talk about a couple of numbers and the outlook for your company. Now, your top client, one of your top clients, Target, they have cut their full-year guidance. While the Walmart CFO, they are talking about price hikes because of tariffs. In this sort of challenging backdrop, for your company, what kind of revenue growth can you deliver as well as margins? Let's get both these two numbers out, and we'll delve a little bit more.
So hi, Nigel. Glad to be here. I just wanted to give a perspective here that the markets are going to be dynamic, and we all know that the global landscape looks very, very uncertain at the moment. It's a matter of, a couple of maybe quarters when we'll get a clear visibility of where we stand. Consumers continuing to go to buy. There might be a kind of a dip of around a couple of, percent where they'll not buy that much, the discretionary spends. But this could be just an uncertainty for a couple of quarters. I think that's what we are seeing as a world. However, when I talk about us as Welspun and I talk about India, India has a great opportunity. Look at, the FTA that's happened for UK. That's a great opportunity. And with Welspun as well, our portfolio has increased to around 35 to 40% on the rest of the world, apart from United States of America as well. So I think I'm looking at both sides as well, because there's an opportunity to grow markets in UK, Europe. FTA is just right around the corner. And that's where I think could be a great opportunity. India, you started seeing the green shoots in the terms of consumption. So definitely that's what we are actually looking at.
All right. You want to give us a number? What would an aspirational revenue growth be for the year, as well as outlook on margins?
You know what? That's going to be something I really cannot, because I think quarter one, quarter two is going to be very dynamic at the moment.
Okay, all right. Your exposure, let's talk about what you just spoke about. Exposure to UK, I think, is a little south of 10%. I think it's around 9%.
Yeah.
How do you see revenue increasing post this UK FTA? And also, since you're sounding quite optimistic, have there been increased inquiries from the current as well as new clients?
This whole aspect of being, having a back foot as a country from Pakistan and Bangladesh with a kind of a delta of around 12%, actually India stands to gain. So while we can say that we were growing at, like a 9% kind of a market share, or of our pie in the terms of UK, but this actually gives us a delta for a huge kind of product portfolio that Welspun makes. It's not just going to be bath towels, but sheets, bedding, rugs, carpets, flooring, advanced textiles as well. So that's the kind of a landscape that we see, and it's a huge opportunity. And, the whole thing is that, a few retailers that, we talk about, but it's an entire landscape that opens up, which actually is huge, which starts from the hypermarket to the better and the best as well. So, yeah, that's a huge landscape that will open up because of the FTA benefits that we can actually now move to and cater to as well.
And maybe other FTAs are also coming. I mean, it's all moving towards bilateral one-on-one instead of these multilateral arrangements, and we'll see if you benefit out of it or not. Dipali, good morning. Prashant here. Could you quantify that size of opportunity for Welspun because of this UK FTA?
Quantification, if I talk about, is not something possible. But I think when I talk about, kind of in the terms of a top line and where we are today, we can actually definitely see this market share grow. And I think when we used to talk about earlier, US used to be around 80% today in that big pie of ours that we have of over 10,000 crores now. I think US is now around 60%, and the rest is the rest of the world and India as well. So that's where you can see this grow. We have a North Star of around 15,000 crores that we are targeting as we go forward. So yes, you can actually calculate what it could be.
So FY28 guidance sticks to that approximately $2 billion, 15,000 crores of revenues with around mid-teens margins, 15-16%. Is that correct? FY28.
Absolutely. And where brands will also play a very big role as well. Let me also tell you that, because right now today as well, we are around, contribute around 15% of our top line with our brand portfolio that we have.
Okay, all right. I wanted to ask you a couple of more questions with regard to this top line itself. The flooring business, that's a little disappointing, right, Dipali? I'm sure you would have liked to scale that up a little bit more. Yeah. How do you see growth for the floorings division move up? And also on advanced textiles, it's still a smaller part of your business, but giving you very good margins. Yeah. So what's the guidance on both these two segments?
So I'll tell you one thing. Let's talk about flooring first. And yes, it has degrown this year. But I think the opportunity here really plays strong in the terms of even hard flooring, because here is where the China Plus One is literally playing right now. So definitely that's what we are seeing in the terms of a hard flooring. Now, when we talk about the soft flooring here, the opportunities have opened up, not only, where we talk about now we have the home improvement retailers in America, in United Kingdoms and Europe now with the FTA happening. That again will be a huge opportunity. Hospitality, and also the commercial space in the United States of America. India, actually, we have grown by 12% this year, and that again holds a very good opportunity here. It has been a very steady kind of a growth that we've seen. But I think, having said that, this is one of the most modern plants and only plant in this side of the world. So definitely, we are going to take that little burn and grow at a steady state. When we talk about advanced textiles as well, I think I can tell you now, we are moving upstream in the terms of innovation. Apart from spunlace now, we are looking at an opportunity to sell jackets, which are like, innovative jackets with one of the big retailers in Europe. We are also looking at wipes, dry and wet wipes in the United States of America. That again is a huge opportunity that opens up because of the other countries. I think India gets that edge there as well.
Okay, give us a number though. Advanced textiles, currently I think it's doing ballpark 500 crores, if I got that number correct, with margins of I think more than 20%. Yeah. Where does this number go? Because you're saying it's a big opportunity, but you're falling short of numbers. So in the next 2 years, where does advanced textiles go? And what kind of a revenue growth can we see for the floorings business, say on an average for the next 2 years? These two numbers and we'll wind it up.
So I think the flooring, let me start with flooring. Flooring, we've actually looked at a growth of, with the kind of right now, the capacity is at 60%. We will grow it to around over 2,000 crores. That's where we see the flooring business go to. Our advanced textile will go to around 1,000 crores in the next 2 years. The opportunity here will be to add on more value-added products rather than just doing commodities. And that's where, we will see an advantage. This quarter, we clocked a good margin of around, say, 18 to 19% in advanced textiles. So I think you can actually look at that we can maintain this along with adding on more value-added products in advanced textile too.
Dipali, I'll tell you, it's a true story. By the way, the flooring is really cool stuff. Stick-on flooring and a lot of the, but I think maybe it needs a little more awareness. We need to spend more.
Yeah.
I'm suffering nowadays with with a lot of work happening around me at my home. So I've actually sent suggestions to my neighbors to use the stick-on flooring and not go,
To let us know that.
banging. So
We'll be there.
I think all right. Thank you very much, Dipali. Great speaking with you, and good luck with all the businesses that you're excited about. Thank you very much.
Thank you so much.
Okay, let's just now take it to our next management, which is with us. And this is Samvardhana Motherson, which reported a healthy set of numbers. Revenue growth came in good. Lower tax expenses added to their profits. Let's discuss this more with Pankaj Mittal, Chief Operating Officer, and Kunal Malani, Chief Financial Officer at Samvardhana Motherson as well. Pankaj, thank you very much for joining us. Kunal, thank you very much for being here as well. Prashant this side. Pankaj, I want to straight away sort of dive into the, not the main automotive business, but the consumer electronics business, Pankaj. And it's an area where you guys are very bullish about. It's a large opportunity. It's the right space. You guys work with Apple as well in terms of supplying components. How after the recent, I don't know how much you can sort of tell us, but I'll have to ask. We heard President Trump essentially asking Apple to come back to the US, to make in the US. Have you heard anything from them? I mean, I think they're, of course, making out of Chennai, down south, now I think Bangalore, and there were reports they were scouting for another sort of facility in the north of the country. What have you heard from them, if anything at all?
Good morning, Prashant. Thank you for having us with you today. As far as we are concerned, whatever we are doing in the consumer electronics business is on track. So as we have mentioned in our presentation also, we are accelerating production and capacity. One of the plant is already operationalized with a sharp ramp-up capacity to supply to about 15 to 17 million units. Two more plants are in place coming up, one in this year, in the next few months, and another one in 27, which will be even a larger plant. As we intend to do what we are doing today, we intend to also do vertical integration and add more value. So our plans, what they are for the consumer electronics business, are on track.
Mr. Mittal, just to understand, can you give us a sense at a blended revenue level, how much of your revenue, say by FY27, maybe that's a better year to look at, or maybe FY28, how much of it will come from the consumer business? Just want to understand how the revenue mix will change 3 years on.
This is still something which is in the offing because there are lots more to come in this sphere. So as we move forward in this area, we will come back to you with a number. As far as current business is concerned, we had indicated an investment of about 2,600 crores into these three facilities, and more will come. We are not at liberty to disclose at the moment the revenue figure.
You know, you said that there is enhanced engagement, new product evaluations are underway, et cetera, et cetera. With regards to, of course, the customer that I mentioned, is there any? It's all on track, sir. Have you heard anything at all, or will, in your assessment, even if you've not heard, do you think exhortations by the president in the US will slow down plans to make more here?
Well, as we had mentioned in the very beginning, that this is a business which we are doing with a partner, with Beal. As you would know, that they do multiple products.
Yes.
And the kind of business which they do, so it's not, there are multiple customers. And as we have been maintaining that there are, we have non-disclosure agreements with various customers with whom we deal with. So we are not at liberty to disclose something more than what we have disclosed so far. I think this information which we have provided in terms of our greenfield sites, in terms of vertical integration, and that our business is on track should be good enough.
Okay, all right. Hi, gentlemen. Good morning. Thanks a lot for joining in. Well, the street is optimistic, and you all as well have mentioned numerous times that the content per vehicle is likely to improve because of premiumization, electrification as well. Could you give us a broad number? What is it at currently? And where is this number headed to, say, in the next 3 years?
In terms of our content, you could see that from the product profile which we have provided. So you see that we were primarily one product maker, and today there are so many different products which are coming in, and they come in at the behest of our customers, both by doing ourselves or through acquisitions or ventures, which we have been partnering with technology providers around the world. We added new partners. 23 new acquisitions were done in the last period, as we have mentioned in the last 5 years. So you see that there is a huge amount of new products like sunroofs. We have fuel tanks. We have multiple products, integrated assemblies. So that's how we keep adding the content, and that's the way in which we will continue to do in the future as well.
Yeah, but do you have a reference number, sir? We get that. You know, I've said this a couple of times in the past as well. You're getting into better products, etc. You know, higher amount of premiumization. Do we have a reference number to work with on a content per vehicle as of now?
See, we are not. See, what you have to look at is that we don't supply to every model all the products which we do. So it's a huge spread. It's about being a solution provider to our customer. So that's the quest. So it's a direction in which you could do more and more. And the company has also diversified, not just into the automotive side, but also into different industries. So you see, we today support the aerospace industry. We do the rolling stock industry. We are into the consumer electronics. So that's the way for us. And when we do integrated assemblies, there is a huge amount of potential in the market to do multiple things. And new products like we are doing now for companies which make machines for equipments for silicon wafers, we're doing products for them. So it's a journey in which we keep finding more and more avenues to support our customers.
Sure. All right. Got that. Let me come to Kunal as well for some questions. Kunal, on the here and now, the P&L for the fourth quarter, your overall revenue grew about 6%, but blended margin was under a little bit of pressure. And I think the bulk of that pressure came in from your modules and polymer products business, where margins have come down from double digits, almost 11% to about, I think, 6.5%. While the margins for the wiring harness business are improving. So can you just walk us through whether this was a one-off pressure in your modules and polymer business? What's the outlook for both wiring and harness and modules and polymer for FY26, especially focusing on the margin?
You're right. Our module polymer business did have a margin decline. And this was largely on account of the volumes dip that we saw in Q4 for the European side of the business. There was a 9% volume dip that we saw on the European side, which wasn't really expected. In April, you would have seen we've also announced a transformation plan in Europe in order to take out around about 50 million of costs in the next year or two. So we saw the market decline and started recalibrating it as we moved down the path. Now, as you know, and we've always spoken about, it is always better to look at us from a year-on-year basis.
Sure. So yeah, just year-on-year margin outlook and revenue outlook as well, if you can, Kunal. You grew 15% last year. I think 8% was organic growth, rest was acquisitions. So just very quickly, FY26 revenue growth outlook and margin outlook.
I think one, on the revenue side, we should do better than where we are in FY25. So I think we should do better than where we are, even though the market backdrop seems to be a little soft on production and tariff uncertainties. When we look on the margin, we've always said don't look at the percentage margin because there's a lot of moving elements on account of commodities, etc. So on an absolute basis, we still hope to deliver a better result than FY25.
Absolutely. Just one last question here, Pankaj. I think you've said that you are open to customer-supported M&A. There is also this news flow around Marelli. So you reportedly made a buyout offer for them. This is new information. Anything you can tell us, Pankaj?
We have already given information to the stock exchanges that there are various discussions which we do with multiple companies around the world. So as soon as something on any particular acquisition gets fructifies, it will be informed to the market immediately.
That's a standard answer. And I think you would give us nothing less. But would give us something. I mean, so you are obviously talking in that sense, right? And should we hear something soon?
We talk to multiple companies. So, M&As are something where unless and until something gets fructified, So very difficult to say something.
Yeah, and you've done a string of acquisitions over the years, lots of them around the world. Pankaj and Kunal, thank you very much for joining us. It's a pleasure having you here on CNBC-TV18. Good luck, and I hope to speak with you again soon, especially around news flow coming through with regards to the consumer electronics business, Apple, as I began the conversation by saying, being very closely watched for any signal if they or other global large companies slow down their plans to build more here. We'll take a quick commercial break here. We're going to come back and we'll focus on one of the top gainers of the day today, Suzlon. Stock, the last I checked, was up over 10%. We have the management with us right here in the studios, Mr. JP Chalsani and Himanshu Modi, both here in just a bit on the other side.
Welcome back. As you can see, the next company on our radar is Suzlon Energy. We have the management right here with us in the studios, and it's been a blockbuster quarter, a great solid end to the year for Suzlon. Stocks right now is surging almost 10% higher last time I checked. So let's just quickly revise the numbers. 73% revenue growth, nearly 100% jump in profits. So let's find out what's working for the company and what the outlook is like. We have the company's CEO, JP Chalsani, as well as CFO Himanshu Modi right here in the studios to talk about the performance. Gentlemen, thank you so much for joining in. Great to have you on. What a blowout performance. I mean, top line and bottom line. I'm just looking at where you are. I think the wind turbine generator order book is about 5,555 megawatts. As of May 25, deliveries have been fantastic. Mr. Chalsani, I mean, tell us if this blockbuster performance kind of continues into FY26 also?
Yeah, I don't call it as a blockbuster. If you say that the last 24 months, quarter on quarter, we have been working hard to consolidate in various areas. You have seen us doing that on balance sheet. You have seen that doing an order book. And in fact, today we sit with 2,000 crores of cash instead of a debt on the book. And then we worked on the organization, people and leadership. And that's what is actually showing the results today. Okay. So I think this is a result of, you've seen it's quarter to quarter. It's not just suddenly jumped up. Even in the quarter three, if you see, we've done well. We reach a stage where now we believe that, yes, we are now in a position to continue to have this growth and then meet what are the stakeholders' expectations from the sector and from the Suzlon.
So what's powered the performance in Q4? I think one is higher than expected deliveries. Most estimates in the streets were lower than what you've actually accomplished in terms of just more deliveries. And then the margin performance is also what the street really likes. I think the gross margin itself has gone up. So Himanshu, you want to comment on this, on what's driving the margin and whether this run rate of deliveries is continuing in this year as well?
So clearly, the larger theme that at play is, which we maintained all the time, that the economies of scale have now started to kick in for the company. It's early stages still. We've seen Q3, we saw some early signs. Q4 has, of course, seen, as a report, good gross margins on the WTG division. We've had about 23.6% gross margin on the WTG division, and we've always given guidance that close to 20%, but we've been able to exceed that by about 3.5%. And I think going forward in FY26, we are confident that we'd be able to maintain those margins for the WTG division at the gross margin level.
23% gross margin.
Yes.
Got it.
All right. Hi, gentlemen. Congratulations on a solid showing. Let's talk about the industry first up. There is that fear with regard to installations. I think for the last year, the installations moved to around 4.2 odd, if I got that number correct. For this year, for the industry, what kind of installation numbers are you looking at for the industry first?
Yeah, for the industry, I think we've been growing consistently. Yeah. Like if you look at FY24, it was 3.2 gigawatts, and we had a 28% growth in FY25. Moved to 4.15 gigawatts. And then our expectation is that in FY26, the current year, it would be 6 gigawatts plus. And then this will keep, I said that last time also, it will keep going up. And then we should peak around 9.5 gigawatts. And the target of 2030 of 100 gigawatts, fine, we would be somewhere closer. I mentioned last time we should still be closer to that. So therefore, we'll continue to see the growth in sector as well. Okay. At this year, like we're expecting 50% growth compared to last year to this year on the capacity additions, purely because the issues what were on the ground in terms of the land, in terms of the evacuation are getting sorted out. I'm not saying they're sorted out. But they're getting sorted out. So therefore, you would see the traction. In fact, as we were talking some time back, in April itself, first month of this year, we did 1 gigawatt, which has never happened.
Okay, all right. So that's for the industry, right? 6 gigawatt. Now, will you all maintain your market share? I think, sir, you know what's coming next. Last year, you did around 1.55. This year, just going by mathematics, last year it was around 37% from Suzlon. So 35%, is that a ballpark number we should work with in terms of as a percentage of the 6 gigawatt?
No, 6 gigawatts is a commissioning.
Yeah, commissioning.
So, and then 1.5 gigawatt, what we're talking about is supplies.
Yeah.
So the obviously, for the first time in our history that we gave a guidance saying that in FY26, we will grow by 60% minimum across the board. So that is not just giving a guidance of a number, and we are able to give a guidance for the first time, shows that we are now well prepared as an organization to see the future. And we would continue to grow, and we would continue to maintain that market leadership. That's we are pretty sure. So on the numbers wise, I'm not going to give exact number, but we said that 60% is what growth will see.
60%, just to clarify, I want to understand this. This is a 60% growth guidance across several parameters: deliveries, revenue, EBITDA, all growing at 60%.
Yeah, except the commissioning, which would be 3 to 4x.
Right.
Not just 60%.
Okay, let me, gentlemen, morning. So while you continue to execute, is the sector also growing, or you think it's, power demand has been kind of weak, right? This year, the last year, maybe it'll pick up over a longer period of time. And the second point is, we've been hearing more and more that PPAs, there are lots of delays in terms of PPAs being signed, is exactly because of these reasons. There needs to be demand revival. Is there a problem at all?
Yeah, I think Prashant, the demand being there or not being there is a bit difficult situation in power sector to understand. There is a demand in terms of energy. There's a demand in terms of megawatts. Okay, these two are two different things. If you look, because generally people are commenting today in the daytimes during the solar hours, we are seeing the demand not being there. In fact, the supply being more than the demand.
Correct.
Okay, that's the reason you're seeing in the exchange, the prices have come down to zero. Not only that, the grid frequency is going up during that period of time. But having said that, in the evening peaks, we are expecting shortages, continue to expect the shortages, and that's growing. Even if you look at on the exchange, it's growing. So when you look at even the energy demand is expected to grow around 5.5 to 6% energy demand. So therefore, there is a demand. It's a question of at what point of time in a day in your load curve, what you need. So therefore, there could be a subdued demand for solar, but there will continue to be demand for the products like combined solar, wind plus storage, or the wind plus storage. That will continue because during the wind generation hours, the demand is growing. And that is reflected in the prices.
There is no issue if, I mean, there's storage there as well, right? I mean, what you're saying is when the sun is shining, I mean, there is enough demand, there is enough supply, so prices are low, but then peak later evening hours is when the demand picks up and...
Yeah, it's exchange shows those prices.
Yeah.
So therefore, I think it is nothing to do with the solar or a wind or the storage. You have, in our country, we have a demand in a particular pattern. Okay, and you need to come out with a product which meets that load curve. So that could be the solar plus storage plus wind. It could be wind plus storage. It could be different things depending upon which state has what sort of a deficit at that point of time. The demand is there, energy demand is there. So energy-wise, we continue to grow at 6% level. There will be demand. There will be products which are different from the pure solar sort of thing. And there will be products which will have a combination of wind, solar, and storage at different levels, depending upon who is asking for what product. You have to design your product for that. Today, we talk about FDRE. There are 8 to 10 different types of FDRE.
Okay.
No? It's people talk about FDRE, but there are 8 to 10. Today, the customer demand saying this is what is my load profile. Even if you look at the industrial segment, which is what is a maximum customer for us in terms of 55% of our order book comes from there, they have a demand profile. If I'm a cement industry, steel industry, I have a demand profile. So as per the demand profile, you design what capacity is needed in what combinations. That's going to be there. And it will never ever be in our country, if you're assuming that we'll continue to grow, and from fourth position to third position to second position economy.
It's only the rate of growth I was referring to. I mean,
rate of growth of energy from the electricity point of view, in million units point of view, there'll be at least 5.5 to 6% growth every single year.
Okay, just very quickly, the 60% growth that you're talking about and the improvement in deliveries and the commissioning, which could be 2-3x, you're saying. I just wanted to understand, where's the bulk of the demand coming from?
If you look at our order book today, the significant portion comes from C&I, which is about 55% of our current order book. And the second one, which is growing, which has grown significantly during this year, is the PSU segment, which has now grown to 26%. Then you have the big portion of bid PPS. That's the reason where we talked about PPS not getting signed. But that's about 20% for us, 20-21% portion of it. So that's how it is. So therefore, the PSU segment is growing, and the C&I segment is growing, and we will continue to grow. We will continue to grow.
Okay. All right, gentlemen, thank you very much for joining us today. Great to have you in person, and good luck. It looks like a solid year ahead for Suzlon.
Thank you so much. Thank you. Thanks for having us here.
Thank you. Thank you.
Thank you.
Well, with that, we have to slip into a very quick break. As we take that break, just a quick glance at the market. Market's not doing anything. 30 points lower on the Nifty. Consolidation continues. We take that break, and coming up on the other side, our special segment, it's the economy. Lata today gets chatting with Ramesh Chand, member Niti Aayog, on the impact of early monsoons on the Kharif crop and the impact of MSP on rural income and the state of the upcoming Kharif season.
Welcome to It's the Economy, an important topic today. The Indian Meteorological Department has raised its monsoon forecast for 2025 to 106% of the long period average, up from 105 that it forecast in April. It also expects the June rainfall to be above normal. That is, it will be at 108% of the long period average. That's one issue. Separately, the government has announced an average 4.5% rise in MSP, minimum support price. Rice got a 3% hike. How will all of this impact the Kharif output? I have with me Dr. Ramesh Chand, member agriculture of the Niti Aayog and one of the best agri-economists in the country. Dr. Chand, really appreciate you giving us time. Thank you very much for joining us.
Thank you.
Well, first up, sir, early rains. Some tell us that that is bad and that will impact sowing. Others tell us it will mean a robust sowing. Your thoughts?
It may be bad in terms of a few dimensions, but if you look at the net, it will have positive impact. You see, it has happened after a very, very a long time. So we do not have historical data to support that that this kind of rain will have particular kind of impact. But from the experience, otherwise, that you will find that evaporation is less, water stress will be less, and effect on animals when there is not temperature going to 44, 45, you find that productivity of livestock is different. So I feel that overall it will be net positive.
Oh, overall it will be net positive. Is there any specific areas that will benefit or crops that will benefit because of early rains? Geography or crop?
Yeah. You see, already the date of arrival of monsoon in Kerala and some parts of southern India, western India, where you get pre-monsoon kind of rain. It is only that central North India, the date of arrival is still very far. So in those areas, somewhere you find that it is a week early, somewhere you find it is 10 days early. So it is likely to give a longer growing period to the crop. And also in terms of quantity, in many years we have seen that in the beginning, a little bit rain will come, it's not adequate, farmers are not sure whether they should go for sowing or not. This time, those type of uncertainties are not there. So I think overall, initially the sowing start for cereal and pulses.
Yeah.
So for them, we can expect that that it will be positive.
Oh, that's good to hear, net positive. Just if you can mention what may be the negative at all. Is there any specific crop or region which can be hurt?
Not in terms of crops. Some people just in general say if the temperature doesn't go to its normal level, there may be some nematode development in the soil, some pest insects in the soil will remain. Those kind of things some people say, but as I mentioned to you, that we do not have historical data to.
Fair enough. No, fair enough, sir. If there was any data or evidence available, you would know it. So we are primarily going by what you say, and that is net positive. That's good to hear. Is there a likelihood of higher output because the overall LPA, long period average, is 106%?
Certainly, again, there we have historical data that there is a positive relationship between the amount of rainfall and growth rate or performance of agriculture sector. So above normal, yes, in some states, maybe there will be more floods, that kind of situation. But overall experience of the country has been higher the rainfall, better is the performance of agriculture.
Okay.
And
that's important.
Holds.
That's important, and perhaps even groundwater will improve for the Rabi harvest. So let me now come to the MSP. The overall CPI-weighted hike has been 4.5%. That's the lowest in 3 years. And for rice, it is only 3%. would that worry you? That, terms of trade have already turned against agriculture because food prices, vegetable prices, cereals prices have all fallen. Would you worry that rural prosperity, rural purchasing power will be impacted?
Lataji, terms of trade should not be seen from price of 1 year or price of a few months. It should be seen but by the situation in the previous years. Terms of trade for agriculture has been rising for more than 12 years. This has been a very, very long period. And you know that last few months we have seen food inflation even touching 10%. When non-food price inflation was very, very low. I feel that this is a correction which is happening in the market, and it need to happen even otherwise. If you have terms of trade going favorable for some kind of say sector over a very, very long period, like they were there for, as I said, 12, 13 years. 12 onward, you just find they have been only improving, except some years. So it is important for balanced growth of economy that terms of trade come back to the balance. If that balance gets too much disturbed for too long, then resource allocation across sectors become a matter of concern, that it is possible that because of highly favorable terms of trade, you are overproducing something, if the demand is not there, you are not able to sell even in international markets. So I think the correction of the sort, which was expected, food inflation remained very, very high for a very long period. So it is now from last 3-4 months, we are having within the comfortable zone. That gave otherwise policy space to RBI and to the government to do other favorable things for different sectors.
Yes, that's a great point, sir, because ultimately governments, if they take away from farmer to help the consumer, they have to balance very delicately between the food growers and the food consumers. But your strong point, therefore, is that rural consumption, which has been the mainstay for the last 2 or 3 quarters, that is not going to get impacted because the MSP is lower.
No, I don't think. You see, first of all, lower, we should not judge in terms of what was the growth earlier years. The new bases selected for MSP that is at least 50% higher than what is cost A2 plus FL. That itself, that you are keeping prices highly remunerative.
Fair enough.
50% margin over A2 plus FL is, I find, quite strong and quite reasonable. It keeps prices remunerative. If the cost structure was such that it increased by, say, more than what is the increase based on which MSP is recommended, then you would have seen that it would have gone much higher. That is not the that's not the case. Yeah.
No, that's again a very valid point, sir. A2 plus FL is already a big base and takes care of all the cost increases, and hence the 4.5% should not be.
The aspect is farmer income is function of prices as well as output. If we have, say, this year also, which I am quite sure if things stay normal, that growth rate will be more than 4%. So if you give, say, 1% more price, what growth rate drops to 2%, it negates the effect of price.
So you're betting on a 4% agri output this year also, because the GDP is going to be announced, and the consensus I got is almost 5% for FY25 as well. And you think on top of that a 4% is possible this year?
You see that advance estimate of food grain have come, which are much higher than what were the earlier estimates. So the growth number of 3.8 is likely to be revised. It will go beyond 4%. And it's not that we didn't have in the past consecutive 4-5 years of good growth. that kind of experience is there in Indian agriculture. And if this monsoon remains normal, other than the date, the other two dimension, total quantity, we have estimated 6% more than normal. Distribution is, so far we didn't hear anything that it will be concentrated in the beginning or in the middle or toward the end. So far, expectation is that everything will be normal. And with that kind of situation and other measures happening in agriculture, I think this year also, despite 2.4, 2.5 robust growth rate, we can have another year of robust growth rate.
Okay. Well, just a final question, sir. There are the negotiations with the US are in an advanced stage of preparation. A delegation has just gone from India and another one is expected from the US. Where are we on agri? Will we have to open our doors to any of the US products, especially in dairy? Anything you can enlighten us in terms of what to expect?
2 days back, I with my colleague, we have brought out a working paper. It is put on the Nifty site to see in details. But I will answer your question. First thing is that US situation, Lataji, is, not certain.
Yes.
The judiciary
has stopped, yes.
You know that President has no power to do those kind of things. First is that lot of uncertainty. There was an initial big shock, then it was moderated to some extent, some understanding with China. So one is that situation is very, very uncertain and volatile, and we can't, so we have to presume a different scenario.
Okay.
So, but we have said in our paper that yes, we can accommodate to some extent concern of US. It's not only a reciprocal tariff, it should be reciprocal treatment. Yes, we are giving better ground to them, then they should also give better treatment to us. And I think we can deal with it. And our major export to US are that of prawn and fish, frozen fish. And second is basmati rice. We are quite competitive in these two. The only country in terms of fish which we have mentioned in our paper is that Nicaragua is emerging as a competitor in global market. So and they are not suffering from this reciprocal tariff kind of thing. Otherwise, if you look at the competitive measure from the past, we have improved our competitiveness in US market. And fish, and even in case of basmati rice, other items are small like natural honey, those kind of things. So I think we can manage. Our Ministry of Commerce, they are negotiating. They are trying to balance interest of India and also accommodating to the extent concern of US.
Got it. Got it, sir. Thank you very much. We will, of course, highlight the highlights of your paper on the Nifty website and get a full view. Thank you very much for staying with us, spending time with us and giving us the very big takeaway that this year's agri output can be as robust as last year's as well. That's the positive. We wrap up on Bazaar. Chartbusters coming.
Bajaj Auto sees profit booking after reporting a steady set of numbers in the fourth quarter. The company's profit and revenue see 6% uptick while margins remain flat. Management tells CNBC-TV18 that the 125 plus CC plus segment will outgrow the industry.
SJVN falls nearly 4% after posting its fourth quarter numbers. The company reports a net loss of around 127 crores, while the margins take a hit. The quarter four power generation falls by 4%.
Suzlon jumps nearly 10% as the company's reported a stellar performance in the fourth quarter. They reported a 73% uptick in revenue. Margins saw an expansion, and profits too rose multifold year on year. The management tells CNBC-TV18 they guide for 60% growth across key parameters in FY26.
And the loss expands for Ola Electric. On the back of an operationally weak quarter, the company's revenue falls 62% to around 611 crores. Kotak Institutional, they maintain a sell rating with the target price of 30 rupees.
Another earnings buzzer, Mazagon Dock falls nearly 5.5% after a sharp decline in profitability, impacted by significantly higher expenses and a margin contraction.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And the markets, well, they're giving back what we put on in the final hour of trade yesterday. It was an expiry-related factor that propelled the markets higher. And normally we see on the next day of a new series, normally on the first day of a new series, that's the next day post-expiry, sometimes the markets realign themselves yet again. I think that's what's happening right now. And that's why the Nifty is down 80 points or thereabouts. The Nifty Bank is well a little bit softish. But from the broader markets, plenty of stocks moving around. Though if you look at the advanced decline ratio, well, that's back in favor of the declines, because from around 1,500 stocks that are advancing, now we have 1,500 stocks that are declining. Crisscross on the screen.
Crisscross on the screen, Nigel. I'm just looking at the Nifty Bank. The Nifty Bank is a slight outperformer in the sense that it hasn't fallen as much as the other frontline indices. And we have a couple of stocks like ICICI Bank doing well. We have HDFC Bank as well, which is holding on. So if there is a recovery in today's trading session after the alignment that we saw in the last hour of yesterday's trading session, then the first day of the series, the low, will be extremely crucial to track for the frontline index. Remember, we're sitting on 2,200 points worth gains over the last three series itself. But it's all about individual stocks, and the first one on our radar is Samhi Hotels. The company reported a strong set in the fourth quarter, marked by a big jump in the profitability. We do have Ashish Jakhanwala, who's the MD and CEO of Samhi Hotels. Ashish, it's been a regular feature on our channel because of the recent deal that you had with GIC as well, and that's reflected in the kind of stock price move that we've seen over the last month and a half. But let's speak strictly on numbers for now. For this year, you did about 18% revenue growth, that is FY25 that we're speaking about, margins at around 36%, and your RevPAR increased a fair amount as well. So as you see things at the start of this year, what are your targets for FY26 when it comes to revenues, EBITDA margins, and revenue per available room?
Thanks for having me on the show. So I think we've had a fantastic FY25. For FY26, the early indicators are fairly encouraging, both in terms of performance of the hotels, but also what we're seeing in terms of demand growth in the core markets. So we do expect to maintain a double-digit revenue growth. And of course, we have seen in our portfolio this strong operating leverage. So for instance, if we grow our revenues at 10%, we end up growing EBITDA at about 14-15%. So I do feel fairly confident about maintaining a double-digit revenue growth, and that's without considering the impact of new inventory that we'll end up launching in the middle of the year.
Okay, all right. Hi, Ashish. Good morning. Good to see you, Ben. As always, the street likes what they've seen in terms of your operational performance during the course of the year. What about the RevPAR? What should it look like in the coming year in comparison to FY25?
So Nigel, I must say you're talking to an entrepreneur who has infinite optimism, but sometimes even my optimism is up for a surprise in markets like Bangalore and Hyderabad, where RevPAR growth has remained extremely robust. While we have always guided towards, let's say, a high single digits to early double digits total revenue growth for same set of hotels, what we've seen over the last few quarters is that our optimism has been beaten by the market, largely because the office space absorption remains extremely healthy. Airline growth continues month on month. So I think we should be able to maintain double-digit RevPAR growth for same set of hotels, really.
All right. So, that's about the same set of hotels that you're talking about. Double-digit growth organically in the revenue, RevPAR, as well as a faster growth on the EBITDA because of the operating leverage nature of the business. If you could give us a sense on, what's your operationalization target for this year? You have about 700 rooms which are in the pipeline. How many of them come on board in the next year? And from the rooms that have recently opened, properties that have recently opened, how much could that contribute to incremental revenue for the company?
So I think we just launched 2 new Holiday Inn Express hotels, one in Greater Noida and one in Calcutta. We have added rooms to an existing hotel in Bangalore. I think for us, the meaningful addition really happens around middle of the year, middle of the fiscal year, when we add a significant inventory to our Sheraton Hyderabad asset and a market which is really outperforming. And then we also add inventory to our Hyatt Regency in Pune, again, a fairly strong market. So that's really for FY26 that you'll see stabilization impact of the 2 Holiday Inn Express hotels that have just opened, and the impact of the addition of inventory in Sheraton and Hyatt Regency Pune. FY27 is a big year for us because we feel fairly confident to launch the W in Hyderabad. So that would obviously create a significant impact for our business. And a year after that, we have the rebranding of the Tribute in Bangalore, which is then going to be followed by opening of the Westin there. So we have a very robust pipeline starting middle of this year till almost continuing till FY28, FY29. And that's really without accounting for any new M&A or leases that we may acquire over the course of the period then.
All right. Ashish, if I look at your mix, the upper scale as well as the mid-scale, upper mid-scale, that's at around 40% apiece. How do you see the revenue mix shape up in the coming year as well as going ahead? What's your targeted mix? And also give us a sense about, GIC and you all did that deal with, with regard to that investment. For those hotels where GIC has invested in, what kind of a growth outlook are you looking at out there?
So Nigel, I think given the commitments we've made last year, which is for the W Hyderabad, the Westin and the Tribute in Bangalore, just mathematically, we see the share of upscale going up from, let's say, mid-40s to about 65%. Our upscale inventory is almost stated to be doubling over the next 3 to 4 years, going from about 1,000 rooms to 2,000 rooms. And that's, I think, pretty significant because currently our upscale trades at almost 2x of our portfolio RevPAR or revenue available per room, whichever way you look at it, right? So we would see a shift in the short term of our greater contribution from upscale hotels over the next 2-3 years. In the long term, I think we continue to see tremendous opportunities in the mid-scale segment. But today we don't have a very active pipeline, which is under development. The pipeline is all for what we can acquire in future. So I think in the short term, you'll see the 45% grow to about 65% in terms of upscale contribution. As far as GIC's joint venture, we have 2 fabulous markets in that joint venture, Bangalore and Pune. Bangalore continues to grow probably at the highest rate in terms of RevPAR across all Indian markets. And we do expect that hotel to continue to outperform. I think the big upside for that joint venture comes as we operationalize the Tribute in Bangalore and then open the Westin in Bangalore. Let's not forget that combined, it's about 360 rooms in a very strong market. And given current performance levels, it's almost about 90 to 100 crores incremental EBITDA from just those 2 hotels. And then, of course, Hyatt Regency Pune, whereas, we're adding more inventory this year, we'll redo some of the food and beverage over the course of the next 12 months to 18 months. So I think that joint venture, just the seed assets, I'm not talking about what we can acquire collectively in future, but just the 3 seed assets are extremely well poised for growth in the next few years.
I think the reason why Nigel asked you this question, Ashish, is because the last time you joined us on the day of this deal, you said that this portfolio could be about $300 million. Where does this portfolio stand at right now? And what's the glide path through the $300 million?
So I think, Mangalam, we have over the last 14 years built the business on M&A. And of the last few years, also some of the long-term variable leases. I think the fact that we have completely, strengthened our balance sheet, we have strong cash flows coming through the business now. We are jointly looking at some M&A opportunities, some acquisition opportunities, following the textbook that we follow, the underperforming, undermanaged hotels, which can see a turnaround through product, brand, operational management. So we believe between us and GIC that we should be able to secure some incremental opportunities over the next few quarters, and that will allow us to deploy the intended capital that we want to.
And speaking about capital, any immediate need for any other investment? I mean, we understand that you might be in talks with other private equity players as well.
Not really. Not at all, actually.
Not in the near future, right?
Not at all. But there are a few things I can say with conviction. This is one of them.
We just bowled a googly there and you did a well left out on that one.
No, I think he's denying it.
You're denying it, is it?
Absolutely denying it. I'm saying there are a few things I can say with conviction.
Yeah.
And this no is with a firm conviction.
All right, not leaving it. Actually, a solid defense out there. Thanks a lot, Ashish, for joining in and giving us those details. Just sounding very, very optimistic. But we'll hold you to some of these numbers and wish you all the best for FY26.
Thank you so much, Nigel.
Well, for the time being, we slip into a short break. On the other side, we'll continue to focus on markets, which have now moved to the low point of the day. We'll also focus on a couple of stocks. Stay with us.
Welcome back. At the low point of the day for the market, just keep an eye out on Reliance Industries. That opened fairly well and now currently has moved to the low point of trade. So, causing a bit of a downtick on the frontline index. And then we have a couple of these IT names as well, LTI, Mindtree, and the IT index on the whole comes up for you. That is too putting a wee bit of pressure on the overall health of the market right now. But then nothing really to worry. It's still 24,750 for the Nifty. Jay Thakkar joins in for a quick technical check. Jay, your call on the index levels and individual stocks?
Hi, good morning to you, Mangalam and Nigel. Well, as far as the Nifty is concerned, I think that, it's been quite long now that, the index is now stuck in a range. Both the frontline indices, may it be Bank Nifty or Nifty. I mean, Bank Nifty is unable to surpass 56,000 levels on the upside. Whatever move yesterday we saw, Mangalam, in the last 30 to 45 minutes was mainly due to the expiry. I mean, we saw Nifty bouncing back from 24,750 to almost 24,900 levels, almost on the spot. But I think that still we don't have a breakout beyond 25,100. On the lower side, 24,450, 400 is a crucial support. So that's 600-700 points range within which Nifty is stuck. And even if it breaks the range below, I think that it has got a good support around the levels of 24,000, wherein it could fill the gap as well. So broadly, the range would be of 1,100 points. But then Bank Nifty has a 56,000 clear resistance. If it manages to take off those levels and that, like that, Fin Nifty manages to take off 27,000 levels, you can have a good financial move from the BFSI, which would help Nifty to eventually break out and inch towards 25,500. But then till we don't have a breakout in hands, I would say that trading through options by doing a long strangle, Mangalam, rather buying call and put both as a short-term trading opportunity would be better. As compared to the plain vanilla option, plain vanilla position in the futures, either on the long or short, because we don't have a breakout as of now on a very clear side. Although FI position is 20% long only, but then we have seen the short rollover mainly happening on the index side, and hence I would be a bit skeptical. And until these higher levels are not taken off, I would be saying that rather do long strangle instead of going plain long on the index. As far as stock ideas are concerned, I would say that SBI Cards, to my mind, looks really good from these levels. I mean, it has provided a breakout technically from a symmetrical triangle pattern. Also from the derivatives point of view, we have been seeing continuously long build-up in this stock. So both from technicals and derivatives point of view, SBI Cards for a target of 960 in the short term with a stop loss of 895. This stock can be bought. And the second buy recommendation, Mangalam, would be on Jindal Steel. I mean, we have seen good rollers happening here as well. The stock has been consolidating, within a band of say 965, 945. But eventually, I think that the breakout is likely to happen on the upside. Today's dip should be utilized as a buying opportunity. One can keep a stop loss of 940 and target 980 to 1,000 at least in the short term.
Okay, all right, Jeff, we've got your picks. Want to wind this down since it's a Friday with a dance step?
Definitely, but post-market hours, Nigel.
No, I think you can do it right now as well, Jay. Come on, you give us that, the 1-2 4 step that you keep doing.
Breakout comes in, definitely.
Thanks, Jay, for joining in, being such a sport, giving us your view on the Nifty, the stocks, as well as the 1-2 4 step. Well, that should focus then to our special segment. We get a few ideas for profit from Money Control Pro. Neha joins us to help us out with the stock that she's tracking. Neha?
Today's stock idea is DCB Bank, which has rallied more than 35% in the past 3 months. However, there is more steam left in the stock going by the earnings performance of the bank in FY25 and the current valuation, which is the real draw. DCB Bank posted a good set of numbers in FY25 with net profit rising by 15% YOY on the back of healthy loan growth, robust fee income and contained credit cost, partially offset by a fall in the margins and elevated operating expenses. The bank's asset quality improved further with the fall in gross and the net NPA ratio. The slippage ratio has come down to the lowest in the past 5 quarters. Overall, the bank delivered return on asset of 0.9% in FY25, which is modest. However, there are levers for improvement in earnings going forward. In terms of margins, it can come under pressure due to further potential rate cut by RBI. Credit cost is already at a lower level. However, bank's operating expenses are on a higher side as it invested for growth in the past. As the balance sheet expands, operating leverage will help reduce cost-to-income ratio over the next 4 to 5 quarters. Overall, ROA improvement in FY26 can be driven by better operating efficiency, while margin and asset quality may remain stable and range-bound. In terms of valuation, the bank is currently trading at around 0.7 times book value estimated for FY27, which is very compelling. The valuation can inch closer to 1-time book value, which can result in a meaningful stock upside in near to medium term.
Thanks, Neha. Well, time to slip into a short break. We'll get you more on the markets as well as on stock-specific action on the other side. Stay tuned. Welcome back. You're tuned into Chartbusters. Well, let's take a break from the equity markets. Let's focus on the commodity markets. Manisha joins us to help us out with the commodity space. Manisha, take it away.
Well, thank you for that. I'm talking about copper right now because while we're looking at prices coming off their one-month highs, but for the month of May, it still is a very positive closing. So if you look at the LME markets, we are up by 5% for the month of May. And for this year, until time, copper has gained up by nearly 16%. It clearly is the best performing commodity within the base metal sector. And there are various reasons for the reason that the prices have continued to gain up there. But starting with the reasons that you have seen prices decline first. Well, first, it is about the risk of slower demand, the kind of data that we have seen from US, all of that has been on the weaker side. So whether it has been about jobless claims, which has seen an increase more than what the street was anticipating, and the continuing jobless claims are at almost multi-year highs there. The second thing that we were reacting to is the US GDP numbers. Well, it has seen a contraction for the first time in 3 years. Here as well, the street was anticipating. So the slowdown is something that seems to be hampering the price moves here. Having said that, other factors and fundamentals are quite supportive for copper prices there. The LME futures are trading in a backwardation that tells you that there is a tight supply in the near term rather than in the longer term. So tight supplies and immediate demand coming in has been supportive. Also, there have been reports of flood in mines in Congo, and that clearly comes in as a threat to global supply in case of copper there. The LME stocks have been on a constant decline as well. When you look at the numbers from mid-Feb, it has been a very sharp decline. The LME stocks right now are trading at a one-year low. It has declined by 43% since mid-Feb and just about stands at 144,000 tons there. The street is also reacting to the IEA data, which tells you that going forward, the demand for copper is going to be quite strong. The spread between LME 3-month and cash also stands at $40 right now. And the IEA statement suggesting that the global demand will outstrip supply by 30% by 2035 tells you that a longer-term scenario for copper prices continues to be quite stronger there, especially when it comes to clean energy technologies, the AI data centers, and with the way we're moving on to EVs and renewables has been supportive as well. The final chart should tell you on what the outlook forecasts are when it comes to copper there. So we have BNP Paribas and Citi talking about $9,000 to $9,100 a ton. This is by the end of this year. 92.25 is what JP Morgan believes you will see in the third quarter of this year. Saxo Bank and Bank of America are talking slightly longer term. They believe that 8 to 18 months from now, you will be looking at copper at $10,000, even $12,000 a ton. So near term, slight weakness, but longer term, clearly a very strong case for bullishness.
All right, there's a forecast for copper, but does the same apply for Ola Electric? Turns out not, because it's trading sharply lower following a weak fourth quarter performance. Sudarshan joins in with more. Sudarshan.
It was an operational week for Ola Electric in Q4 FY25. Losses have expanded both on a sequential basis, also YOY. But outlook that company has given for Q1 FY26 is looking healthy. Now talking about the headline numbers, loss for Q4 FY25 was at rupees 870 crore. It has increased from rupees 416 crore that company had reported in Q4 of FY24. Revenue was down 62%. It has come at rupees 611 crore against almost rupees 1600 crore. And EBITDA loss was at rupees 700 crore versus loss of rupees 312 crore. Now coming to the outlook that company has given for Q1 of FY26. Company is saying that adjusted revenue growth on a sequential basis, Q1 FY26 versus Q4 FY25 is seen at 23 to 31%. Deliveries are seen rising 28%. Adjusted EBITDA margin may come at minus 10% against 78% that company has reported in Q4 FY25. And auto gross margin may come in at 28 to 30% against 19.2%. Also, commentary that company has given that in FY26, it's expecting to achieve break-even in auto segment, and gross margin, company is saying that it might improve to 35% Q2 FY26. But on the basis of earnings today, you are seeing a big downtick in the stock price.
Take that point, Sudarshan. Thanks a lot for that. On the basis of earnings, there is a sharp downtick on the stock price despite what the management had to say. Watch out for BHEL and CESC and IEX. A lot of these, companies are actually selling off right now at the low point of trade for BHEL and CESC. IEX as well is at the low point of trade, but a big move is what we're seeing on Muthoot Finance. So just keep an eye out on that one. Opened relatively flattish. Thereafter, there was a bit of a spike, and from there itself, it zoomed ahead up nearly 6.5%. Let's see what's causing that and whether this sustains here or not. And the other one I'm looking at from the frontline pack is Eternal. Post the liquidity event getting over, the street watchers coming back to brass tacks, maybe growth returns, big cash is what we've seen, liquidity went behind the company. Can we see some green here or not?
That's going to be the interesting one. They did a QIP after all at around 252 rupees. So, domestic money that was interested, looks like they are getting into that one. A couple of stocks though, before we wrap up. Thomas Cook, you pull up the chart out there. That stock is spiking up. So good move is what you're seeing on Thomas Cook. Not just today, but all through the month, in the last 1 month or so. And also if you pull up Force Motors, that's the other one, bucking the trend. This week itself, big mover in the last 1 month as well. It's making fresh all-time highs. On that note, though, we'll wrap up on this edition of Chartbusters. Stay with us. Trading Hour comes up next.
Good morning. It's time for Trading Hour, the final time this week in a week that has been a week of consolidation. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormuz Patakia. With me today is Ekta Batra. Ekta, good morning. It's been a week that we've gone nowhere on the index, right? And even today, we are at the lowest point of the day. We are expecting an MSCI adjustment as well towards the end of the day. So there's a lot to track.
Hi, Hormuz. Yes, absolutely. And not to mention that, it is the fag end of the earnings season. So we have a lot of action which is happening in the broader markets in terms of specific stocks. But I just want to take you through the larger movement of the market on a week-to-date basis. Like Hormuz mentioned, it's been a week where we haven't seen much movement. So on a week-to-date basis, we have the Nifty, which is just about down by around 0.5%. We have the Midcap index, which is outperformed with a gain of around 1%. A lot of stocks in focus, and that seems to be the theme playing out. Bajaj Auto, top loser on the Nifty today. Apollo Hospitals, which is managing to hold on with a gain of around 0.5%. It does come out with its numbers today. So let's see what it reports, because it's going into its numbers relatively stronger. We have Suzlon, which reported numbers, and the stock, as you can see, has outperformed up around 10% Alchem Labs under pressure as its guidance is weaker than what the street had anticipated. So a lot taking place in the market in terms of specific stocks.
Earnings reactions, yes, and there are a lot of others as well, right? With the 9 new F&O entrants that we have in today's trading session as the start of the June series as well. Bharat Dynamics is one of them, and that is at a record high in today's session, the first day in the F&O as well. So 6% higher on Bharat Dynamics. Can't say the same for Mazagon Dock. Another first day in the F&O, but results were disappointing, although they met their FY25 guidance. But the fourth quarter results weighing on the stock price, 5% lower, is slight recovery from the lows that it had made at the start of the trading session. So Mazagon Dock is the other one that we need to track. We'll hear more from the management during the earnings call later this evening, so it'll be interesting to see what they have to say. The other positive earnings reaction, though, is Gujarat Pipavav Ports, and that is among the second top gainers on the Nifty 500 index. The numbers on a year-on-year basis were flat, but even after that, the stock is up almost around 8.5%. So good going for Gujarat Pipavav Ports in today's trading session. So these are some of the earnings reactions, but also on the other earnings side, we also have some other stock-specific movers, which is Muthoot Finance is one of them. That has now surged to the highs of the day, 6% higher on Muthoot Finance after the FinMin suggestions that came in on the gold loan lending guidelines. So good going for Muthoot Finance. And a lot of these other smaller pharma names, be it Aster DM, be it Wockhardt, be it Concord Biotech, all of them doing well for themselves in today's trading session, Ekta.
Yes, absolutely. You know, like I mentioned, Alchem was one particular stock which really stood out. The company is just about guided for high single-digit or overall revenue growth in FY26 and an EBITDA margin which would be flat in FY26. They've guided, however, for a pickup in FY27 to around double-digit growth. Wockhardt, there's been a turnaround which has taken place on the bottom line. You know, the losses are lesser on a year-on-year basis. A bit of a tongue twister there, and you know, it's a loss versus a profit Q-on-Q, but year-on-year it's a lesser loss. We have the margins which have come in at 9% again versus a negative EBITDA year-on-year. So that's the reason why you're seeing Wockhardt higher in today's trading session. That stock up around 5-odd%. Concord Bio also revenue up 35%, margins 44%, improved 200 basis points year-on-year, and a profit which is up around 48% as well. So overall, doing well for even Concord Biotech, and you know, it's looking good in terms of specific stocks at this point in time.
Yeah, some of the PSU names as well, right? A lot of these came out with results yesterday other than Mazagon Dock. But look at ITI, that's down in a 5% circuit. SJVN is down 5% after its results. NMDC Steel is down 4%. So it's not a very good day for the PSU names, at least. SJVN is now down to the lows of the day. NMDC Steel too. And ITI is another one that is locked in a 5% circuit. That too had seen a sharp up move earlier in the week. So on the other side, though, another PSU that's doing well after its results is Engineers India. It has a very strong operational performance during the quarter. So Engineers India is one of the PSUs that are bucking the trend. But the other one, though, and there's another pharma name that has not done very well for itself through the year, and that is Orchid Pharma. Ekta, what more do you have on that for us?
Well, you know, it's really underperformed post its Q4 numbers. The stock is down 20% this week at current reckoning. It's lost around 66% of its market cap this year. So it's been quite an underperformer for Orchid. Now, if you look at the numbers on a Q4 basis, the margins came in at around 11.8% versus 13.3% year-on-year and versus 12.1% Q-on-Q. So there's been a dip in terms of the margins year-on-year as well as Q-on-Q, and that was due to reasons such as higher cost on account of plant inspections as well as a drag in the antimicrobial solution segment that they have. Now, Nuvama looks at the company and they've said that the base business price pressure has led to a muted FY26 guidance. They face key challenges such as a delay in key projects such as the 7 ACA, and that would be a delay by 3 to 6 months according to them. They have an NCE royalty ambiguity, which is a new chemical entity. There's a royalty ambiguity on that aspect according to Nuvama, and the Dhanuka Labs merger is near completion, which may propel revenue according to them. So the value, the value of the base business according to them is at around 25 times FY27 PE versus 28 times earlier. They've cut the target price to 990 versus 1570, but they've maintained their buy call on Orchid Pharma. It's been a continuous downtick for Orchid Pharma. You know, in the past 7 odd trading sessions, maybe a chart of the past 7 trading sessions will give you a sense in terms of how the stock has performed.
Indeed, not good going for Orchid Pharma, one of the few pharma underperformers in today's trading session. So, and of course through the week as well, as Ekta was highlighting. But earnings reactions, we are counting down to the closure of this quarter's earnings season, and we continue our conversations with companies that reported results. Century Plyboards is one of them, a 13% revenue growth. Margins also contracted from last year. Its profitability was also under pressure. To discuss more on this, we're being joined by Keshav Bhajanka, the Executive Director at Century Plyboards. Keshav, good morning. Thank you for joining in. You know, if you could help us more with regards to the internals of the quarter with the plywoods business, the laminates business, the MDF business. How have all of them fared? How have realizations been? And what is the road ahead for these businesses this year?
Sure. Good morning. Thank you so much for having me on the show. I think that in an overall muted demand environment, we have done reasonably well. On the growth part, I think we have done better than what most people had expected, considering building material as a category is under tremendous pressure. If you look segment-wise, in plywood, we have had close to a 10% growth, which was as per guidance given by us for the quarter. For the year, growth has been even higher. If you look at the laminate segment, we are finally back to growth, even though growth has been negligible on a console level. Plywood margins have looked up. We have guided for 12 to 14%, and we have managed to overachieve that for the quarter. And for the year, we are well within the range that we had defined. Laminates margins are off, and we have invested substantially over the course of the last 2 years towards growth, but that growth has not come. Hopefully, in the current year, we are looking at a 20% plus growth. With that, there'll be recovery in margins to high single digits for the current year. MDF segment has performed reasonably well, given the overcapacity situation in the market. Standalone basis, we are close to 20% EBITDA margins. Console basis, we are close to 13.5% EBITDA margins. Particle board segment continues to suffer because of overcapacity in the market. And I think till we commission our new plant, which is likely to get commissioned by the end of this current quarter or early in the next quarter, we will face headwinds in the particle board segment. However, steady state margins in the new plant should be close to 15%. With capacity utilization ramping up towards the second half of the year, in particle board, we should be back at high single digit margins in H2. Overall, I think from a growth perspective, we are quite well placed, but the margin pressure remains.
Okay, all right. Margin pressure remains. It's a cautious outlook, Keshav, I would say, for FY26. Before we get to specific numbers for FY26, I just wanted you to just elaborate a little bit on the muted demand scenario that you started this conversation with. Tell us a little more about it. What is this muted demand? Which segments are you seeing it from? What is it as compared to last year? And what are you projecting?
Sure. I think, for the building material sector overall, the new launches that were supposed to hit the market post-COVID, and after COVID, there was a lot of, I would say, perhaps revenge buying, where all the unsold inventory was sold off in terms of houses that were available. The new supply, I think, is yet to hit the market, and you will see that as a reflection across most building material companies. So I think that as this supply starts hitting the market, perhaps towards the middle or the end of this year, we're going to see a revival in demand. Currently, there is a muted scenario. I think the high interest rates, which lead to higher EMIs, have also played into the same theme. But hopefully, by second half of this year, we will see a buoyancy in terms of building material demand overall. Category-wise, I think all our segments other than laminates have done well in terms of growth. Particle board, of course, the new investment will come on stream only towards the end of this quarter or the beginning of next quarter, and that will propel growth. But other than that, plywood and MDF have done reasonably well. And I think for the current year, our overall growth guidance of 15% on a console basis will be met.
What does that do to margins, Keshav? You mentioned that the demand outlook is pretty subdued. But in light of all of this, where do you see margins going in for FY26? You've managed to close the fourth quarter at 11.2%. Do you stay above double digits? Do you improve from this figure and go to, say, mid-teens? Where do you see margins this year?
I think we should see a definite uptick in margins without fail. Guidance or our objective will always be to work at 15% plus console, and I think by H2 we will reach that. Like I said, there are a lot of new capacities we have commissioned. For instance, the Budwell plant, which has MDF, which has laminate, which has PVC with close to 1,000 crore capex. So, it takes some time to scale up and to reach capacity utilization. Particle board, again, will be a lag for the current year, given that we are commissioning only in the first half of the year. So, I think towards the end of the year, we will definitely be at 15% plus. And going forward, we will be looking at higher margins for sure.
Since you mentioned it will take some time to scale up, when do you reach peak utilization for these new facilities that you have commissioned? And since you the particle board unit as well in Chennai, when do you reach peak utilization, and what are the kind of revenues that you're anticipating from them in FY26?
So as I've already said, MDF will be looking for close to 80% capacity utilization within the current year itself. We will be clocking 20% plus growth. For particle board, we should be at 50% capacity utilization for the new capacity towards H2. But reaching higher capacity utilization will definitely, or 70 to 80% will definitely take next year. Because again, we'll have to create the market, we'll have to ramp up. We are increasing capacity from 250 cubic meters to 800 cubic meter capacity. So that's a massive jump. But we'll definitely have 40% plus growth in the current year in particle board as well. And going forward, next year, we should be at a reasonably high capacity utilization.
Okay, reasonably high would mean what?
Next year, we will be looking at 75% plus for particle board.
And what would all of this do to price and pricing in your particular segments?
I think in terms of pricing, the oversupply scenario in the market is preventing a pass on of the raw material cost increase. However, having said that, we have worked on a lot of cost cutting initiatives. If you look at MDF on a standalone basis, 20% EBITDA margin has been primarily driven by a slight uptick in price, but a substantial saving in cost. And I think when times get difficult, it is when you work on cost, when you work on efficiency. So long term, it is going to be very beneficial. But pricing currently in the market, I don't see substantial increases because we are in an oversupply situation. Maybe towards the second half of the year, we would be in a position where price increases start.
Okay. Just a quick word on your debt figures.
So, debt, I think we are at peak debt already. Like I said, after the particle board plant commissioning, we have no substantial capex. We have a new plywood capacity that will cost anywhere between 100 and 150 crores. But we have no major capex plans. And from now, the debt repayment cycle starts. Hopefully, towards the end of FY27, we'll be back to zero long-term debt.
So by the end of FY27, you are expecting to be zero long-term debt, Keshav, right?
Yes.
All right. Okay. And what about your market share? What is it currently? Where do you anticipate that to go to, considering you have a slew of new capacities coming up?
I think market share, we need to see capacity by capacity. We need to look at different segments. So plywood, we are the market leaders and we have definitely gained in market share. As you can see, our growth is double-digit plus, whereas the industry, I think, would have been low single digits at best. Exact market share figures are difficult, but I think in all the segments we are operating in, we are going to rapidly increase our market share. MDF, with the industry growing at single digits, at mid 15-20%, at teen digits, we have grown at 40% plus. So again, we have taken market share. Particle board and laminates, yes, we have struggled, but these segments as well, I'm looking at higher market share gains over the course of the current year.
Okay, so just before we let you go, Keshav, let's just summarize what FY26 and FY27 is going to look like. FY26, you are looking for double-digit growth in terms of the revenue, but the margins are probably going to be pressured. FY27 probably is more of a year where things would look better on the P&L and the balance sheet. You're guiding to increased capacity utilization as well as lower debt. Is that how we would read it? FY27 would be a better year than FY26?
I think the way to look at it is that FY26 will definitely be a better year than FY25. FY25 was when the bulk of the new capacities came in, and FY27 definitely will be a much more profitable year with the new capacities having scaled up.
All right, Keshav, thank you so much for sparing time joining us today. Wish you good luck for the rest of the year as well. Management there of Century Plyboards, hoping that FY26 is a better year than FY25 and FY27 a better year than FY26. The stock, though, still at the lowest point of the day, 2.5% lower on that stock. Take a short break. All things commodities on the other side with Manisha Gupta. Welcome back. Time to focus on the commodity space. Manisha Gupta is now joining in to talk more about crude oil prices ahead of the all-important OPEC meeting, Manisha.
Oh, well, yes, and ahead of that, we are headed for a second weekly decline when it comes to the crude oil prices. One OPEC Plus ministerial meeting is already done, and they've kept the output untouched. But 31st May is going to be an important one because OPEC 8 Plus are meeting here, and they would perhaps decide on what really happens in sense of output for the month of July there. As of now, the street is anticipating an increase in production anywhere between 300 to 600,000 barrels per day there. Well, the markets also are reacting to the weak GDP numbers from US, the first contraction that we've seen in last 3 years. And add to that the US jobless claims as well, which also are the highest in many, many years. So a couple of factors which are weighing onto the prices. The other thing is about the US crude inventories, which have seen a decline that tells you that the summer demand season is looking slightly positive because we've seen a decline rather in oil and distillate inventories there. The markets also are reacting to the IEA statement, which has warned of weak demand going forward in case of China. Also, potential new US sanctions on Russia is yet another thing that seems to be weighing on to the markets. So we haven't been able to hold above that 65, 66 mark. Every time we see the crude prices going there, there is an immediate profit taking coming in, and that's exactly the case right now as well.
Okay, all right, Manisha. Thanks very much for that. We'll take a short break, but once we come back, we'll discuss market technicals. Mitesh Thakkar will be joining in. Welcome back. Well, for the markets, it's very quiet. We have the Nifty just about lower by around 67 odd points. It's the first day of a new series. We do have the Midcap index, which is down around 54 odd points as well. But just want to point out that Shalby is the one which is actually under pressure at this point in time. That particular hospital company reported numbers late last night, so is reacting to that. The revenue was at around 265 crores, so that wasn't the problem. It was lower year on year, but the margins have come down to around 8% versus 16% on a year-on-year basis and versus 12% sequentially. And they've expanded their losses sequentially to 11.8 crores versus 5.7 crores Q on Q and versus a profit on a year-on-year basis. In fact, this is the largest loss that they've recorded ever. They've never recorded a loss as big. They've never recorded a loss for multiple quarters. Past 2 quarters they have, and this is now even larger than the previous quarter. So on record, it would be a multi-quarter low in terms of the bottom line. So that's what's taking place on Shalby. That stock down around 3.5%. But there are several other stocks like that. Gujarat Pipavav, Shobha, Landmark Cars, Amara Raja, Welspun Living. They all are in focus on the back of their Q4 performance. Sudarshan is here to tell us more.
We'll start with companies which are reacting positively to their earnings for Q4 FY25. First on the list is Gujarat Pipavav, which has reported a steady set of earnings in this challenging environment. Revenue was at rupees 250 crore, almost flat. Even EBITDA was flat at rupees 157 crore. Company has managed to hold on to margin above 62%. It has come in at 62.3% against 62.6%. Second in the list is Sobha, which has reported a healthy Q4. Revenue was up 63%. EBITDA too has increased by more than 52%. And collections were higher by 21% and sales value has increased by 32% on a sequential basis. Now coming to the stocks which are reacting negatively to their earnings for Q4. First on the list is Landmark Cars. It has seen a healthy revenue growth, but margin has contracted. Revenue was up 26%. EBITDA too has increased. It's a minor increase of 2%, but margin has slipped by more than 120 basis points. Amara Raja, it was an operationally weak Q4. Profit was down 30%. Revenue has increased by 5%, but EBITDA has fallen 17%, and margin too has contracted by more than 300 basis points. Welspun Living continues to see a moderate growth. Revenue was up just 3%. Margin remains under pressure. It was down 200 basis points. Company has reported FY25 revenue growth of 9% against its guidance of 10 to 12%. Also, company has not given any guidance for FY26, and that's the reason there's a sharp downtick that we are seeing in Welspun Living as well.
A lot of soft earnings reactions. Sudarshan, thanks a lot for that. No guidance as well from the company for Welspun Living. So not good going for that. But there are some positive earnings reactions as well. By the way, since Ekta was highlighting Shalby, not only is the stock at the lowest point of the day, but it is also trading below its IPO price, which was 248 rupees. The IPO had come out in December of 2017, so it's trading below that level now. Currently at 189 is Shalby. But Mitesh Thakkar joins in for a quick chart check. Mitesh, good morning. Thank you for joining in. You mentioned in our previous interaction that you're expecting the index to grind lower towards 24,450, 24,400 levels. Do you still maintain that view, considering the fact that we are still managing to hold on to that 24,700 mark on the downside, and your stock recommendations as well?
Almost my view isn't negative. I'm saying that the markets will most likely consolidate between these range, and I think in the worst case scenario, one of these days it could test those levels on the downside. So I think it's a market which is just chopping around between the 600-point range, 24,500 to about 25,050, give and take a few points, and this consolidation might last for a few more days.
And your stocks, Mitesh?
I have a buy on Pidilite. I think that's a stock which is showing good traction. So buy here, stop at about 30.40 for targets of 31.40. And ONGC is a negative call on the sell side. Keep a stop at 245. Look for targets of 232.
All right, Mitesh, thank you so much for sparing time and joining us today. And we look to have you back later in the day. Take a short break. Up next, we get you market fundamentals with Nilesh Shetty of Quantum Advisors. Stay tuned. Welcome back. 65 points lower on the index, but Suzlon continues to go on its merry ways, 10% higher on that stock as well. And after a very strong fourth quarter result, of course. And Vivek is now joining in with the fine print of those numbers. Vivek.
Well, Hormal, like we discussed last evening, it's a very, very strong set from this time from Suzlon this time around. FY25 has been a stellar year as far as deliveries are concerned, especially for the newer range S144 wind turbines. Now, looking at the numbers themselves, revenue is higher on a year-on-year basis by over 73%. We are comparing Q4 of this year to Q4 of last year. EBITDA higher by 94%. EBITDA margins up 200 basis points at 18.4% versus 16.4% last time around. Profitability aided by a tax deferral gain of close to 600 crore, but despite that, profitability remained very healthy for Suzlon this particular quarter. Now, talking about the volumes, volumes in this particular quarter at close to 573 megawatt, up both on a year-on-year as well as on a sequential basis. FY25 order book quite healthy at 5.6 gigawatt, almost 12 to 18 months of visibility, especially from this particular order book, is what the company has indicated. More importantly, this particular order book of 5.6 gigawatt, 91% of this order book is from the newer range S144 wind turbine, which is contributing close to 91% of the order book, indicating that structurally Suzlon can now be able to enjoy higher margins. For the first time ever, the company has also given a guidance as far as the full year of FY26 is concerned. WTG volume deliveries, revenue, EBITDA, as well as profitability, all of it is expected to grow by 60% on the base of FY25. Along with that, the WTG segment contribution margin has been guided at 23%, along with the O&M margin, which is expected to be much higher. Suzlon is set for a structurally higher EBITDA margin band as well. No wonder then the street clearly likes it, up over 10%, and quite a few EPS upgrades too coming in, especially from brokerages today.
Okay, all right, Vivek, thanks for that. Well, we also spoke to the management. Listen in to what they had to say.
Obviously, for the first time in our history that we gave a guidance saying that in FY26, we will grow by 60% minimum across the board. So that is not just giving a guidance of a number, and we are able to give a guidance for the first time, shows that we are now well prepared as an organization to see the future.
The management of Suzlon, bullish commentary after strong results. To take this conversation forward, Nilesh Shetty from Quantum Advisors is now joining in. Nilesh, good morning. Thank you for joining in. I'm sure you heard the management of Suzlon speaking to us. Where are you placed in this entire power generation theme? You want to bet on these power generators or this equipment suppliers like Suzlon and Inox Wind, or you want to bet on the power financiers like REC and PFC? Where are you placed here?
Yeah, unfortunately, we don't have any allocation to this entire space. We used to have significant allocation to generators as well as transmission company. But again, these are regulated entities, especially on the generation side and the transmission side. And roughly they make about 15% ROE. And so now when they trade at 3 times, 4 times book, it's just for a value portfolio like ours, it's difficult to justify holding them. We've actually exited them a couple of years ago from our portfolio. I know there's a transition happening to the renewable side. So there is, especially on the grid supply or players exposed to supplying equipment to the grid, there is significant demand uptick there. But when you look at their valuations of 60 times, 70 times earnings, I think a lot of that is already discounted, and there is disappointment possibly ahead in terms of growth not catching up to valuation at the end of the day.
Okay. Nilesh, hi, welcome to the show. Mazagon Dock shipyard is reacting to its numbers and, F&O entrant as well. But separately, how would you approach the stock given, its defense play and that the stock is already outperformed, sitting at a gain of around 60% year to date?
Yeah, so again, we do not have any allegation to the defense space as such. I at least internally, the view is global defense spending will go up. India traditionally has grown, defense spending has grown in line with its normal GDP. So there is going to be one big buyer in India, the government of India, and its budget goes at a certain rate. And to assume these companies can go above that is not justified. We've not significantly seen a trend where defense spending outpaces GDP growth by a material number. So in that environment, if they go to match normal GDP growth rate, to give them the kind of valuations that they're getting, rivaling consumer staple companies, seems very unrealistic to us. So our sense is it's actually a very frothy environment for defense stocks. In this current environment, I know a lot of the money is flowing in, including a lot of sectoral funds which have been launched, which are putting money in the defense space. But once sanity prevails, I think people will realize these companies are extremely overvalued.
So where are you putting money to work, Nilesh, in a market like this, which is in slightly consolidation mode, having recovered from the lows? Where are the sectors that you are betting on right now?
So our largest allocation remains private sector banks. We continue to have a significant weightage there, where at least in terms of valuation, they're trading at far below the long-term averages. We have allocated to the insurance space as well, where we found selective stocks which came to our buy limit. We continue to have an allocation to IT services. I know there are near-term concerns on what can happen as discretionary spend slows down in the US. But if you have a sort of 3 to 5 year horizon, current valuations do make a lot of sense. Where we think there's margin of safety if you're a long-term allocator. So these are the large places where we have allocated.
Oh, okay. Just wanted to get a sense if you're looking at the entire banking space on IndusInd Bank.
Yeah, we hope there is a cleanup underway. See, it's a bank which has had historical problems as well. It was a darling of the market, but it went through a significant correction, especially after COVID, as issues on non-recognition of NPA in the microfinance book even erupted then. So, and exposure to certain groups, which eroded the confidence in the market. Our sense is, hopefully, what is happening right now drives a cleanup in the bank. And valuation again remain very, very attractive. So it is a portfolio stock for us. We continue to hold it. And you think there is especially after the cleanup, once things normalize, there could be sort of a value unlocking that will happen in the bank.
Now, what about a lot of these new listings, Nilesh? Ola Electric is one of them. Losses continue to widen, although the guidance remains optimistic, but delivery or execution remains the concern. There are brokerages that are guiding for targets as low as 30 rupees on the stock. Where do you see this going for Ola, and what do you think is the key trigger now for any reversal in sentiment for a stock like that?
So we continue to actually have allocation to the traditional ICE-based two-wheeler. We've reduced it as valuations became expensive. But again, distribution is such a big advantage in this space, and to create that overnight is not easy. And to be able to do after sales of all the two-wheelers in the market, which sort of helps build a brand, again, it's a long-term process. It's not an overnight process. Where some of the new players have jumped the gun and sort of flooded the market with the products, then realizing we have to service them as well. So we continue to believe that the existing players or incumbents have a big advantage, and our allocation continues to favor them over the newer players that are.
Okay, all right. Nilesh, also wanted your thoughts on a couple of these pharmaceuticals counters. You know, the CDMO plays, they all are in focus on the possible opportunity from, say, GLP-1 drugs. So how would you play, a company such as Syngene, as well as OneSource, as well as Cohance? Are they companies that you have in your portfolio?
Not the CDMO players. We continue to have the traditional generic players. So, there were selective opportunities which came up when there was significant pricing competition in the US. Valuations for these players came off. Then we added them to the portfolio. They have done well for us. They've valued a bit. Again, there are some concerns emerging now on what can happen under sort of the new president and his policies targeting the pharma sector. But again, we favored traditional IT generic companies exporting to the US. And again, it's been stock specific. It's not that we have a view on IT generics being a place to be invested in. It's selected stocks which came in at different points in time where we found valuation comfort. We allocated them. The entire CDMO space has always been very expensive for us.
But wouldn't you take, wouldn't a pure play generics company be a risk, considering that what could emerge when it comes to Trump and the tariff situation? And from that aspect, which are the other sectors which could probably be at risk?
Again, the assumption is there are alternatives to Indian generic suppliers. Do not believe there are. I think even whatever policies come through, I think there is no alternative available to Indian generic suppliers in the US. And I think if there are tariffs imposed, I think Indian manufacturers will find a way around it, by either passing on the cost or absorbing some of it. And some of them have already created manufacturing bases in the US. So our sense is that the discount and valuation that they're getting for the perceived risk may not be best at all.
All right, Nilesh, thank you so much for sparing time and joining us today. Look forward to having you more often on this platform. Take a short break. On the other side, we continue our conversations on the markets. But just before we do that, we are excited to unveil our brand new global business news channel, the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset and for the Global Lens at 8:30 p.m.
Welcome back. Well, for the markets, nothing more to incrementally talk about except for the fact that Apollo Hospitals is now your top gain on the Nifty, up around 0.5%. So watch out for that. And on a week-to-date basis, there are a couple of stocks which have done well. Adani Ports, IndusInd Bank has seen a bit of a comeback, so it's up around 3% close to it on a week-to-date basis. And L&T also, Larsen & Toubro, is up around 1.8%. Divi's also has picked up pace post its numbers especially, so that stock is up around 1.5% for the week. In terms of the broader markets, a couple of outperformers week to date. MMTC up 18.5%, IFCI up around 8% on a 21% on a week-to-date basis, and MMTC is up 35% this week. So that's what's taking place in terms of the markets. But let's focus on some specific news. The centre has allocated around 3,481 crores under the PM E-Drive scheme to deploy 11,000 electric buses across 5 cities of Bengaluru, Delhi, Hyderabad, Ahmedabad and Surat. Our colleague Abhimanyu spoke to the Heavy Industries Minister H.D. Kumaraswamy on this. Listen in.
PM E-Drive's third flagship program. Recently, we had a meeting. In the budget, they have allocated our finance ministry 10,800 crores. In that 3,481 crores for electric e-buses, we have actually allocated the amount. More than 14,000 buses we are going to distribute now. In first phase, we requested 9 cities, that is from Maharashtra, then West Bengal, Chennai, Ahmedabad, Surat, then Pune, Maharashtra, then that Karnataka and Telangana. Out of 9 cities, 5 city government machinery from Transport Ministry, they have approached us. Karnataka, they requested for 7,000 buses. Highest demand from Karnataka, they are requesting. Then Telangana also, they requested first 2,000, then they enhanced it to 2,800. Delhi, lastly, they approached, they are actually requesting for 2,800 buses. Surat, 1,000 buses they requested. 600 buses. Ahmedabad, 1,000 buses they requested. Out of this, Ahmedabad and Surat, 100% what they requested, we have decided to allocate all the demand. Then Telangana, we allotted 2,000 buses in the first phase. Karnataka, 4,500 buses in the first phase we allotted. We are still requesting West Bengal, Chennai and Maharashtra. But from West Bengal, personally also requested, advised Chief Minister West Bengal to send a proposal from them. But some judicial controversy from FAME 2 is going on. That is not settled. For that, Madam is little bit, after clearing that judicial thing, then only she decided. That is the reaction from West Bengal. Then Chennai, the Tamil Nadu government, they are actually getting some World Bank loan. On their own, they wanted to take the decision to allot the buses for the common man there actually. This is the issue. Another 3,800 buses we have to allot. What demand will come from other cities? We are waiting for that.
So what is the per bus subsidy which is going to be given and the total subsidy outlay from the ministry's side?
The subsidy issue we are working out. Now we have to call tender also. For that actually time guidelines we have put actually. After that only we will decide actually how much they will get. But 10 years this scheme will be in the process actually to get some subsidy.
So my final question to you, the initial plan was for 14,000 buses. Is there going to be a fresh allocation as well after the current announcement?
No, first phase actually the demand from the state. For that actually we have took the decision. Another remaining 3,800 buses, next demand from which state it will come, we will try to allot them. We are actually requesting West Bengal, Maharashtra. If they come actually we will consider their request also. Otherwise, even Karnataka, they are requesting some more buses. Even Telangana Chief Minister is requesting another 800 buses. For that actually second phase, the demand from other cities, if it comes, actually we have to allot them. If the allotment is actually, if any buses actually remain, we will going to alert the demand from other our present cities.
H.D. Kumaraswamy there in conversation with CNBC TV18. But one of the earnings reactions of the morning has been Ola Electric, and that continues to remain lower after a weak fourth quarter fine print. Sudarshan is now joining in to tell us more on that. Sudarshan.
So it's under pressure after reporting an operational weak Q4, but the outlook that company has given for Q1 FY26 is looking healthy. But talking first about Q4 FY25, losses have expanded both on a sequential basis as well as YOY. Losses for Q4 FY25 were at rupees 870 crore versus rupees 416 crore that company had reported in Q4 FY24. Revenue was down 62% and EBITDA losses increased to rupees almost 700 crore against loss of rupees 312 crore. Now coming to the outlook that company has given for Q1 FY26, it believes that adjusted revenue growth, that is revenue growth in Q1 FY26 against Q4 FY26, might be in the range of 23 to 31%. Deliveries can increase by 28%. Adjusted gross margin can increase to in the range of 28 to 30% from 19.2%. Auto EBITDA margin may be minus 10% against 78.6% that company has reported in Q4, and consolidated EBITDA margin may be minus 25% versus minus 101.4%. Also, it believes that gross margin may improve further, and in Q2 FY26, it may hit the level of 35%. Also, in FY26, company believes that its auto segment will turn EBITDA break even. So, outlook is healthy, but on the basis of Q4 FY25 earnings, you are seeing a sharp downtick in the stock price.
Still continuing to hold on to that 50 rupee mark though, Sudarshan. Thanks a lot for that. But stay on because Bajaj Auto is also in focus after its fourth quarter results. Tell us more on that.
Bajaj Auto, as far as earnings for Q4 FY25 are concerned, earnings looked very steady. Company has managed to hold on to margin of 20% for the sixth straight quarter. Even revenue that it saw double-digit growth in few segments like commercial vehicle, electric two-wheelers and premium motorcycles. But due to temporary suspension of KTM exports, Q4 FY25 revenue growth has come just at 6%, but it was above estimates. Also, profit was above estimates. Margin too has come at 20.2% against our estimate of 20.1%. And also, good parties realization was higher against the estimate. It has increased 2% year on year, and also on a sequential basis, it was up 5%. Talking about the outlook, company is saying that domestic industry growth for FY26 is seen in the range of 5 to 6%, almost at the same level that industry had grown in FY25, but positive part for Bajaj Auto is in 125cc plus segment. That is the focus area for the company, where it's saying that industry is likely to grow in the range of 8 to 12%, but company believes that it will outperform the industry. But one more thing that will be in focus is saying that rare earth magnet supply from China, because it's a concern, and if there is any disruption in the supply, it will disturb the output from the month of July, and that's one of the main reasons that stock is under pressure today.
Okay, all right. Thanks for that, Sudarshan. So that's on Bajaj Auto. That's one of the top losers on the Nifty. But defense shipbuilder Mazagon Dock also reported weak numbers in its fourth quarter earnings. Ria's here with the fine print.
Well, yes, Mazagon Dock has reported a very weak set of numbers in quarter 4, although the full year performance has remained healthy this time around. Coming to the Q4 numbers first, profitability has been sharply lower this time around. EBITDA and net profit have fallen by 83% and 51% respectively, both on a year-on-year basis. EBITDA margins have also contracted by over 1400 basis points on a year-on-year basis this time around. They've come in at just 2.8% versus 17% that we saw in Q4 last year. Even on a sequential basis, margins have declined by around 2300 basis points. The profitability has been impacted this time around by significantly higher expenses. The subcontracting expenses have gone up by over 9 times on a year-on-year basis. Even some other project-related expenses have gone up by around 4 times, and provisions have also gone up by around 5.6 times compared to Q4 of last year. Now, in the earnings call for quarter 3, the company had said that these provisions have been created with regard to excess inventories from ships with expired warranties, and while the components are still in good shape, shape and may be used for future projects, the provisions will be reversed upon utilization. Now, coming to the full year performance, that has remained quite healthy. Revenue has gone up by around 21% on a year-on-year basis, above the guidance of the company of around 10 to 12% growth. EBITDA margins have also come in at 18%, showing a growth of around 300 basis points compared to the previous year, again above the company's guidance of 12 to 15% margins. Now, the total order book, that stands at about rupees 34,780 odd crores at the end of Q3, so that remains quite healthy. And the company also has some other huge orders on the anvil for the next 1 to 2 years, which include the Kalvari class submarines, the P-75I submarines, as well as the next-gen corvettes. So that is something to be watching out for. And today, of course, we will be watching out for further management commentary in the earnings call post-market hours.
Yes, most awaited. Ria, thanks a lot for that. Snapping a 7-day gaining streak. Mazagon Dock ending at a record high in yesterday's trading session. So now seeing some bit of profit booking. Of course, the first day in the F&O segment as well. Take a short break. But just before we do that, here's some good news for our viewers. India's business news leader is now just a click away. And that, of course, is that CNBC-TV18 all-new app where you get breaking news updates, in-depth articles and financial world stories, all of them at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that's up on your screen. Take a short break. Back on the other side. Well, still looking to end the week on a dull note. The Nifty Bank, though, has recovered slightly from the lows of the day. It's almost now about to move into the green is the Nifty Bank, and that is showing up on the Nifty as well. Still 75 points lower, still holding on to that 24,750 mark. And there are plenty of stock-specific reactions. Gujarat Pipavav is now at the highest point of the day. 10% higher now on that stock, the top gainer on the Nifty 500. With that, we call time on this edition of Trading Hour. From Ektami and the team that put this show together, thank you so much for watching. Halftime report for the next 60 minutes.
Stocks trade soft after a U.S. appeals court stays ban on Trump's tariffs. A stalling of U.S.-China trade talks doesn't help matters. Metals, utilities and retail are big losers, even as industrials manage some gains.
Bajaj Auto drives in a steady Q4 with healthy margins, remains confident of healthy domestic and export growth in FY26. Stock, though, is down 2.5%. Ola Electric's losses climb as sales dive.
Suzlon powers up on reporting a big jump in revenue and profit, guiding for 60% growth in FY26. But Mazagon Dock ends the year on a weak note as muted revenue growth and a spike in costs hurts profits.
The early arrival of monsoon may be net positive for the Kharif crop, while data shows that above-average quantum of rains usually results in higher output. Ramesh Chand, Niti Aayog member, tells CNBC-TV18, adds that FY25 agri growth may be 4%, and this year can be as robust.
The Finance Ministry has advised RBI to ensure that small borrowers with gold loans of under 2 lakh rupees not affected by the proposed norms. The exclusion of such loans will benefit gold loan NBFCs.
Hello and welcome to Halftime Report. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar and with me is Mangalam Malu. Mangalam, a quiet Friday, right? Almost seems like it's waiting for the weekend.
It is waiting for the weekend. If you look at yesterday, the last hour spike that we saw on account of expiry may have normalized right now. The good part, however, is that on day one of the series, the markets moved off lows, and that becomes an important reference point to watch out for every time you start a new series. Though June actually is a bit of a bridge month, if you've noticed, X of any sort of, events, like last June had the interim budget, the first budget of the new government. June has been 2 to 3% sort of moves on either side because it's post-May, post the earning season rush, etc. And then before the next earning season begins, June is the bridge month.
That's in July. That's like just a month away now.
So which is why the market's just biding time. The big cues this time around would probably be the RBI policy meet and all that takes place.
Today we've got the GDP print.
Yes.
So that will be tracked very closely. And globally, from a US point of view, we've got the weekly jobless claims, the PCE, the core inflation data that the Fed tracks very closely. But it's good to see the mid and small caps outperforming to some extent. I think that Midcap chart will show you there has been a recovery from the lows. And this week, while the Nifty and the Sensex are down close to about 0.4%, the Midcap index is up a little more than 1%, 1.3% week-to-date gains, while the small cap index has a 1.8% week-to-date gain. So it's good to see that outperformance.
It's good to see that. And one of those stocks right now is Muthoot Finance. It's an up move nearly 7%. Manappuram Finance also over the last half an hour or so has seen a big spike. So just pull up the intraday chart of Manappuram Finance. You'll see that the stock has made a recovery from the lows, though not in the quantum of Muthoot Finance. And that's largely because the Finance Ministry has told the RBI to ensure interest of small gold loan borrowers are not impacted by the new draft guidelines. Remember, these stocks had taken a bit of a knock once those draft guidelines had come in. Sapna now joins in with more details on what has transpired out there. And is that, in turn, causing this relief rally on these names? Sapna.
Hi, yes. So this matter has been in the discussion, as you can see from the statement of the Finance Ministry. The decision has been taken to forward this feedback or rather this pushback right at the Finance Minister's level. The discussions have happened at her level. And post that, this feedback has gone to the RBI. So I think on two accounts, the government is very clear that the interest of the small gold loan borrowers should not be adversely impacted. Here they have also suggested that, maybe up to a ticket size of around 2 lakh rupees. I mean, such borrowers should be actually excluded from any kind of directions that RBI comes out in the future. And second, more time will be needed to implement or rather roll out the guidelines. So the suggestion is that they should be pushed back at least to June 2026, nothing before that. So on both these accounts, the government is very clear. I just wanted to highlight that, this after a long time, basically, the government has actually shared these kind of internal deliberations. They have put it out in the public domain. So it's noteworthy that it is an important issue from the government's perspective, and they want to ensure that the interest of the small borrowers and maybe to an extent even the companies is kind of protected. They're not adversely impacted.
Got that. Thank you very much for that important story. Let's now straight away take it to the first corporate on the show, Lemon Tree. The company reported a steady Q4, revenue surging 15.5%. Occupancy has improved on a year-on-year basis, and the total debt of the company has declined by 10% on a year-on-year basis. Patanjali Govind Keswani, Chairman and Managing Director of the company, is now with us on the show. Thank you very much, sir, for joining in. If you could give us an indication of how Q1 has been so far in terms of occupancy and the outlook that you have for the rest of the year in terms of ARR and occupancy. Do you think you can push it higher compared to last year?
Hi, Rima. I think certainly we will have higher occupancy in Q1 this year than last year, because last year in our hotel in Bombay, which is 15% of our inventory, was relatively new, and this year it has stabilized, which is the Aurika.
Right.
I think April, in and of itself, was a fabulous month. In May, two things occurred. One was this war, and one was this rise in cases of COVID. So that affected demand. But if I looked at it in the aggregate, I would say we would do about 15% better in revenue terms in this quarter vis-a-vis last year.
The entire year, what would your target be? Because last year was incredible. If you look at the entire year, you've done 20% revenue growth. Your margins have maintained that 50% mark as well. So first quarter notwithstanding, 15% for the remainder of this year. What's the guidance that you're giving?
It would be roughly mid-teens. So, guidance in the hotel business is like shooting in the dark.
True.
Because, sudden events can very significantly affect demand. So if I gave you a range, it would be, mid-teens plus minus 2%.
Truth be told, in the VUCA world that we're in, guidance in any sector would perhaps be shooting in the dark, but, a little more for the hospitality space itself. In terms of capacity addition, that's where you have visibility. What's the kind of addition that you've lined up for in FY26 and FY27? And how much will occupancy scale up basis those additions?
Occupancy is a percentage. So
Yes.
I assume you're talking in terms of units or room nights.
No, I'm talking about room nights getting added, plus your occupancy in those room nights scaling up.
So Mangalam, it's very simple. We had given guidance 2 years ago that in 5 years we would hit 20,000 rooms.
Yes.
But I think we'll cross it this year, number one. Number two is, so we will give a fresh plan for 2030 because we are meeting all the set targets actually a year or two before we said we would. Number two is that we are already at, I think, 17,200 rooms. So we just need to add 2,800, which will certainly happen this year. Our occupancy is a sum of mature hotels and new hotels. It is the weighted average. So a new hotel naturally takes more time to scale up.
Yeah.
So when you aggressively add new hotels, the occupancy of those hotels is always much less and brings the weighted average down.
Exactly.
That happened to us, for example, with Aurika and Bombay. So this year, I think our total occupancy was a touch under 72%. I'm pretty sure we'll do better than that this year. And my broad expectation is, based on how I see, change in consumer behavior, an inclination by a larger number of consumers for branded hotels, my broad guess is that Lemon Tree's occupancy will be 76 to 78%. 12 months forward. So that's how I'm looking at it. We will cross 20,000 rooms and we will be selling, something like 16,000 rooms on a steady basis at that level of control over supply.
And just for bookkeeping, typically for a new hotel, what's the break-even occupancy?
Well, if we design it and build it, on an OPEX basis, it would be 21 to 23%. If you add debt, which is, I'm assuming that you have leveraged carefully and, you have loan to value is 50%, then typically you can pay your interest by about 35%, and you can pay your principal by 45%. So as long as we hit 50% occupancy, we basically pay for everything. And after that, it's to the bottom line.
Since you're going to overshoot the capacity addition target of 20,000, what about on the debt front? You had guided to be debt-free by FY28. You lowered your debt by 10% last year. By FY26 end, what will the debt number stand at, and FY27 end?
I don't think it'll be, I think it'll drop by another 20%. But if we, as we said, most of our debt is in our joint venture, which we own 60% of, where the earnings growth has been quite significant. So best guess is we will definitely meet that timeline. But if we list Fleur, then we'll go debt-free, at that time. So debt-free 100% in 3 years. If we list Fleur before that, we'll be debt-free before that. And end of this year, we'll be, if we don't list Fleur, we'll be another 20% down.
Your ARR is about 7,042. In Q4, it went up by 7%. What's the outlook on the average room rent?
See, our room rents, we expect, see, when I say we'll grow 15% in revenue, my broad guess is that 1/3 of that will be by occupancy. So say 72 will become 75. And another 2/3 of that will be by rate increase, which is a good sign, by the way, because rate increase goes straight to your bottom line. Occupancy increase has some implied variable cost.
So, speaking about straight to your bottom line, the other thing that goes straight to your bottom line is management fees. You did about, 45 crores in the fourth quarter. What is the quarterly run rate likely to be? And by when do you reach that 300-350 crore annual management fee target?
We'll reach it in 2 years, for sure.
Okay.
But I can't give you an annual or a quarter. It's so much a function, Mangalam, of the hotel opening on time. So if we have a plan that, we'll open 10 hotels in this half year, and only 6 open and another 4 get pushed forward to the next half year, then it changes these numbers. I would look at run rate. So what I'm saying is our run rate by end of next year should be 25 crores a month.
Is supply becoming a problem? Because now everyone's looking at hospitality as a big, tailwind sector for the next 10 years or so, where the macros are favoring the overall sector. For so many players coming in, so many properties, is real estate supply and the cost of acquiring a new hotel increasing?
In fact, that's the good news, because if you put supply up at current costs, what it means is that it makes money at current costs. And what about the guys who have hotels on book value? So in that sense, an incumbent who has an existing hotel, has a much lower investment cost than somebody who's opened a hotel in that same location now. So typically the construction cost doubles every 7 years, 7, 8, 9 years, depending. So if I put up a hotel 10 years ago and I'm getting and somebody puts up a hotel today and gets a 12% return, then our hotel will get a 24% return because its book value or its cost of construction was, half of the the later guy. So I believe that supply is very necessary in India for 2 reasons. One is for consolidation rather than fragmentation. Number 2, for quality. Number 3, for competitiveness. And most importantly, I believe supply creates demand. So the more supply you create in the hotel sector, the more demand you create, basically.
Mr. Keswani, just mathematically, if 2/3 of your revenue comes in from an increase in the cost of a hotel room, what would that number stand at, the ARR, by the end of FY26? And are we in for, Mangla was just talking about how the industry itself has structural tailwinds. Do you think the ARR can keep compounding at that, growth rate?
I'm actually... Rima, I keep saying this, our current room rate is 20% less than what it was, 17 years ago. On an absolute rupee basis, forget inflation. So the good news for the hotel sectors, I expect room rates will continue accelerating, and they will accelerate to a point when it will be closer to the mean, which is the global mean. Number 2, as you know, pricing is a function of supply and demand. So no new supply will come up if the price is not right to give a return to that new supply. So why would I put up a hotel for, say, 250 crores to get a return of 10 crores? but that is what an old hotel may be generating today. So this is self-balancing. And I am pretty sure prices, I keep saying this, nobody believes me, but I'm pretty sure prices will be double in 3 years.
You had said that last year as well, and you said that the year before that as well, and it's been the case. So 3 years ago, what the prices were versus what the prices are right now, it has almost doubled, if not doubled. Just a final question. You earlier also pointed out the possibility of the demerger of, assets and brands, because that's how globally the business is structured. What's the update for Lemon Tree on that? Have you considered anything in the very near future?
No, we will, as these are various routes to getting, de-aggregating or disaggregating the management asset-light business from the asset-heavy ownership business. It is very much one of the options we will consider, but our view is that we will list Fleur in some form or the other, and that is the asset-heavy side of our business. So sure, it is what you just mentioned, Mangalam, is one of those.
Thank you, Mr. Keswani, for joining in. Always a pleasure chatting with you about the company and the industry. We wish you all the best. Well, get into breaks, but we are very, very excited to unveil a brand new global business news channel, the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime every day at 12 noon for the Global Reset and the Global Lens at 8:30 p.m.
Welcome back. A big move is what we're seeing in Manappuram Finance right now. It's up 4%. We spoke about Muthoot earlier and the possibility of some sort of relief coming in for gold loan borrowers under 2 lakh rupees. Manappuram Finance is a late mover to that party, but is moving quite ferociously as well. HDFC Life is the other one. This week, it hit a fresh life high after 3 years and continues its up move. This week's gain on that stock is close to around 5%. And we're also seeing some sell-off in Vodafone Idea, which continues. Currently down about 4% from the highs at the low point of trade itself. But L&T, that's the stock on our radar, and that's because of a case update that has come in, a relief for L&T in the Mumbai Metro case. Ashmit joins in with all the details here. Ashmit.
Well, this is a major relief that has come in for L&T. Bear in mind that L&T had challenged in the Supreme Court an issue of a tender that had been issued by the MMRDA. The tender had been issued for essentially two projects in Maharashtra. One was an elevated road from Fountain Hotel Junction at Thane, Godbandar Road to Bhayandar. The other one was an underground road from Gaimukh to Fountain Hotel Junction. Now, what's important to understand is that this tender aggregates to about 14,000 crore rupees. L&T at the technical stage itself had been disqualified, and that is what they had contested in courts. Now, what's important is that while this was contested, the Supreme Court had made some very stern observations, had essentially questioned as to how this entire tender process had gone about, had questioned L&T's disqualification, had at one point also remarking that L&T, which is responsible for constructing Delhi's Central Vista project, how could such an entity, how could such a party have been disqualified? There were very pointed remarks that had fallen from the apex court in view of L&T's contention, L&T's disqualification, and that is what we understand has now led to a decision by the MMRDA where they've said that on account of all these concerns they're scrapping this entire 14,000 crore rupee tender altogether. So this entire concern that had been raised by L&T yielding returns in the form of scrapping of this contract. Now, as far as the road ahead is concerned, MMRDA says that the future course of action is to be decided by the Maharashtra government. So for now, major relief coming in. That big contract, that 14,000 crore rupee contract that L&T was on the cusp of losing now stands scrapped. The future course of action to be decided by the Maharashtra government.
Take that point entirely, Ashmit, and take note of the pointed questions as well. Someone that's designed the Central Vista project, how can that be, taken out on technical grounds for a metro case itself? Speaking about construction, the next company on our show is NCC. They reported a decent fourth quarter where order inflows have gone up by 20.5%. Profit after tax has also increased by 11%. But on an overall year basis, the execution has been slightly on the slower side. The revenues for FY25 rather have been around 6.5% higher itself. The stock slightly under pressure right now. We have Neeraj Sharma who's joining in. Neeraj, thank you for joining in. Just on FY26 guidance, the order inflow was strong in the fourth quarter. Execution of just 10% growth, that comes on a favorable base. I mean, how can you get better on the revenue front and even the margins? By when do they get to double digit? I think you're on mute. You'll have to unmute yourself.
No, I'm.
Yeah, go ahead. We can hear you now.
Yeah. So the point that I was trying to make was, firstly, let me give you a little overbrief of the last year, that is FY25. We had shared three set of numbers with the street. The first number was, the order inflow guidance. We have been able to handsomely achieve the guidance that we had shared with the street. You have yourself, just quoted the numbers. The revised guidance that we had shared for the revenue was, revenue growth of about 5% that we have been able to deliver. On the margin guidance, also the guidance that we had shared on the EBITDA, we have hit the number. Now talking about FY26, this last year, that is FY25, was, an unusual year in more ways than one. Firstly, this was not a year of 12 months, typically speaking. The point that I'm trying to make is as follows. We have the bulk of the projects that we have been able to bag has just come in the Q4. If you talk about the first 9 months of the FY25, all that we had bagged was, about 13,000 odd projects. The 60% of the total award that we have bagged in FY25, which is 32,888 crore, has really come in the last quarter. That too, in the last month of the FY25, that is March. It takes time, for these projects, to mobilize, to get all the ROWs in place, for the construction to start. It takes time. There is a time. Even when we start the construction, there would be, recognition criteria, milestone guidance, for recognition of the revenue as well as profits. So and the monsoons are right around the corner. So that is the reason, we have decided to share a guidance on the basis of the assessment, the best assessment that is available to us. And that is the reason we are talking about revenue growth of 10%, which we believe is a good guidance. And I also take this opportunity to share with you the fact that if you really see the growth of the company in last 3 years, we have been able to deliver a CAGR upwards, close to 25, 26%. So that's the base itself is a, little bit on the higher side.
Right. Okay. And on the margins, 8.64% is what you've done. 9 to 9.25 is what you've guided for. Double digit happens when?
That's right. Yeah. I mean, hopefully in the next year, that is FY27. But we have to see. We have to also look, at the net profit. In the last FY25, we have been able to deliver, a PAT growth of 20%, which is a good profit number. So let us not only look at the EBITDA margin, let us also look at the net profit number.
Okay. Got that. So revenue guidance 10%, EBITDA margins 9 to 9.25%. Order intake, I think, is 22 to 25,000 crore rupees, right? That's the guidance.
That's right.
Okay. How much of that is already L1 of this order inflow guidance?
The L1 number would be, anywhere between 7 to 8,000 crore. And if we really take into account the order that we have bagged in the month of April, which is 1,663 crores. So we have already, let us say, achieved about 8% of the lower band, that we have shared with the street.
Okay. And this, Amravati, the capital city project of Andhra Pradesh, lots of hopes have pinned on that. In Q4, did you win any orders linked to Amravati? And of your order inflow guidance of 22 to 25,000, how much of that is linked to the Amravati development?
See, most of the, we have been able to bag good number of projects for this new capital city, that is Amravati. This number would be about, 9 to 10,000 crore.
Is what you've already bagged?
That's right. In the last quarter.
And how much of the order inflow guidance for FY26 would be from Amravati?
We have to wait and watch. It would really depend on what kind of projects really do come up for bidding. Then, we will assess those projects and then take a decision whether to bid or not. But happy to report that we have been able to, corner a sizable chunk of the awards already, which is a little less than 10,000 crore.
Could you give us a sense on what your bid pipeline for the year is? You are 7 to 8,000 crore L1. How many other orders are you bidding for? What's that pipeline like, and what your hit ratio typically is?
The prospective pipeline would be, more than 2.5 lakh crore for the FY26.
And your hit ratio is, I suppose, 10% because you're guiding for 25,000 crore worth inflows.
Approximately, it keeps changing. It would really depend on the competitive intensity in a particular vertical, what kind of projects are coming up for bidding, the size of the project.
On execution, I wanted to know if there are some working capital challenges, because yesterday we did have a management join us saying that, the Jal Jeevan Mission receivables haven't been haven't been given by the government, released by the government so far. Do you have any exposure to Jal Jeevan Mission or any other authorities from the government where execution has been a little challenging because of the late release of payments?
Yeah, we do have some exposure,
How much would that be?
From this mission called Jal Jeevan Mission. We have been able to get some payment, in the month of April, and we are hopeful. I think that problem is across, across board for the whole, scheme as such. But we are hopeful. We are hopeful of, getting the balance payment. But let me take this opportunity also to share with you, there have been challenges. There have been challenges related to payment for the FY25, not only for, this scheme, few other schemes as well.
So how much would your amount be receivable right now, which is overdue beyond the normal course of payment?
I mean, that you're talking about the data number we have already shared, it would be close to
No, that's the total data number, but stuff which is overdue. Like you said, there have been some challenges in a lot of them. So say, for instance, your average data number is 30, 40, 45 days, or average terms are that. What proportion of that number is overdue right now?
That is difficult to quantify, Mangalam. See, we do about 150, 160 odd projects. It would be difficult to quantify.
Okay. What's the expected revenue from smart meter projects in FY26 and the kind of order booking? You've made an investment of 280 crore rupees, I believe, in smart metering, and you're hoping to get in a partner.
That's right.
And
Firstly,
the revenue go ahead. Revenue forecast.
Yeah. Firstly, we have not made. We plan to make in the FY25. We have made an investment, about in the range of 70 crore for these smart meter projects. And we have planned to make, this kind of investment anywhere between 250 to 300 crore for the FY26, depending on the progress that we are able to make. This would be, and we are also, scouting for a partner, but this would really depend on the progress that we are able to achieve on these smart meter projects. I also take this opportunity to share with you that we have 3 smart meter projects. The total value of the project would be little more than 8,000 crore.
All right. Okay, take that point. Thank you so much for joining in, Nirad, and giving us your views for FY26 and putting on board the challenges that the industry is facing as well. But wish you good luck for the execution that you have for this year. 10% revenue growth guidance with 9 to 9.25% EBITDA with 22 to 25,000 crore worth order wins this year. That's NCC. Take a short break, come back. Ajit Mishra of Religare Broking joins in with some trading strategies. Stay with us. Welcome back. The market down about 100 points for the Nifty. Just keeping an eye out on the F&O space. And this one, apart from how the market is behaving right now, the important part is we're seeing traction in names like BSC, Angel One and Nuvama Wealth. This at the start of June series, also because yesterday evening we had a circular coming in from SEBI on F&O. Two things really stand out from that. One, they've said that open interest will now be measured basis delta and not notional open interest. Remember, delta of options is a lot lower than futures. So basis that, the open interest for total F&O contracts will be measured. And the second part is that market-wide position limit will either be 15% of free float market cap or 65 times average cash volume, whichever is lower. What this basically means is that delta-based OI and delivery-based market-wide position limit will reduce potential manipulation. You've heard of, way out of the money options being used to put stocks into F&O ban, etc. These norms, which come into effect from October 1, will, reduce these potential manipulations. What is also good is that there has been no intraday limit as earlier proposed in the consultation paper. So the actual norms aren't as drastic as were issued earlier in Jan-Feb itself. And end-of-day gross limit proposed at 1,500 crores in the consultation paper is actually now set much higher at 10,000 crore. So a lot better for all the participants, and that explains why these stocks, which I earlier mentioned, are doing well. For the Nifty itself, start of June series has been on a bit of a back foot, but we'll track today's low and potential recovery from here on itself. 24,800 call and 24,800 put, both equally active, telling you that those who are writing the 24,800 straddle are playing for a broader range of 24,600 at the lower level to 25,000 at the upper level for the index for the next week. Birlasoft seen a big spike in open interest, may enter F&O ban, so we'll keep an eye out on that. Take a short break now. Ajit Mishra joins in.
Welcome back. Let's now talk market technicals. Ajit Mishra from Religare Broking is now with us. Ajit, thank you very much for joining in. Muted day, what would the stock calls be?
Yeah, good afternoon. So since we are seeing consolidation continuing for almost 2 weeks now, it's prudent that until we see a decisive break in the index to maintain position on the both side. So first stock that we like on the buy side is SBI Card. So if you'll see almost a 1 month long consolidation seems like to be over in a day or two. With a positive breakout, and 957 is what we are eyeing in SBI Card with stop at 900. On the short side, Asian Paints, after this failed attempt of recovery, we are seeing again a shorting pivot formation on the daily chart, which may push this stock towards 2190 in the near future. So here one can go short with 2310 as a stop loss.
All right, take that point, Ajit. Thank you so much for joining in. Those are a couple of stocks that he's spoken about. One of the stocks which is doing well today is Senco Gold. So what we'll do is take a short break, come back. Suvankar Sen, who's the MD and CEO at Senco Gold, joins in to discuss their fourth quarter performance and more importantly, the outlook for FY26. Stay with us. Welcome back. You're watching us here on Halftime Report. Senco Gold is the stock on our radar. Reported a very good set of numbers in the fourth quarter, especially after the previous 3 quarters where there was a sharp margin contraction. And as guided by the management earlier itself that they would see margin recovery in the fourth quarter, that's exactly what has happened. The stock up 1% right now because over the last 3 months or so, it has seen a big rally, though still 50% off its 52-week high. We have Suvankar Sen joining in. Suvankar, let's start with your outlook for FY26 because the first quarter you had given an outlook of 18% revenue growth because of the Poila Boishakh as well as Akshay Tritiya sales that you saw already. Do you stand by 18%? Do you think you can better that? And for the full year, what's your margin and revenue growth outlook?
So if you look at the previous year's full performance, in terms of revenue, we've grown by 19.7%. And if you look at the way the numbers have been looking in the month of April and May, we are growing in the range of 18 to 19%. So while our efforts and endeavor will be to take it closer to 20%, but I will stand by the growth, revenue growth of 18 to 20%. And until now, I think that we are clocking those numbers.
And for margins, what are you talking about? Because you had said 8 to 9% earlier. You recovered that in the fourth quarter. Do you think this run rate now sustains for the next few quarters?
So see, we have to understand that why were the margins looking low in the previous financial year? And time and again, we said that the impact of customs duty in the month of August was the one which was impacting the overall margins. And we were confident that in the Q4, where we could see that, the diamond selling trend had picked up. The duty impact was done and away with, so that wouldn't be there in Q4. So that is how we saw that the recovery happening in Q4. And I think that we can continuously see that interest in diamond jewelry, especially with the gold prices being towards the all-time high. So while the confidence and the trust on gold as a commodity continues to remain in the mind of the consumers, but they are also looking for lower cost, options, which is in 14 and 18 karat jewelry with diamonds studded in it. So the diamond sales are continuously in an upward trend right now. So yes, in terms of margin, if I look at it, the EBITDA levels, adjusted EBITDA of the previous financial year was around 6.5, 6.8%. So that my 6.8 to 7.2 is the EBITDA levels that we will be looking at for the whole financial year.
Okay. So diamond growth was very strong, 39% in Q4, and I believe it's about 11% of your overall revenues. Now with consumers perhaps moving towards or being a little more aggressive on diamonds, what could the revenue contribution of diamonds go up to? What would the growth be? Can it sustain the Q4 run rate, for instance?
On a sustainable basis with the various seasons that we see, we are expecting a growth of close to 20 to 25% because the diamond growth in such a situation and a scenario is usually higher than a gold growth. It is just that the gold prices have been on an all-time high. It has moved up so much. That's why we are seeing a value growth of almost 20% and a diamond growth of, say, 35% in the current ongoing scenario. So I think that, yes, a 25 to 30% is going to be our effort. And if the gold prices continue to remain on such high levels, consumers will be looking at buying more of diamond jewelry. However, the catch point here is that Q1 is one of the festive season. Q2 is one of those seasons when we usually don't see much of buying happening. We all have to look and pray for a good monsoon so that the upcoming festive season of Q3, the wedding seasons, and the Q4, that should be strong. So Q2, we will not see as much as that kind of number. But again, Q3 and Q4, we will see a good pickup in terms of diamond and in terms of overall jewelry industry also.
Yeah. Just to confirm, 6.8 to 7.2% is the margin guidance that you've given for this year.
EBITDA margin, yes.
Yes. Okay. On gold prices and diamonds and how consumer behavior is likely to be is what my question was on right now. Because yes, gold prices are making record highs consistently. So consumers are reducing the volume purchase and because the value purchase is increasing. And secondly, they're looking at alternatives. But diamond, while you're buying jewelry for adornment, you're also buying it as an investment value. Diamond hasn't proven to be a good investment over the last many years. And with the lab-grown diamonds coming in, etc. as well, that the attractiveness of diamonds as an investment proposition has come down even further. So do you think that consumers will now buy plain gold things like coins, etc., going forward as against jewelry for adornment, which may not be as high value? I mean, just wanting to understand what consumer behavior at high gold prices is, because we've also seen your gold exchange, old gold exchange, come up to 39%.
Yes, old gold exchange has come up to 39%. And what we are seeing is almost 60% of that is the non-Senco Gold that is coming in, which means that, like we have been seeing in the last 3 years, the shift from unorganized to organized is happening at these high gold price level also. And as far as the investment outlook of a consumer towards gold versus diamonds is, see, we need to understand two things. One is that it is only solitaires which has always been looked up as a investment for diamonds. Small size diamond, which is almost 90% of the business that we do, has been looked at more as an adornment, as beauty, as a symbol of romance for the daily wear or for weddings and all of that. It is only in the bigger size that the diamonds have looked as investment. So what we are seeing is that the consumers who were investing in diamonds have also started understanding that no, they need to invest in gold bars and coins when it comes to investment. But when it comes to adornment, what people are seeing is that at such high gold prices, the lightweight everyday wear jewelry, which is we are seeing the average ticket size that is, for us, let me tell you one more number. The average ticket size, which was 63,000 rupees in the previous financial year, has gone up to around, it's gone up by 15% to 72,000 rupees. So irrespective of the fact that, we are talking of gold prices moving up, there has been an increase that the consumers are having to shell out a higher value in terms of what they want to invest in jewelry. But that is not equal to the rise in gold price, which means that there is a 4-5% decrease in volumes, which means that now consumer is saying that fine, and in this range of 60 to 70,000 rupees, what is it that I can wear on a daily basis? If gold, it is looking too light, but if it's diamond, it's looking modern, trendy and stylish. So that is where we are seeing a convert. So our stud ratio has been 10.9. And what we have been saying is that we want to take it closer towards 15%. And I think that is very much a possibility in such high gold price scenario. So I hope that what I try to explain is solitaires. Yeah. And one more information is solitaire prices are now gradually in an upward trend. This coming 2-3 months is
right. Critical. So we take that point entirely, Suvankar. Finally, before we let you go, you've given us a great primer on how to look at gold and diamond as investment or adornment and all of that and stuff. What about the primer on investment in your own stock? Because promoters have increased their stake over the last couple of months, but this after having diluted their stake via QIP as well. QIP shareholders on an adjusted basis has still sitting on a loss. Their buy price was 570 odd rupees. Despite the up move that we've seen from the lows on the stock price, they're still, sitting on losses. How do you assuage their concerns right now?
No,
and are promoters buying more at these levels?
So I think that, the QIP investors need not worry. Q3 numbers were looking depressed because of the duty impact in terms of what we saw, that the price is coming down and the impact it had on the inventory and the profitability. But fundamentally, as I keep saying, that nothing changes. The consumer interest towards the product and category and the brand continues to remain strong. We actually saw a 6% increase in terms of the invoices. We have added 2.5 lakh new consumers into the brand. So I think in the long run, nothing really changes. And it is only, the geopolitical scenario, the market sentiments, the uncertainty that is just creating a little bit of irk in the investor's mind. But in the long run, I think Q2, then Q3 and Q4, especially with the festive season, I am very much positive towards the growth of the company. And if you ask me that at these levels, will I be interested in buying? Maybe yes. Whether I am buying or not is not yet something that I can talk about right now. But I think that we can be confident about the future of the company.
Mr. Suvankar, thank you very much for enlightening us about what's happening in the industry and the company. Thank you for that. Get into a break. On the other side, Manisha Gupta joins in with Sumit Gupta of Vasida Global Commodities. Stay tuned.
Welcome back, and joining us on the show now is Sumit Gupta. He's CEO of Siddha Global Commodities. Sumit, hi, thank you so much for joining in. Your first reaction on the MSPs, really, because there's just so much conversation on this. I do understand that MSP is a regular thing, comes twice in a year, but the reaction this time comes in on the back of the fact that we've seen the highest of MSP for ragi and the lowest perhaps for paddy.
Very good noon, ma'am, and thank you for having me on the show. And you have raised a very important point, because let me ask the question: when you are saying MSP, do you mean minimum support price, or you mean maximum price possible for the farmer at the moment? Because what has happened in a way by increasing MSPs which are not in line with market, and specifically, as you have mentioned, maybe highest for ragi and lowest for rice, government is signaling to the farmer that you should plant less rice. But it is not going to translate completely into cropping pattern as such by only through MSP till the time buying mechanism for the other crops are in place. For example, government has given a lot of incentive on planting of pulses, and if you can see today, pigeon pea prices in open market is trading around 6,500 levels, as against if you see the MSP of 7,500, and next year promised MSP of 8,000. So we have a lot of distance to move on converting policy into action for farmers on ground.
So there has been various conversation and data as well, which shows that not even 20, and in some cases even 15% farmers are able to get that MSP. I'm not talking about wheat and paddy here, but for the rest of the commodities.
Absolutely. If you look at the pigeon peas, total procurement that government is able to achieve is around 600,000 tons on a crop of approximately 4 million tons, which is maybe 1/6, 1/7, around 15% of total production is being procured by the government. And though market surplus in these crops are much higher than wheat and rice, which farmer keeps for their own consumption, but what is more important point is it takes away confidence in the long-term policy making from the farmer point of view. And the farmers who produce or the crops which are not being procured by the government are the most marginal farmers who are based in Maharashtra, Karnataka, Andhra, and parts of Rajasthan and MP. So I think there needs to be a better conversion of policy into action, and giving such a high MSP without that having a good track record is not a good thing.
So, Sumit, would you say that a fine line perhaps needs to be drawn? Because on one side, the government is increasing MSP for farmers, and on the other side, keeping many of these commodity prices in check for the consumers.
It's a very good question, actually. How do we, because when you talk about US and talk about Fed, they say 2% inflation is our target. In case of RBI, we say 4% inflation is our target. But if we increase MSP by 4%, 3 to 4%, or 5% in certain commodities, how can you have a 4% inflation target year on year when 46% of the inflation basket is made up of food items? Because if you increase grain prices by 4%, the milk prices will go up at a higher quantum, or animal product prices will go up at a higher percentage than that. So the point that or the question is addressing is very important, that we should look at inflation which negates the impact of MSP. And we cannot have a reasonable target of 4% inflation by increasing MSP 4% year on year. That means one signal that you are giving to market that we don't respect MSP. And commodities will trade at a price lower than MSP for farmer.
The other concern I want to put forth and get your response on is about maize, because we've seen a very strong MSP increase, 2,400 rupees a quintal. Do you also believe, are you also on a school of thought where you think that cotton, soybean, and perhaps pulses area could go down in favor of maize?
So it's again a very important question, because if you look at the competing area in the farmer margin analysis, the competing area between maize and cotton is Gujarat, Rajasthan, and Maharashtra. Among soybean and maize is largely MP, south of MP and Maharashtra. And for sure, the kind of MSP increase that we have seen in both in case of soybean and maize will put farmer at a spot that what crop he should go into. But let me put it this way, government does not have infrastructure to buy maize at majority of the places. Last year, government bought almost 2 million tons of soybeans, but still, if you see soybean prices throughout the year traded much lower than MSP levels, which is a psychological innovate for the farmer to go for oilseed planting next season. And as in case of maize, as you have rightly mentioned, farmer may look towards planting more maize. Why? Because yield in maize is quite good. And with the ethanol sector coming in, farmer has been able to get good realization. And if monsoon stays good, which though with a good, after a good start, next 10, 15 days looks a little tepid, then we are in for big maize crop in the coming season.
Fair that point. Take your sense on all of those commodities there, and the fact that, of course, the government will have to walk that very fine line about increasing MSP prices, but also ensuring fine prices for the consumers there. Thank you, Sumit, for joining in. And with that, it's a wrap on Halftime Report. Business Lunch will take all the action ahead.
Stocks trade soft after a U.S. appeals court stays a ban on Trump's tariffs. A stalling of U.S.-China trade talks doesn't help the matters. Metals, utilities and retail are big losers, even as industrials manage some gains. Bajaj Auto drives in a steady Q4 FY25 with healthy margins and remains confident of healthy domestic and growth export over the next year, that's FY26. But Ola Electric's losses climb as sales dive. The MMRDA has scrapped its 14,000 crore rupees tender after the Supreme Court raised concerns over L&T's disqualification. The Maharashtra government will now decide on the future course of action on the projects. The early arrival of a monsoon may be net positive for Kharif crop, while data shows that the above average quantum of rains usually results in higher output. Ramesh Chand, a Niti Aayog member, tells CNBC-TV18 adds that FY25 agri growth may be 4% and this year can be as robust. The Finance Ministry has advised RBI to ensure that small borrowers with gold loans of under rupees 2 lakh are not affected by the proposed norms. The exclusion of such loans will benefit gold loan NBFCs.
Hello, good afternoon. You have tuned into Business Lunch, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in. As always, markets, a muted day coming in. Not much of an excitement there, not much of an uptick, downtick. Slight bit of a downtick that we've seen coming in the last few minutes of the trading session. So watch out for that. We opened up in the green, then the downtick, then we went the range. Some bit of that fall, but we are around the 24,700 level. We couldn't sustain 24,800 and above that mark. So that will be key to watch out for, as well as the beginning of a new series. We'll be keeping an eye out on that front. Other than that, Nifty Bank, not some sort of an excitement today coming in on the Nifty Bank front as well. A dull day there as well. 1/10 to 0.2% of decline we've seen coming in today's trading session. Mid and small caps, some bit of a better performance versus benchmark indices is at least what you could highlight on that front, because mid cap is just near that flat line, managing to trade between the red and the green. The small cap has moved to the green just the last few minutes that we could see. That's come back on the green side. So 0.1% of gain coming in for the small cap. So that outperformance for the broader end of the market, that is something that has continued. As of now, most of the sectors are trading in the red. We have PSU banks that was managing to hold on to some bit of a gain, Nifty PSU bank. So that is something that we'll watch out for, because 0.4% of gain, that is what it's managing to hold on to. Other than that, nothing was in the green today. Chemicals and fertilizer stocks, let's keep an eye out on that, because that's also in some bit of a trend that we're seeing a downtrend coming in for these stocks. Chambal Fertilizers, Deepak Nitrite, Deepak Fertilizers. These are some of the stocks that I would mention, as well as SRF. Also, that's almost near the day's lowest point, down 0.5%. Around that mark in today's trading session. But yes, that's how the market setup is looking like. Not much of an excitement, some bit of a negative bias is what we're seeing coming in today's trading session. Let's talk about the top Nifty loser on that note. Bajaj Auto, they reported their Q4 FY25 numbers. While obviously they've seen some bit of a profit booking right now after the numbers seems like it, we caught up the management of the company. Their guidance for the 125cc plus segment vehicles and outlook on the margin is what we managed to get out of them. And we spoke to Executive Director Rakesh Sharma. So listen in to what he had to say in terms of the guidance there.
One thing is, which has held steady, is that the 125cc plus segment has outperformed this 6% growth. It'll probably be between 8 to 12% growth, and we would be looking at growing faster than that. Well, the EV volume should ramp up. The margins are a consequence of many things. We will have to, our intent is to keep managing dynamically, but you know, the dollar is the rupee is appreciated against the dollar. There is some marginal headwinds when it comes to the commodity and the material cost inflation, and we have to watch competition. The intent is to keep the margin steady, but there are some headwinds, particularly from the currency side going into the quarter.
Okay, and now let's move on to a gainer in today's trading session. That is Suzlon Energy, surging away in trade, more than 8-9% uptick that we're seeing coming in for the stock after a strong set of Q4 FY25 numbers. We spoke to the management of the company to understand how they expected the growth to pan out going ahead. What is the outlook there? Listen in to what they had to say.
Obviously, for the first time in our history that we gave a guidance saying that in FY26, we will grow by 60% minimum across the board. So that is not just giving a guidance of a number, and we are able to give a guidance for the first time, shows that we are now well prepared as an organization to see the future.
Not only Bajaj Auto and Suzlon Energy that have reported their numbers, but a lot of other stocks that are buzzing on the back of their Q4 FY25 earnings as well. Gujarat Pipavav, Sobha, Landmark Cars, Amara Raja, Welspun Living. To talk to us about all of them, how are the numbers like? We have Sudarshan here to give us those details. Afternoon, Sudarshan.
Good afternoon, Vinny. So we'll start with companies which have reported a healthy set of earnings and are reacting positively to their Q4 FY25 results. First one on the list is Gujarat Pipavav. It has reported operationally steady number for Q4. In this challenging environment, revenue was flat. It was at rupees 252 crore. EBITDA 2 was flat at rupees 157 crore. And margin company has managed to hold on to levels above 62%. It was at 62.3% versus 62.6%. For Sobha, it was a healthy Q4. Revenue was up 63%. EBITDA 2 has risen 52%. collections have increased by 21% and sales value were higher by 32% on a sequential basis. Now coming to the companies which have reported a negative set of earnings and also are reacting negatively. First one on the list is Landmark Cars. Revenue growth was healthy. It was up 26%, but margin has contracted. It was down 120 basis points. Amara Raja, it was an operationally weak quarter. Profit was down 30%. Revenue has increased by 5%. But EBITDA was down 17% and margin has contracted by more than 300 basis points. Last one on the list is Welspun Living. Growth remains soft. It was up 3% YOY. Margin also was under pressure. It has slipped 200 basis points. And for FY25, revenue growth was at 9% versus guidance of 10 to 12%. And also, company has refrained from giving guidance for FY26. And that's the reason it's seeing a sharp downtick.
Okay, Sudarshan, thank you so much for that. Important stocks to watch out for in today's trading session. They're moving on the back of their earnings. But let's move on and talk about the data that is expected to come out of the economic front. We have MOSPI, or the Ministry of Statistics, that will announce the GDP for the fourth quarter of last year and for full year of FY25. A CNBC-TV18 poll sees the fourth quarter GDP at 6.85% and the full year at 6.3%. For more details on this, let's go across to Lata, who's waiting by to tell us about this one. Lata, afternoon.
Good afternoon. Yes, the poll gave us a number of 6.85, but some of the responses I got after the poll was done were closer to 7. So I would prepare for an upside surprise to that 6.85% that we got for the fourth quarter. The GVA is 6.5 for all respondents, and that's a more important number. Just for reference, the previous numbers are coming up for you in a table. Last quarter was 6.2, second quarter was 5.6, and Q1 was 6.5. I'm giving you these numbers for a reason. I'll come to it in a minute. What is expected to fire well in the fourth quarter are agriculture, services like construction, finance, and public administration. That's the government services. What will not do well or is expected to lag would be manufacturing. Investment and consumption are both expected to do well, but investment will do a little better than consumption growth. That's the expectation. There is a large gap expected between GDP and GVA because of the lower subsidies, and that's important to note. So GVA, everyone expects at 6.5. The important part is the previous quarter's numbers may be recast. You remember that 5.6 in the second quarter? If that is recast, then the numbers can look very different. Then all bets are off. Then don't go by our poll at all. For the full year, the expectation again is 6.3. Again, if previous numbers are recast, then this can well be 6.4 also. Many people told us about that number. Upside surprise is what people are expecting.
Okay, upside surprise is what we're waiting for. We'll wait out for those details coming in. Thank you so much for that, Lata. But shifting focus, and a major relief that is coming for L&T as MMRDA has scrapped its rupees 14,000 crore tender after the Supreme Court expressed concerns over L&T's disqualification from the process. Ashmit is joining in with us to give us more details on this one. Afternoon, Ashmit. What are you picking up this one? At least some bit of a relief coming in for L&T, right?
Well, a big breather coming in for L&T. Bear in mind that there was a contract in Maharashtra, two of them, one for 8,000 crores, the other for 6,000 crores, aggregating to a 14,000 crore rupee bid. And this is for construction in and around Mumbai. What we understand is that at the technical stage, L&T had been disqualified as per the MMRDA tender, and that is what they had challenged first in the Bombay High Court, then here before the Supreme Court. What is extremely telling is in that in the course of these proceedings, the Supreme Court was not very kind to the state of Maharashtra, was not very kind to the MMRDA, asking very pointed questions. How L&T, a name that inspires confidence in the field of infrastructure, was disqualified at just the technical stage, asking questions that L&T was the one responsible for, in fact, constructing the Central Vista project in Delhi, how such a name could have been disqualified, asking very pointed questions if there was any scope for re-tendering of this entire process. Now, that is something that apparently weighed on the minds of the Maharashtra government, of the MMRDA. What we understand today is that their counsels, including the Solicitor General Tushar Mehta, appeared before the highest court of the country and said that on account of the concerns being raised, now they are scrapping this entire tender altogether. and that the future course of action is to be decided now by the Maharashtra government. So clearly, a big relief coming in. This was a 14,000 crore rupee tender that L&T was on the cusp of losing. Now that entire process has been scrapped. One assumes that it will start again, but that's of course a call that the Maharashtra government will now have to take. But a major breather coming in for L&T in this MMRDA 14,000 crore rupee tender. Back to you.
Absolutely, Ashmit. Thank you so much for that. As of now, the stock is managing to hold out a some bit of a gain of almost around 0.5% in today's trading session. But let's move on, talk about some of these NBFC gold loan players that we have. Muthoot Finance, Manappuram Finance, they are gaining in trade. Why? Because Finance Ministry tells RBI to ensure interest of small gold loan borrowers and that they are not impacted by this new draft guidelines. Sapna is joining in with us to give us details on this front. Afternoon, Sapna. What is the latest update coming in here, because these stocks are surely cheering today?
Well, it is what the government has put out very clearly, in their statement, indicating that the small gold loan borrowers should not be adversely impacted by any kind of guidelines that the RBI has in mind, and especially, for where the ticket size of the loans is as less as 2 lakh odd rupees. That's where the selection, the particular selection is that they should actually be excluded from these kind of directions that the RBI has been talking about. The draft guidelines, of course, happen in the public domain. So all this feedback has gone to the Reserve Bank of India. And mind you, this discussion or these kind of selections going from the Finance Ministry, they have been taken at the highest level. It's the Finance Minister who has held these discussions with various stakeholders, and that's how the information has flown to the Reserve Bank. The government has also made a very clear pitch that any kind of direction should not be rolled out before Jan 2026, because enough time will be required for the banks to sensitize customers, as well as make changes in the systems for all of this to happen. But the one point that I really want to make is that this is a sensitive issue for the government. We have not seen in the recent past the government coming out with this kind of a statement, wherein the kind of consultation that they're having with regulators, they've actually brought it out in the public domain. So that's a very, very positive thing going forward. And I think this is how it's going to be in the times to come. If you look at the back also, in the past also, all the discussions that happen in terms of LCR, something may also be underway in terms of relaxation of the norms for the infrastructure project financing. All of that is also underway. So this is how it's going to be. Right. Yes, a big step by the government to actually bring out this in the open and indicate that this is what they're asking.
Absolutely. Absolutely, big step coming in there as well. Thank you so much for the latest update coming in, Sapna, on that front. But on that note, we're going to actually slip into a very short break. But as we slip into the break, we are excited to unveil our brand new global news channel, the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for Global Reset and Global Lens at 8:30 p.m. Welcome back to Business Lunch on CNBC-TV18. Now let's get you the latest update coming in on the tariff fronts. Now, in a relief for Trump administration, an appeals court has reinstated Liberation Day tariffs a day after the trade court halted their implementation. The next report is here to give you more details on this one.
A U.S. appeals court on Thursday reinstated President Donald Trump's sweeping tariffs, a day after a trade court ordered an immediate block on them. The Court of Appeals for the Federal Circuit in Washington provided no opinion or reasoning for reinstating the tariffs. White House trade advisor Peter Navarro said that U.S. tariffs would remain in place for now.
The tariffs remain in place. The court told us, they didn't all but tell us, they told us, go do it another way. So you can assume that even if we lose, we will do it another way. And I can assure the American people that the Trump tariff agenda is alive, well, healthy, and will be implemented to protect you, to save your jobs and your factories, and to stop shipping foreign wealth, our wealth, into foreign hands.
My fellow Americans, this is Liberation Day. I'm waiting for a long time.
The trade court's ruling on Wednesday threatened to kill, or at least delay, the imposition of Trump's Liberation Day tariffs on most U.S. trading partners. But the White House said the ruling had not interfered with any negotiations with top trading partners that are scheduled in the days ahead. Wednesday's order to block Trump's tariffs had given financial markets a brief boost, but Thursday's turn of events left Wall Street with no clear direction. Analysts said broad uncertainty remains over the future of Trump's tariffs, which have cost companies more than $34 billion in lost sales and higher costs, according to a Reuters analysis.
Meanwhile, even as China and United States have agreed to a 90-day pause on the tariffs, U.S. Treasury Secretary Scott Bessent says that further talks with China are a bit stalled. Listen in.
I would say that they are a bit stalled. I believe that we will be having more talks with them in the next few weeks, and I believe we may at some point have a call between the president and party chair Xi.
Meanwhile, Mark Mobius of Mobius Emerging Opportunities Fund also spoke exclusively to us on CNBC-TV18 Prime and added that Trump has turned things on its head for the economy with his tariffs. Take a listen.
Well, I think the words that you use, things have been turned on its head, because Trump has done that actually for the global economy. He's basically said, look, folks, we're starting a new game. I'm throwing out all the old ideas, and now we're going to start over again so that the U.S. can get the fair treatment. And by the way, this kind of fair treatment idea is being extended all over the world. Other countries in the world are beginning to ask the same questions that Trump is asking. But you must remember, Trump is a negotiator. He loves to negotiate. And the way he negotiates, of course, is start out with the worst possible scenario. So that's the reason why he said, I'm going to give you a high tariff. I'm going to kill all of you, and you're going to be all in trouble. And then he starts to negotiate down to a reasonable level. So now we're really in the middle of this. We're not finished with this negotiation, but we're beginning to see some light at the end of the tunnel.
Earlier today, we also spoke to Stephen Englander of Standard Chartered Bank to get his views on the appeal court's decision to reinstate Trump tariffs. Listen in.
I think it weakens it a little bit. Certainly the the trading partners who are facing very high reciprocal tariffs. It doesn't look as if that's as big a threat now as it might have been, say, a week ago. But even then, it looked more likely that they would just roll over the 10% baseline tariff rather than, jump to the reciprocal tariffs. They do have a bunch of options. And, if you actually read the decision of the court, it's a little bit narrower, I think, than was construed. The issues seem to be that there was no limit that the Trump administration saw on what they could do on tariffs, and the court was sort of saying the authority that Congress gave them is not meant to substitute for congressional discretion, so there has to be some sort of bound.
Meanwhile, the tussle between United States President Donald Trump and the Fed Chair Jerome Powell has intensified. The next report tells you more on that.
Donald Trump has not been a fan of Fed Chief Jerome Powell.
I call him Too Late, Too Late Powell, that's his nickname.
On Thursday, he summoned Powell to the White House to tell him he's wrong to hold off on rate cuts. Both sides confirmed that the meeting happened at the president's invitation. In a statement afterwards, the Fed said Powell told the president that future monetary policy would depend entirely on economic data. White House spokeswoman Caroline Leavitt set out Trump's take.
The president and I both saw the statement that the Fed put out after the meeting. That statement is correct. However, the president did say that he believes the Fed chair is making a mistake by not lowering interest rates, which is putting us at an economic disadvantage to China and other countries. And the president's been very vocal about that, both publicly and now I can reveal privately as well.
Earlier this month, the Fed left rates unchanged. And bank officials have since signalled that policy could stay on hold for some months more, while they wait for clarity on the impact of tariffs. The Fed is concerned that trade turmoil could slow the economy, but also stoke inflation. That makes for a tough call on whether to raise or lower rates. Financial markets are currently pricing in a cut in September, with another to follow in December. Trump elevated Powell to Fed chair during his first term, but soon fell out with him over interest rates. In April, stocks tumbled amid market fears that the president could try to remove Powell from his post. Trump later denied ever having any such intention.
And after billionaire Elon Musk's announcement has come in on his exit from the Trump administration, US President Donald Trump has also called for a joint press conference with the billionaire entrepreneur at the White House Oval Office today at 11 p.m. Indian Standard Time. On his social media platform, Truth Social, Trump said that, and I quote, "This will be his last day, but not really, because he will always be with us, helping all the way. Elon is terrific." End of quote. On that note, we're going to slip into a very short break. Viewers, don't go anywhere. We'll be back with more updates after the break. Thanks for staying tuned into Business Lunch on CNBC-TV18. To some international updates, Israel's Prime Minister Benjamin Netanyahu has said that his government has accepted a U.S. proposal for a Gaza ceasefire and hostage release. However, Netanyahu's office was not immediately ready to comment on the same. The White House has said that Israel has signed off on a 60-day Gaza ceasefire proposal as Israeli army continues its military actions in the war-torn area. Now, earlier yesterday, Hamas said that it was studying the proposal and Israel's response, considering that the people in Gaza are suffering of genocide. The proposal does not require Israel to commit to ending its 19-month offensive in Gaza, but requires them both, Israel as well as Hamas, to engage in negotiations on the long-term truce. The United States, Egypt, as well as Qatar will serve as guarantors of the ceasefire proposal. And with that, we're absolutely out of time on this edition of Business Lunch. Thank you so much for tuning in. Up next, you have Midcap Radar. Well, final few hours of trade for this day and for the week. But what a week it has been. Good afternoon and welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I am Vamakshi Dhoria and with me is Vivek Iyer. Well, Vivek, it has been an incredible week so far as news developments around the tariff situation is concerned. Yesterday, we were looking at a positive news flow, but today it's been, not so good, especially for the Asian markets. We're still holding relatively better as compared to them, and the mid-cap end of the markets as well doing quite well.
That's right. Good afternoon, Vamakshi. Absolutely right. So we are starting off the June series on a slightly subdued note, especially as far as the Nifty is concerned. But remember, the May series, despite all of the news flow, managed to hold on with gains. We have quite a lot lined up on the show, a management interaction as well. So let's start off with the top headlines. Stocks trade soft after a U.S. appeals court stays a ban on Trump's tariffs. The stalling of U.S.-China trade talks doesn't help matters. Metals, utilities and retail are the big losers, even as industrials manage some gains. Mid-caps fare relatively better.
Suzlon jumps over 8% after a stellar fourth quarter, reports a 73% uptick in revenue while profit rises multifold year-on-year. Management tells CNBC-TV18 that they're expecting 60% growth across all key parameters.
Pharma stocks in focus after their Q4 numbers. Alchem Labs under pressure after management says they see high single-digit overall revenue growth in FY26. Wockhardt reports lower losses while revenue and profit for Concord Biotech surge.
An operationally weak Q4 drags Amara Raja, profit down 30% while revenue declines 5% as compared to last year, stock down nearly 5%.
Mazagon Dock falls over 5% on a sharp decline in profitability impacted by significantly higher expenses and margin contraction. Welcome to Midcap Radar. Well, especially in the last 15 to 20 minutes of the session, you've seen a very sharp spike as far as the entire PSU banking pack is concerned. There is a money control article indicating that there has been some progress, especially as far as the divestment of the ITBI is concerned. And post that particular news break, you've seen a sharp surge across the entire PSU banking index. So if you look at names like SBI, PNB, Bank of Baroda, Canara Bank, even the other smaller names like Union Bank, Bank of India, all of these stocks and all of these banks trading near the intraday highs. But Hormel is standing by the wall. He has a list of all of the top stocks in the broader end of the markets that are making all the moves.
Oh, there are lots of them, and especially since it's a Friday, so there's no devoid of any Friday fever, if you can call it that. There are a lot of movers in the gaining side among the broader markets in today's trading session. Look at LG Equipment's BSC continuing to make new highs every single session, 7% higher on that stock. RR Kabel too, now at the highest point of the day, 8% higher now on that stock as well. The earnings reactions are categorized into two buckets today. We'll take the positive ones first. Suzlon is off the day's high, still holding on to gains of 9% after some very strong management commentary. On the flip side, Gujarat Pipavav is at the day's high, 11% higher on that stock. Engineers India, very strong operational performance, 6% higher here. And Wokhard, Ekta was mentioning that losses have narrowed, and that too is up 8% in today's session. On the flip side, the negative earnings reactions, of course, led by Mazagon Dock at 6.5% lower. Look at Ola Electric with targets going to as low as 30 rupees. Welspun Living, SJVN too at the lows of the day. Some of the newsmakers in today's session, of course, we are counting down to earnings from Vodafone Idea today. That stock is down at the lowest point of the day. Deepak Nitrite too at the day's low after the downgrade that came in from Motilal Oswal. On the flip side, look at Manappuram and Muthoot, the surge that they have seen after the Finman recommendations. Muthoot now is up 7%. We'll hear from the management shortly as well. And lastly, stocks that are doing well on the volumes front. And look at Concord Biotech, Tata Investment, Nuvama Wealth is up 4%, and all of these stocks gaining on very strong volumes. Back to you guys.
Well, thank you so much for that, Hormaz. And just to add to your list, LG Equipment is one such at the counter. They had reported the numbers on 28th of May. The stock didn't do much, but today the stock is up almost 8% on the back of very strong volumes. Apart from that, when we look at the stocks that have managed to hit an all-time high, pull up the chart for BDL as well. The stock has been doing quite well today as well. That stock is trading with a gain of almost 3.6%. But let's welcome in Hemen Kapadia from DR Choksi Finserv for a technical check on the market. Good afternoon to you, Hemen. I'm Bamakshi. And, I'd just like to understand from you, where do you see the markets go from here on? Because yesterday it was a good session. Today, again, we're down and out.
A very good afternoon to you, Bamakshi. Thank you for having me on the show. It's always a pleasure. 3,350 points has been the move for the Nifty from the lows, Bamakshi. So frankly speaking, it's tired, it's overbought, and it's corrective. Having said that, there have been four gaps on the upside. None of them have been covered. So I would say the markets are resilient. The VIX is still at 16.5. Below 15, I think we'd see some more action by the bulls. So frankly speaking, currently we're in a range between 24/7 on the downside and 25,100 on the upside. So we remain over there. Stock specific, there are a lot of movements happening every other day. So Nifty still needs some more time to recoup, maybe consolidate some more. Bank Nifty, on the other hand, seems set to make a move, but only above 55,800. So as of now, markets are in suspended animation. I wish we had a more significant time price correction. But anyway, that's just visual thinking.
Absolutely, Hemen. Good afternoon to you. Individual stocks, what's on your radar? All buys, or do you have a sell mixed in there as well?
A very good afternoon to Vivek. No, no sells. Markets like these, the undercurrent remains positive. So buys. Firstly, a buy call on Godrej Properties. The stock is quoting over the 55-day exponential moving average. The daily as well as the weekly oscillators are in buy mode, supporting the move. A further upside seems like a distinct possibility. One can buy Godrej Properties at 2240, stop loss 2190, target of 2340, risk reward ratio 1:2. Secondly, there has been a lot of movements in PSU stocks. PSU banks are something which were lagging. I believe the movement could have started today. So it's safe to go with the big daddy of PSU banks. I have a buy call on State Bank of India, Vivek. One can buy State Bank at 805, stop loss 780, target 855, higher top, higher bottom, above 55-day moving average, oscillators by decent period of consolidation, setting the stage for an upmove. Vivek.
Well, thank you so much for that. So keeping an eye out on Godrej Properties and SBI, you have a buy call on both of these counters. But as we slip into a short break, we're excited to unveil our brand new global business news channel, the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset and Global Lens at 8:30 p.m. Welcome back. You're watching Midcap Radar on CNBC TV18. Let's put the spotlight on Quality Power Electrical Equipments. The company reported a mixed set of Q4 numbers. Profit and revenue growth came in very strong, while the margins contracted sharply due to higher cost of materials. We are now being joined by Bhatnidharan Pandian, who is the Joint MD and Whole-Time Director at Quality Power Electrical Equipments. Well, good afternoon to you, sir. At first, I'd like to start off by asking you about the kind of growth you're penciling in for FY26. The growth in FY25 stood at 12%. You have an order book of around 750 odd crores. How much of this gets executed in FY26?
Very, very good afternoon, ma'am. Thank you. Thank you for having me on the show. Our revenue guidance for the year is between 700 and 800 crores that we have already committed on the earnings call. The margin shrinking is not so much as what is shown. We have always had the issue of IFRS and IAS 29. Some of our earnings from our Turkish subsidiary are classified under other income due to the hyperinflation formula, where the price variation clauses are treated as other income rather than the operational income. Otherwise, the margins are more or less stable. We have made an excess of about 101 crores in profit after tax this year. We believe the growth is going to be solid this financial year, considering the headwinds, the tailwinds in the sector. The 750 crores order book is the unexecuted order book as on date, is just 2 months into the year, and we believe the year we have a lot of more positive surprises coming up.
Okay. Mr. Pandian, we get that point. When we're looking at the export order book, especially in the first half of the last year, it was at over 70%. Where does it stand at currently as a part of your total order book? Also, are you seeing any further uncertainty, especially given worries around tariffs? Also, you have a significant presence as far as Turkey is concerned. Are you relooking at that particular partnership as well?
The subsidiary what we have in Turkey is over 15 years now. We have business there, but it doesn't serve Turkey alone. They serve across the world. We serve in Australia, in Africa, in Middle East. amount of direct exposure we have to the government, Turkey and India is close to negligible. Going, I believe it will be even smaller because of the kind of growth we are seeing in the renewable energy sector across the world. With regards to exports, I believe the blended numbers, because Mehru acquisition was done in March of last year, so which means we couldn't take the consolidated numbers. Going forward in the Q1, Mehru will be consolidated with us. We believe they did about 250 crore plus of revenue last year. So they are primarily a domestic vendor. As we are increasing their export share, we believe we should be about 50-50 in domestic and exports. But our export books are quite well. We are one of the very few players across the world who make this equipment. So we are seeing a lot of traction, including we just got a contract out of Hong Kong, a one-year contract with the local utility, the CLP.
Sure. And, if just talking about your order inflow, right? You mentioned earlier that you were expecting some surprises this year. So could you quantify that for us? What is the kind of order inflow you had in FY25 and what would it be in FY26? And what is the demand situation looking like on ground? Are there any sort of delays, concerns, as Vivek was just asking you?
The pressure right now for most of the high voltage equipment manufacturers across the globe has been on the capacity. The demand is ready to pay a premium for capacity and delivery. Most of the HVDC projects in the world are coming up very, very fast. National Grid in Britain, which is the British power grid, equivalent to power grid of India, released an order for 59 billion pounds a couple of months back. And that is the kind of numbers we are seeing in most of the utilities coming up in the next 2-3 years. So it will be an execution challenge for smaller vendors like us to be able to ramp up our show. So I believe it's more of an execution side worry rather than an order side worry. We could ramp up our order book how much ever we want if we have a capacity at this moment.
Okay, Mr. Pandian, would you be able to quantify two numbers for us? Number one, the order prospect pipeline. You gave us an example of British equivalent of India's power grid. You've also given us examples of various capex that's been done across the world. So what is the order prospect pipeline, typical win ratio for you, and what are you penciling in terms of order inflow for FY26?
We believe we should be able to tag along another 500-600 crores of order again over the 750. I think that would be a conservative estimate if we win some of the HVDC jobs that are on the pipeline. Plus, again, the high voltage transmission sector, where we have a significant exposure with Meru, that is also increasing. And the STATCOMs and the SVCs we are delivering, we see an upside coming up with the metal prices soaring again.
Sure, and you just mentioned that capacity is a constraint, but you have two coming up, one in Cochin, which will be operational by November 2025, and one in Sangli, which will be operational in Q2 of FY27. So what is the kind of revenue potential that you see from these new capacity additions? And this is what I'm asking you about is at the full utilization of the capacity, and what will be the margin kind of contribution that would come through in FY26 and FY27?
The peak capacity output of these two plants would be about INR 2,000 crores, give and take, which we believe would suffice for the next 2-3 years till we are able to execute the orders that may come in. With regards to margins, because we have some blended margins coming up, that means we are consolidating Meru and some of the M&A opportunities that we're looking at. So the blended margins we are giving in around 15%, but on the existing product side, I think it should be higher than 20%.
And when will you be reaching the peak utilization for both of these facilities? How will they ramp up?
We have a 9x capacity addition that is coming up in the next 1 year's time. I believe it will take about 2,000 odd people that we need to take in to ramp up the numbers. If we are able to ramp up on time in process, I believe in 3 to 4 years' time, we should be able to get the peak capacity.
Mr. Pandian, you spoke about a 2,000 crore capex. Number one, how are you?
The peak numbers that can
understood.
The revenue.
Okay, okay, got that. So what is the capex that you have penciled in? How are you funding the capex? Internal accruals, or are you raising debt? And typical asset turns for you?
We are not raising debt. The promoters are infusing the money through the OFS, whatever we raised. We have done a repo plus 0.5, what we say over a period of 15 to 20 years to ensure that our current cash in the hand We are sitting in over 150 crores of cash. We do not want to put it in capex cycle at this moment where we see some interesting M&A opportunities. So we are using the company accruals and the profits for growth cycle at this moment. The asset we are putting in as a soft loan. So we are not raising any external debt at this moment.
Sure, and with the kind of capacity addition that you will do, there will be some expenses that will be involved in setting up the facilities, bringing on the manforce, and then sort of scaling it up. So, do you think that there could be some pressure on the margins in FY26 and 27? The period within which these facilities will ramp up, because historically, when I look at your numbers, your margin, your EBITDA margin has ranged between 12 to 13% typically, and this time around it's spiked up to 19%. So, will you be able to sustain this, or can we expect some pressure?
The margins are more or less constant, ma'am, for the past 5-6 years. But when we shifted from a in-GAAP to Ind-AS during the IPO, we had to, classify a lot of our operational income under other income, especially of the subsidiary. As we try scaling up, either through organic or inorganic, the margins may be what we say slightly varying, maybe a couple of percent here and there. But I think on the sum total of what is the magnitude, I think that will be a addition. So what the PAT would continue to increase.
Right. Mr. Pandian, one question. You've gone ahead and constituted a task force to explore acquisitions. Could you give us a sense of the size of the acquisition? What will be the targeted entity? What will be the business that they are in? And how will you fund these acquisitions if you manage to go ahead and come to a fruition?
So at what we say at cash and bank, we have at this moment about 210 crores, give and take. What we say with more being generated every day. So I believe with the promoter OFS, we would be able to fund something in the range between 300 and 400 crores. That is a kind of war chest we are sitting at this moment. With regards to what we are seeing synergies, we look at high voltage electrical equipments. We are looking at, again, stuff in the power sector where we feel that we can have the same customer. The CAC is almost zero, where we can sell it push through. We are quite excited on the power electronic space, especially on energy storage. We are looking at a couple of companies, again, in the Western markets, primarily because those technologies are not available in India. We are also trying to partner with other similar like-minded companies where we can look at co-acquisitions wherever it may be.
Right. Thank you so much for joining us, giving us a sense of how FY25 panned out and what we can look forward to as far as FY26 is concerned. Thank you once again. Well, as we now slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back. You're watching Midcap Radar on CNBC-TV18. Well, a whole host of pharma stocks are reacting to their Q4 numbers. Ekta is here with us and she will tell us how the numbers have panned out this time around. Good afternoon, Ekta.
Thanks very much for that. So I'll start with Orchid Pharma, which is in focus post its numbers. It has been under pressure for the entire week. Nuvama had written a brokerage note on it a couple of days ago. They said that the base business price pressure led to muted FY26 guidance. They've cut the target price to 990 rupees. They've maintained a buy. Alkem, the company is guided for high single-digit overall growth in FY26. Margins should be flat in FY26, so that seems to have disappointed the street. And they've guided for, however, double-digit growth in FY27. Wockhardt, there's a turnaround year-on-year with around a 6% growth and lower losses. So revenue is up around 6% year-on-year. Margins 9% versus an EBITDA loss year-on-year, and a net loss of 25 crores versus a net loss of 169 crores year-on-year. Moving to Concord Biotech, that one is in focus on account of numbers. Revenue up 35%. Margins have expanded 200 basis points year-on-year, and a profit which has jumped 48%. Lastly, Shalby. It was a disappointing set because the margins came in at around 7.9% versus 16%, and there was a loss of around 7.8 crores, and this is versus a profit on a year-on-year basis.
Well, thank you so much for that, Ekta. Surely keeping an eye out on all of these pharma names. But moving on then, let's put the spotlight on some gold financiers because they have been doing extremely well in today's trading session. There was a post from the Finance Ministry on X, the draft guidelines on lending against gold collaterals issued by the RBI have been examined by the DFS, that is the Department of Financial Services. And here are some of their suggestions. They have asserted that the requirements of small gold loan borrowers should not be adversely affected. What they've also added that small ticket borrowers below rupees 2 lakh should be excluded from the proposed directions, and this brings relief to some of these gold financiers. Now keep in mind that for Muthoot, in their Q4 con call, they've given up a breakup of their AUM. So below 50,000 rupees, accounts for almost 13% of their AUM. For ticket size ranging between 50,000 to 1 lakh, it accounts for nearly 15% of their AUM, and overall, when we look at Muthoot, over 60% of its loan book has a ticket size below 3 lakh. As far as Manappuram is concerned, in their conference call, they've highlighted that almost 85% of their loan book has a ticket size below 5 lakh rupees. Now, this ensures for both Muthoot as well as Manappuram that the adverse impact on loan growth due to these LTV guidelines are minimized. Therefore, that bodes well for these companies. And another suggestion that also came through is that the guidelines will need time to implement at the field level, and therefore they've proposed to delay the implementation of guidelines to January 1st, Vivek, and that is the reason why all of these counters, including Muthoot as well as Manappuram, are surging in trade.
Well, thank you so much, Vamakshi, for that. The entire pact, so Muthoot, Manappuram, and also remember IIFL Finance, that too has a gold loan portfolio. So IIFL Finance too, today doing quite well in the session. Well, one stock that I've been tracking is Suzlon. Earlier today, we also had the management, and this was post their Q4 results. So what actually transpired as far as Q4 was concerned? The company managed to end Q4 FY25, that is the last year, on a very, very strong note. Strong deliveries of 573 megawatt worth of volumes led to revenues jumping higher by over 73%. When you're talking about the EBITDA jumped by 94 crore. Well, there was a one-off impact as far as the deferred tax was concerned, and on the back of that, profitability jumped up 4x. Margins, however, went up almost 200 basis points. So that was a significant development. End of FY25, the order book was at close to 5.6 gigawatt. And for the first time, the management of Suzlon actually said that they had the confidence, given the order book visibility as well as the order inflow that they were seeing. They have given an order inflow guidance, or rather, an execution guidance of 60% growth as far as FY25 is concerned. So they expect volumes to spike up by 60%, revenue, EBITDA as well as profitability, all expected to go up by over 60% on a pretty high base of FY25. Street clearly likes it. Suzlon was up over 10% at one point of time, cooled off a little bit from there.
Well, absolutely, Vivek. And we also spoke to the management, so let's listen into what they had to say.
Obviously, for the first time in our history that we gave a guidance saying that in FY26 we will grow by 60% minimum across the board. So that is not just giving a guidance of a number, and we are able to give a guidance for the first time shows that we are now well prepared as an organization to see the future.
Well, some bit of recovery coming in the Nifty. The Nifty is now closing to the 24,800 mark. The mid-cap end of the market has also picked up marginally. It's trading with a gain of almost 0.2%. The Bank Nifty too, on the back of the gains that are coming in on the PSU banks, is up and away in trade today, up almost 0.4%. But that's all we have on this edition of Midcap Radar. From Vivek, me, and everyone who put the show together, thank you so much for tuning in. Don't go anywhere, because your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 or Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in. As always, market is where we left it. Not much of a pickup that we're seeing in the markets. 24,790 is where the Nifty is trading at. Right now, also a decline of almost 0.2%. But outperformance coming in from Nifty Bank, mid and small cap, that's managing to hold on to that green as well. So yes, that's what we are watching out for in today's trading session, specifically PSU banks. They're doing very well. PSU banks like Bank of India, Indian Bank, Canara Bank, all these names are buzzing in trade. As of now, also, we've seen a spike up coming in for HUDCO as well. So, let's watch out for that. Other than, the PSU banks, HUDCO is trading almost at the day's highest point. So that is something interesting in today's trading session. But yes, that's how the momentum is right now in terms of overall the market that we're seeing coming in, the beginning of the new series as well. But joining in with us is today our independent market expert Shaina Mukaddam, as well as Vaishali Parekh of Prabhudas Leeladhar, to solve all your stock-related queries. And Vaishali as well as Shaina, good afternoon. Thank you so much, as always, for joining in with us. Beginning of a new series, hoping for better days coming in. Trump tariff issues continue, but we're hoping for a better market. So let's get started with those stock-related queries for today. The first query is coming in from Shweta Punj, who's writing to us from New Delhi. Holding 100 shares of ITC, price is 400 rupees per share, wants to know if she should buy more of these at the current levels. Vaishali, let me take it to you on the charts and technicals. How is it looking like? And good afternoon.
Hi, very good afternoon. So I think ITC, talking about it, it has hardly been showing any momentum as such. It is just consolidating for now between 410 to 440 levels. So if one has to buy, I would say yes, 410 acts as a very good support. So I think very close to that, one can buy over here and look for this stock to move past 440. That would bring in further strength. And we are looking at a long-term target of around 500, 520. So I guess it's a good level to buy.
Okay, I'll just mark the flashes at the bottom of your screen, which our ticker team is flashing right now. What we have and what sources are saying on Patanjali is that Patanjali Ayurveda is under scrutiny of the Corporate Affairs Ministry. So keep an eye on that. The DG investigation has sent a notice to Patanjali Ayurveda under Section 210 of the Companies Act. The MCA investigation is underway. Likely that will be, completed in the next 3 months. Section 210, if you want to know what that is, of the Companies Act 2013, that is to investigate into the company's affair. And also agencies like the ED, IT, GSC, MCA have an MOU that is there on the exchange of info to look into such matters as well. So that is why Patanjali Foods right now is seeing a bit of a pressure coming in. There is a scrutiny by the Corporate Affairs Ministry. So keep an eye out on that one. Stock down almost 3% in the trading session. Let's move on to the next stock for today and next query for today. We have Sulochana, who's writing to us from Kolkata. 200 shares of Praj Industries, price is 500 rupees per share. She's holding it since last year. She's asking if she can hold the stock for another year. Praj Industries, what's your view coming in on this one, Shaina?
Well, I would say it is advisable to switch. The numbers were a bit disappointing, and I see a lot of analysts now, or likely going forward, bringing down the estimates. So I would say it is better to switch from here.
Sure. Okay, switch from here on. That's the word coming in there. But we do have some exclusive coming in for you all. Let's cut across to Madhya, who's actually in conversation with Peter, the CEO at Interglobe Aviation. So let's go across there.
Over 90 lakh passengers in April and taking over around 65% in market share. Given that at least 40 of your planes are on ground, how is this sustained? Like, what is the strategy or planning that goes into sustaining this leadership?
Yeah. Indigo is in a very good position to deal with some of the global supply chain challenges. So for the past 2 years, actually recovering from COVID, we see all over the world these global supply chain challenges. Indigo has an order book which provides us with one new plane each and every week. So what we have done over the last 2 years, and this year is exactly the same, we put out a capacity guidance and then we basically work towards that with all kind of mitigating measures. So we have some extra planes leased in, we extended some of the leases, we took some planes from other operators and we brought them in. So that picture really helps us to live up to the capacity guidance. Going forward, we see a reduction in the number of planes on the ground. Today we're already in a much better spot than we were a year ago, and actually we're confident that we turned the corner in terms of planes on the ground. We're back to a situation which becomes more bearable, and with that, in fact, we have a lot of opportunities to continue our growth.
So when you mentioned about supply chain challenges, what are OEMs telling you? How bad is it now? Is it expected to ease now going forward?
Well, when it comes to our situation where the planes were on the ground for some of the engine supply chain challenges, I think that actually we do see improving. And in the second quarter of last financial year, we were in the 70s. Today we're more like in the 40s. So that's a very, very significant improvement of that situation. When it comes to the delays which airlines all over the world are being faced for the planes itself, also there Indigo is in a good position. We have such a huge order book that we can deal, as much as I don't like the delays, we can still deal with some of these challenges and some of these delays.
Okay. Talking about your financial performance, you achieved 80,000 crore rupees in revenue in FY25 and over 7,000 crore in profit, in quarterly profit. How have you managed this, and what is your outlook for the next fiscal now?
You know, when you look at the revenue basis, very important that we have now crossed, or about to be crossed, that small group of airlines with a revenue basis of more than $10 billion on an annual basis. And that was an important milestone for us, which we have achieved last year. When it comes to profit, I think Indigo's cost leadership is a very important element in that. So we continue to invest in our customers. We started the loyalty program. We do internationalization. So for sure the revenue focus is important, but in combination with the revenue focus, the focus on our cost leadership is incredibly important too.
You mentioned cost leadership, and I must ask that just very recently, the CEO of a leading American airline said that the budget airline model is dead. There are no budget airfares. What is your view on that?
Countries and markets develop at different stages. The domestic US aviation market cannot be compared to the domestic Indian aviation market. First of all, I would say India is probably the most competitive market in the world. And we still have millions and millions and millions of travelers who travel by train today and want to go by plane. And if you go from the northeast to the southeast of the country, which takes 2 days by train, and now we connect directly from Guwahati to via Delhi to Chennai, I mean, that demand is still there. So cost leadership for us is important in order to make sure that we continue to offer affordable fares. But with that, we build on that with the aspirational travel. Where I'd like to make a small clarification, you know, budget travelers, low-cost travelers. Low cost or cost leadership, having low cost, should not be mixed or confused with having a low-cost proposition. I think the product we offer to our customers is really tailor-made. And the fact that now on our long-haul flying international to Manchester and Amsterdam, we start to offer hot meals. You know, a 10-hour flight requires a different service pattern than a 2-hour flight.
That's about service, but when we're talking about affordable airfares, you think Indigo's airfares are the most affordable, or there's more margin for lower airfares? There's potential there.
You know, the Indian markets, the Indigo airfares are a reflection of what's the situation in the market. You know, we always look to what are your competitors doing, what are you doing, and in the long run, airfares should be a reflection of the cost, which are out there in order to to deliver the product to our customers. We have been seeing a slowly uptick of that cost base, airfares. And with that, I think we have been able to make sure that some of the global cost increases in terms of supply chain cost, airport cost, overfly cost, have been found a reflection in the airfares as well.
Okay. The IATA AGM happening in Delhi in India is also a very defining moment for Indian aviation, but it also comes at a time when Indian airlines went through uncertain times with airspace closures, airport closures. You had to cancel 170 flights to border airports. Is the vulnerability index gone up? I mean, aviation business has been very vulnerable to external factors, but has the vulnerability index gone up? There are weather-related cancellations, disruptions.
Aviation, by nature, is connected to what's happening on the global stage. And even if one were to be a domestic operator only, the price of fuel is being determined by factors which are globally and not only locally. So I would say every airline is affected by what's happening globally, and then you have the rate of exchange, you have the fuel price. I think in India, the underlying demand and the underlying development of the economy continues to be there. So even when we had to close 11 airports and 170 daily flights for that time frame of 8 days, the rest of the country and the rest of the flights was in fact going on almost business as usual in terms of flights and operations. So from that angle, I think the underlying development of India is clearly supporting us to, despite some of the geopolitical challenges at hand, to continue our growth trajectory.
Have you
Okay, that was the CEO of Interglobe Aviation talking about the outlook in terms of market and how Indian market is very competitive compared to other markets. But on that note, we're going to actually slip into a very short break. After the break, we'll continue with our stock-related queries. But we are excited to unveil our brand new global business news channel, the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for Global Reset and Global Lens at 8:30 p.m. Welcome back to your stocks on CNBC TV18. We still have with us Shaina as well as Vaishali to solve all your stock-related queries. Thank you so much, ladies, for waiting by patiently. Let's move on to the next query for today. This is coming in from Gorang, who's writing to us from Chennai. He's holding 750 shares of Piramal Pharma. Price is 265 rupees per share, making a loss on this one. And he's holding it since November 2024. He's a long-term investor. Shaina, let me take this to you first. What should the viewer do? Piramal Pharma, yes, it does have that CDMO side of the play coming in, but has not done much in terms of a move. What should one be doing with Piramal Pharma now?
Yeah, Vinny, actually the CDMO side of the business has done quite well if you take the full year, FY25 versus 24. And even going forward, it is a segment which will do well for them, and it accounts for about 65% of their revenues. Having said that, I still would suggest a switch and relook at the stock a couple of quarters down the line. Exit now, because the US FDA had inspected their plant and they were issued some observations. Now, I think this could to some extent impact their growth for the current couple of quarters. So I would suggest exit now. And also, if you look at their ratios, most of the ratios, at least as of now, financial ratios, single digit ROCs. So, I mean, not very strong ratios also. So I would say exit and then relook at it couple of quarters down the line.
Exit and then relook at it a couple of quarters down the line. Is that the view, Vaishali, that's coming in on the charts as well? Or maybe it's a possibility that, the viewer can actually look to average at these levels as well, given in the last 6 months it's fallen almost 24-25%.
I agree, Vinny. Actually, it is showing signs of revival. We've seen the stock falling right from 310 and now to 207 levels. So there has been a long consolidation at these levels. I would say keep a stop loss of 190 now that you have held on for so long. Average it out. And I think there is a bounce back possibility coming to at least 230, 240. Once we see a clarity of the stock moving above 240 and sustaining, I think we are back on track for further upside. So for now, follow a range of 190 as stop loss and 230, 240 as resistance.
Okay, keep an eye on those levels over there for Piramal Pharma. Let's move on to the next query that is coming in from Kotesh, who's writing to us from Hyderabad. He wants to buy 500 shares of Hero MotoCorp, and this is for long-term investment. Wants to know whether it's a good deal to buy now, or shall he wait for some bit of a dip coming in for Hero Motor? Shaina, your view coming in for Hero Motor, and is this the best play in that one could have on the two-wheeler side?
It's not one of my topics in the two-wheeler side, and overall, I think the two-wheeler side is going to see a lot of competition. So even in my view, if one wants to be in two-wheeler, I would say Bajaj Auto looks better, in my view, with a even shorter term and even medium to longer term investment. Hero Moto on valuation basis is not too expensive. On a PE basis, current year it's about 16 times. Even on price to book, about 4 times. EV by EBITDA also, it's not really an expensive stock. Just about 11 times EV by EBITDA. Having said that, I think the increased competition is likely to, impact overall growth for at least the next couple of quarters, year, 2 years. So I would say if you want to be in two-wheelers, Bajaj Auto looks better as of now.
Okay, Bajaj Auto looks better as of now to Shaina versus a Hero Moto. On the charts, Vaishali, Hero MotoCorp, is it a good buy, or is it the view coming in that one should wait for a bit more of a dip here?
I would say actually keep a strategic buying, because the stock showed signs of bottoming out at 32, 3,400, and from there on it has started moving. So buy at every decline. And looking at the chart, I think the stock, at least for a positional trade, one can look for a target of 5,500 to 6,000 levels, and that would be quite a decent gain as far as trading strategy is concerned. But if you have to have it for a longer term period, let's see how it goes. Above 6,200, it could take off to higher targets. So for now, I would say buy at every tranche.
Okay. Buy at every tranche is what the view coming in from Vaishali, but keep an eye out on the stock going forward as well. Let's move on to the next query for today that's coming in from George, who's writing to us from Chennai. He's holding 310 shares of Welspun Corp. Price is 223 rupees per share. So he's holding it for a while. Stock is currently trading at 926. He wants to know if it's the right time to exit, or should he continue to hold this one? Should he, reap the benefits of the investment that he's made for a long time, Shaina? Numbers were good even this time. So what should the viewer do now?
Yeah, the numbers were very healthy, and also the order book position, especially the new orders that they're getting from the US market is quite good. Raw material also, I think they will be able to manage quite well over the current year. So I think everything is in place for them to do better going forward. And though the investor is making good money, I would suggest you can continue to hold.
Okay, continue to hold for Welspun Corp. You could still make some money as well. Maybe book out costings is possibility, but yes, continue to hold the stock. That's the word coming in from China. Vaishali, on the technicals, Welspun Corp, are you expecting more of an upside, closer to 1,000 now? Should the viewer be more greedy?
Definitely. The way the chartical formation is, it shows a lot of robust up move. And having said that, we have seen good 3-4 days of one-way upside move. But seeing the volume and the way it's moving, it's very likely this can go to 1,000 and 1,050 also. So continue hold.
Okay, 1,000, 1,050 also is the view coming in there. So you can get some bit more of a profit, at least on the technicals. That what is the indication is coming in. Our next query for today is coming in from Joseph, who's writing to us from Tamil Nadu, holding 1,500 shares of Lux Industries. Price is 1,962 rupees. He's making a loss on this one. The stock is trading at 1,486 rupees. Wants to know whether to hold or look to sell this one. Shaina, your view for Lux Industries on the fundamentals?
I think, one can continue to hold. It's a small cap with market cap just about 4,500 crores. If you see in terms of balance sheet, the balance sheet is strong. It is possible that, with textiles, garments doing better with some hopefully India will have better tariff rates versus China and other neighboring countries going forward, both for US as well as UK, and that should be a positive going forward. Now, having said that, I think fourth quarter numbers, the top line they showed a decent growth of about 15 odd %, but profits were impacted, margins, raw material cost was higher. So, but if you see for the full year, numbers were decent. So I think valuations also just about fair. I wouldn't say they're cheap, they're not expensive. expensive. So you continue to hold, and I would say that you could look for much better levels to exit or book profits or cover some of the losses.
Okay. Exit, book profit, or cover some of the losses. But that's a view on the fundamentals. On the technicals, Lux Industries, what's your view coming in, Vaishali?
I would totally agree. In fact, add more at these levels because this too has just making an attempt to come out of its oversold. So I think the worst is really over. Even for a short-term trading perspective, the near-term target I see is 1800, and above that we can see higher levels also. So if bought earlier and you want to average it, this too is a good level to buy.
Okay, can look to buy some more also is the word coming in from Vaishali. Let's move on to the next query. Purav Shah is writing to us from Gujarat. He's holding 650 shares of NCC. Price is 300 rupees per share. Holding it since November 2024. Currently, the stock is trading at 232. So wants to know whether to hold or exit the stock. Shaina, your view?
Well, the numbers were out just yesterday evening. Today, I heard the management also on your channel. And basically, the fourth quarter numbers were a mixed bag. So there was some disappointment. Having said that, I think, the clarity that we've got is that they have got a huge order book of, I believe, over 71,000 crores, of which a large part, over 30,000 crores, was received at the fag end of the year in March. So this would drive growth in the current year, and they are maintaining their guidance for the current year around 10% growth in revenues and EBITDA around 9%, which I think is quite decent. Balance sheet is strong, so I would say it's a hold.
Okay, that's a hold coming in on NCC as well. Balance sheet is also strong. That's the word there. Vaishali, on the charts and technicals also, would it be a hold?
Definitely, because this too, actually, most of these infra stocks are getting back in momentum, and likewise even NCC. So I'm looking at a good target of around 300, 320 from here on. So, but patience is a must, and technically well placed. So I would say yes, it looks bright for higher targets.
Okay, can continue to hold this one both on the fundamentals and technicals. That's the view there. Next query, Sanket is writing to us from Mumbai. He's holding 250 shares of Jupiter Wagons. Price is 615 rupees per share. Wants to know whether to hold or to sell. Shaina, we had heard all these problems coming in terms of executions. Seems like that's becoming a bit better, or the outlook that everyone on the railway side is talking that FY26, maybe that could be some bit of a better an improvement in terms of execution. Your view coming in specifically for Jupiter Wagons?
Well, if you look at it in the overall sector, compare it with the other railway stocks, Jupiter Wagons, in my view, yeah, they are improving in terms of, they are talking of improvement going forward. Last year was quite a bit of a washout in the sense, disappointment in terms of the execution. Going forward, it looks better. At the same time, I think valuations are a bit high. So if, in my view, you could switch from Jupiter Wagons to maybe a Titagar or Texmaco. I think they look better, especially Texmaco. If you look at pure valuations, they look a bit more attractive.
Okay, Texmaco looks a bit more attractive than Jupiter Wagons. That's the word coming in there. But, that was the last query for today. So thank you so much, Shaina, as well as Vaishali, for joining in with us on the show. As always, helping our viewers solve all their stock-related queries. And viewers, thank you so much for sending us your queries. Keep emailing us all your queries on the email address that is there at the top of your screens as well. But don't go anywhere. You have the last hour of trading that is still left, and closing bell will take you through all that action.
on market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Hang Seng is down 1.25%. Similar sort of losses being reflected on the Nikkei as well.
So Nifty found support once again at the 20-day moving average and moved higher. 24,840. So absolutely flat. Nifty Bank is up about 0.25%.
125cc plus segment has outperformed this 6% growth. It'll probably be between 8 to 12% growth.
We believe that yes, we are now in a position to continue to have this growth and then meet what are the stakeholders' expectations from the sector and from the Suzlon.
It's been a week that we've gone nowhere on the index, right? And today, even today, we are at the lowest point of the day.
The poll gave us a number of 6.85, but some of the responses I got after the poll was done were closer to 7. So I would prepare for an upside surprise to that 6.85%.
That on account of the concerns being raised, now they are scrapping this entire tender altogether, and that the future course of action is to be decided now by the Maharashtra government.
Small gold loan borrowers should not be adversely impacted by any kind of guidelines that the RBI has in mind.
So we are starting off the June series on a slightly subdued note, especially as far as the Nifty is concerned. But remember, the May series, despite all of the news flow, managed to hold on with gains.
Okay, well, that is the day so far. Markets are down 60 points. I mean, so again, it's a neither here nor there kind of a day because it's not much. The Nifty Bank, by the way, I think is up about 1/3%. Mid and small caps are doing their own thing, so it is very much a stock-specific day. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant Reema, Surbhi, Nigel with me here in the studios and the newsroom. Guys, hi, good afternoon.
Hi, good afternoon. It's been a nothing kind of a week, actually, not just day or afternoon, right? Because for the index, at least in terms of direction for the market as a whole, the Nifty has not found its clear intent. But I think individual stocks, that's what the week has been all about. And I guess that's what the last hour may be all about as well.
Well, that's right, guys. And y'all are three of y'all in the studio. So why is today a good day? There are three big factors. Why? Reema?
It's a Friday.
Okay.
Salary.
Yes. And?
Okay. 1 hour
End
ago.
of earning season. End of earning season.
Bingo.
There, got it.
Lovely. After spending so many years in the newsroom together, I think you'll know the thought process. Three big reasons to celebrate today. Salary, it's a Friday, and obviously end of earnings as well. So good times. Let's see how
I think there's some cake there as well, Nigel, in the newsroom.
Yeah.
Somewhere around, right? Pineapple cake.
Yeah, that's advantages of being in the newsroom and not being in the studio.
Prashant, it's only cake right now, imagine. Let's get to the markets.
Absolutely. And, markets, of course. But actually, market breadth is slightly negative. It's not bad in any way. And for the week, let me just see, look at so about 1/3% lower. So Friday to Friday, we're down about 80 points. That's it. So this is a absolutely flat kind of week, which is actually not bad. It's been consolidating. Last week was also flat, by the way. The week before last was the big one, when mid and small cap indices went up 7% and 9% respectively. Last week was spent consolidating. Nifty Bank this week, Friday to Friday, is up 370 points, which is not even 1%. So 0.6, 0.7% on the Nifty Bank this week. And let's just look at the small and mid cap indices as well. Small cap index is up 1.5% for the week. And I think the mid cap index will come up on your screens. That is up about 1.5% as well. So once again, the outperformance as far as large caps go continues absolutely unabated. So that's essentially going to be the focus here as we go forward. But I think, we have the last hour coming up. So let's get Mitesh in with a quick check on what the closing strategies are and what he'd want you to do. Mitesh, good afternoon. What do you have?
On the index, nothing much. What is happening and what is interesting is the Bank Nifty or the Bank Index. I think that's where some kind of a breakout is taking place. The Bank Nifty, sustaining above 55, 560, 550 zone is a positive. So as long as we are above that, good chance that this time the bank Nifty could clear 56,000 and even head towards 56,500. So we're positive over there. In fact, on the stock side as well, I have two banking names as the buy calls. One of them is PNB. So buy here with the stop at about 104. Look for a target of around 110, 11 to begin with, and then eventually 115 is what I'm looking at. Similarly, SBI is on buy as well. Buy here with the stop at about 800 and a target of around 835 can be looked at.
Okay, all right. You know, Mitesh, stay with us. I'm going to come back to you for Muthoot Finance. A quick call because Muthoot is surging as we speak. We, of course, put that story out with Rima earlier this morning, with Sapna, beg your pardon, earlier this morning. And, you know, the conclusion was, in that time, it was not up 7.5%. There was positive for gold finance companies. So what are the news? I mean, this is the Ministry of Finance, which seems to have examined the RBI draft directions on gold loans. And RBI is to ensure that requirements of small ticket borrowers are not adversely affected. So ticket sizes under 2 lakhs may be excluded from proposed directions. So this is a positive development, reduces the overhang on the space. Let's speak to the management of Muthoot Finance now, who is joining us. George Alexander Muthoot is Managing Director of the company to take some questions, to answer some questions. Mr. Muthoot, great to have you with us here, sir. Thank you very much. Good afternoon, Prashant here. So this is unambiguously positive in that sense. How do you read this?
I think, first of all, the fact that there is a consultative approach by the RBI and the Ministry of Finance is certainly good. And the views, the fact that Justice Muthoot, the government is also considering or keeping the consumer first aptitude. So that is the attitude which is definitely required, the consumer first. The earlier directions were not that good for small borrowers especially, and also for NBFCs. I think we had also given our suggestions almost on the same lines to RBI and the ministry, and I'm sure they would have both thought about it, and they are thinking of maybe revisiting the regulations, draft regulations once more. That's definitely positive because we have always felt that this is an industry which is serving the public, serving the consumers.
Mr. Muthoot, these are at the end of the day suggestions, right? These are suggestions. At the end of the day, the regulator will have to decide.
Yes, yes. So at
right?
least.
So that is so that is one. These are this is. I mean, they can only suggest, which is what this is. And second, which are the 1 or 2 top kind of things which, according to you, would have adversely impacted, as you said, the borrowers and of course then your business as well? Which the ministry is suggesting that gold borrowers who use gold as collateral be excluded from? Go on, sir.
Yeah, I think most of the suggestions earlier were based on the processes, controls, etc., which is fully welcome. But when the suggestions was about making it a little difficult for, or maybe a little more complicated for the borrowers and especially the small borrowers, that is what actually really would have affected and finally would have led the customers to go back to the money lenders. I think that was to be the biggest one. So I think now that people are thinking on that, as you said, the final decisions, final regulations have to come from RBI. But at least we have some, the ministry also supporting some of the views which we had given.
Mr. Muthoot, hi sir, good afternoon, Surabhi here. Just to dive a little deeper into exactly that point, the question that Prashant raised. Now, in that RBI consultation paper or the draft guidelines, some of the proposals that they were saying was to cap loan to value at 75%. In the earlier years, we've seen lenders go up to 80-90% as well. I think you've told us that you anyway try to keep it around that 75% mark in any case. Would you want to see some change around the LTV norm? Would it be something else? There was one more norm I remember, because this whole point of gold ownership, that the customer has to prove that the gold that they're coming to give as collateral, that they are legitimate owners of that gold. In many cases, it's, the family jewelry has been lying around for decades and maybe it's tough to provide ownership. So was that another condition that perhaps the industry is also seeking could be diluted? What specifically would you want to see a little diluted in the draft guidelines?
So I think you're not exactly correct when you say about LTV. The loan to value is already fixed at 75%, both for the NBFCs and the banks. It is only the question was some of the banks were maybe treating it as agricultural loans and giving more than 75. Otherwise, no NBFC can give more than 75%. Having said that, today the loan to value is only capped at 75% for NBFC. But having said that, at today's price, the average loan to value today in our books is only 58%. So people borrow only 58% because the price has gone so high. So
there's plenty of headroom.
Yeah, definitely. But 75% is good. We wouldn't want definitely the RBI to increase that from 75 to higher level. As an NBFC, as a largest gold loan NBFC, we would also not want RBI to increase the rate from 75 upwards. The second point is about the ownership of the gold. It is nobody carries a jeweler's bill with him when he comes to, or I don't know any one of us, neither you or me, has a bill for the gold which I'm wearing. So it is only probably getting an affidavit from the person that he has purchased it and it owns to him should be sufficient. That's what I think, a common sense approach.
And the purity, sir, I mean, there was also some, just tell us if there is anything in the RBI draft on the purity of gold, on whether it's 22 carats, all gold needs to be treated as 22, etc. Customers might be bringing gold, which is 18 carat. So on that purity part, would you want anything to be be made less onerous from what the RBI is proposing?
22 carat gold.
Yeah.
Just less than 22 carat, we have to actually convert it or maybe reduce the price to make it to
22 carat.
22 rate and then only give. That is already there. It's nothing new. It is already there. See, as I said, most of these regulations, process, etc., are already there. It is just once more reiterated and made into one single composite direction. That's all.
Okay. Sir, the Finance Ministry has also proposed exempting loans below 2 lakh for the small borrowers from this 75% LTV cap, right?
I don't think that is there. I didn't read it that well. But anyway, even if they propose to exempt it, I think as a prudent NBFC, we wouldn't like to give more than 75%.
What percentage of your loans are given to sub 2 lakh crore, 2 lakh rupees in terms of borrowing?
But I think more than 60% of our customers are below 2 lakhs. More than 70% of them are below 2 lakhs.
Okay, and the LTV for them is also below 75%.
I didn't hear you, please.
The LTV that you give out, the LTV for the small borrowers below the 2 lakh mark, for them also it's below 75% for you.
Yes, we have actually not distinguished anything below 2 lakhs or above 2 lakhs, etc. As of date, the regulation says we have to go only 75% maximum, and that is what we would like to continue.
So, sir, incrementally, I mean, from everything that you describe, in its present form, the RBI draft guidelines, which you're saying many of them have been in place already, in its present form also, you do not see it impacting business in any way, right? That would be a fair assessment?
No, I think the draft regulations had one or two issues about the LTV because the 75% there was some deductions, etc., to be made from 75%, which required some clarifications. That's which you had asked. I think now that we will have to do that clarification. So they were saying that not every loan can be given at 75%. Some loans have to be reduced from 75 to something lesser, etc.
Right, Mr. Muthoot, let me ask you the standard question in terms of guidance, since we have you on anything. Always say minimum 15%. Is that still 15%? Or
I'm sure it will be better than that, but I don't want to commit on record about that. But please wait for our quarter results. We will do that. Anyway, the business is quite good. Business is growing. A lot of people are borrowing, even at whatever. I said our average is only 58%. Still, people are borrowing because they need the money.
Yeah, no, absolutely. So, I mean, it's turning out to be a good month so far. I mean, this month, right? It's turning out to be a good quarter.
Yes, I agree.
And so just rechecking the average LTV across your portfolio that you are maintaining as of now, and this varies with gold prices, but as of date, it would be around, you said, around 54%, is it?
58%. 50, if you
58%. Today's gold price, 58% is the average LTV.
Yeah. If you take the weight of the gold and our total AUM, it is only 58%. Because everybody has not borrowed all the 75%.
As gold prices, if they keep going higher, that number will
going up so high.
It'll keep coming. I mean, the LTV will keep coming down. Thank you very much. Good speaking with you, sir, and appreciate. Sorry, you wanted to say something?
I think this is actually a very useful loan model, and people shouldn't make it very complicated. That's all. That's what we want to say. Don't make it very complicated. It's just somebody pledging his ornaments. If he wants to sell it, he would have got all the 100%. But he wants to take it back. That is why he's pledging and paying interest. So these people take it back, which is something which you should help them, not to sell the gold, but to take a loan of it and to save the gold. That's what is happening today. So don't make it very complicated, and there is actually no risk also in this. It's something which we always like to shout from the top of the...
it's a business you've done for, I think, one of the oldest players and done it successfully. And I think the ministry, of course, the government seems to agree with you. And that is the reason why they come out with these suggestions. Mr. Muthu, thank you very much for your time, sir. Good speaking with you. It's always a pleasure here on CNBC TV18. So that is the conversation with Muthu, which, by the way, is one of the big gainers with tremendous amount of volumes, great gains. What a move, 7%, 8%. That's a 160 rupee move coming through. And, just look at what the open was. Open was 2,073. So, and for the first couple of minutes, didn't do anything and then started moving higher. So it's been, it's come up gradually through the course of the day. Okay, what we'll do is we'll play out an interesting conversation. This is the conversation I had with Mark Mobius. He's, of course, someone who needs little by way of introduction, chairman of Mobius Emerging Opportunities Fund. And I spoke to him on our new program, The Global Reset, on CNBC TV18 Prime. We spoke uncertainties around tariffs and, of course, what this means for markets. Mark has a clear non-consensus view. His view, what is the consensus? The consensus is that US deficits will rise, dollar will be under pressure. That's the view. That's the consensus view. He thinks the opposite will happen. Deficits will not rise, and the dollar actually, beyond the near term, will actually strengthen substantially. Listen in.
I think the words that you use, things have been turned on its head, because Trump has done that actually for the global economy. He's basically said, look, folks, we're starting a new game. I'm throwing out all the old ideas, and now we're going to start over again so that the U.S. can get the fair treatment. And by the way, this kind of fair treatment idea is being extended to all around the world. Other countries in the world are beginning to ask the same questions that Trump is asking. But you must remember, Trump is a negotiator. He loves to negotiate. And the way he negotiates, of course, is start out with the worst possible scenario. So that's the reason why he said, I'm going to give you a high tariff. I'm going to kill all of you, and you're going to be all in trouble. And then he starts to negotiate down to a reasonable level. So now we're really in the middle of this. We're not finished with this negotiation, but we're beginning to see some light at the end of the tunnel. And I think people around the world, investors around the world, realize that at the end of the day, it's not going to be as bad as it seems. And probably we'll end up with a actually fairer trading system, which will be good for everybody. So it's interesting to see how this is going to develop. But at the end of the day, I think it's going to be much better than many people imagine.
The big, beautiful bill, as Trump has called it, should that put to rest any doubts of where U.S. deficits are headed? They're headed higher, much higher. Some estimates suggest additional 2.5 to 3 trillion in deficits by 2034. Some have pointed out that the bill which is now being pushed through is more of the same. I mean, tax cuts now, spending cuts later. What is your sense, Mark?
Well, it's interesting. You can see what the U.S. dollar has done. The U.S. dollar has weakened against many currencies. So observers and investors around the world are beginning to think, yes, the U.S. is going to be spending like crazy and the deficit will increase, which in turn will reduce confidence in the U.S. dollar. But I believe that this is not going to take place. What will take place is, oddly enough, a reduction in the income tax rate will result in increased income from taxes. We've seen that before. When you reduce the rate of income tax, the actual returns from taxes paid increases. That's number one. Number two, with the revitalization of industry in America, of course, it will take time. It won't happen overnight. But over the next few years, you'll see a much higher tax income from industry in America. Then finally, don't forget the tariffs. Generally speaking, the tariffs will be higher. The income from tariffs, particularly from China. Must remember, China is the biggest exporter, or Chinese imports are the biggest for the U.S. than any other country. Now, with the tariff on Chinese goods, that income, of course, will go into the budget of the U.S. So all of these factors are going to play, I believe, to a situation where the deficit will be reduced, not increased.
So you're saying lower income taxes, leading to sort of, more propensity to spend on taxes that way, higher collection from industries as industry in the US does better, and a lot of the tariffs which US will take in. So you're not of the opinion that deficits will be out of control in that sense, Mark, right? That's what you're saying.
That's right. I believe the deficits will not be out of control and will probably be reduced as a result of the resurgence of the US economy.
Okay, and as a consequence of what Mark said, I mean, he goes on to add that the dollar, because deficits are not going out of whack, deficits will reduce, which, I mean, actually I have not heard from anyone else, and this was an interesting point. The dollar will strengthen. Near term, maybe it weakens a little bit, but longer term, it will strengthen substantially. That's Mark's view. We're excited to unveil our brand new global business news channel, the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into the channel, CNBC-TV18 Prime, at 12 noon for the Global Reset. You'll find Mark Mobius on the Global Reset. The episode played out today. You can catch it on YouTube. And of course, later at 8:30 p.m., my colleague Parikshit hosts the Global Lens. Okay, welcome back. We got the market, which I think is absolutely, flattish, sideways is going to put it. But there are lots of individual movers. Kiri, for example, came up at the bottom of the screen, and Sudarshan will explain what's happening there, along with a bunch of other stocks in just a bit from now. We have Varun Goel, who's now with us. He's Senior Fund Manager, Equity at Mirai Asset Investment Managers. Varun, good afternoon. Great to have you with us here. Thank you for your time. I don't know if you got the chance to listen to the Muthoot management earlier. Stock's up 8%. I don't know if you own this name. You have a view. Go on.
I think gold finance overall continues to be an attractive opportunity. And I think whenever we see sharp spikes in gold prices, typically the companies or the various institutions which are engaged in this business, their ability to lend more for the same amount increases. So I think typically we have seen growth coming back to gold finance companies in times of big gold price movements, and this year looks like one of those years. So I expect gold finance companies should do well.
Hi Varun, good afternoon, good to see you in. So from the banks and financial pack, since we touched upon that first, what would you be most optimistic on? You know, the couple of conferences that have been held this week, the feedback that I've got is there's plenty of interest now in the PSU banks. They haven't done much, I think, for the last 12 months or so, but suddenly that interest level is back out there. Your take?
Yeah, good afternoon, Nigel. So I think broadly we expect BFSI companies to continue to do well. We have already seen 50 basis points of rate. The important thing is that looking at the weakness in the US dollar, I think RBI will carry out significant monetary easing because they don't have to worry too much about rupee now. And therefore, we believe RBI rate cuts could be front-loaded from this point onwards, and that should be good news. I think loan growth should stay resilient for system at a whole at 12-13%, and some of the larger public and private banks should be able to deliver high double-digit lending growth. And I think post the first 2 quarters, we should see stabilization of NIMs. And that should lead to good earnings growth from the second half of the year for most large banks and financial institutions. So broadly, we are pretty optimistic on this space. I think valuations are pretty attractive, both for public and private sector banks, and we continue to be invested in the same.
Okay, all right, got that point. Varun, hi, good to have you on. I remember you saying that the market and overall the economy should see strong cyclical recovery over the next 1-2 years. The question is how to play that. I mean, whether you're better off playing that. I think real estate is a sector that you singled out even last time, that maybe that could be a way of playing it. Beyond real estate, if the market is poised for good earnings growth, then which sectors, where will it show up first?
Yeah, good afternoon, Subhi. So our sense is yes, post economic slowdown and earnings, kind of a holiday in FY25. I think FY26 should see a lot better economic growth. So we expect Nifty earnings growth to move from low single digit in FY25 to let's say 12-13% in financial year 26. And we believe banks, telecom, IT, pharma will continue to be the drivers of that story. Also, please keep in mind that in FY25, there is a big decline in earnings of metals and oil and gas, because the refining margins were poor and the commodity prices came off. And that has impacted the earnings growth in FY25. And I think some of that will see good earnings growth on that low base. And therefore, we believe that journey to 10, 12, 13% kind of earnings growth is not that difficult. And our sense is with the benefit of these tax cuts and rate cuts, we should see economic growth coming back very strongly in the second half of this financial year. I think already the results that came in, I think they're either in line or slightly better than what we were expecting. And our sense is cyclical domestic-oriented sectors, be it real estate, capital goods, banking and financial services, auto, generally should see a good year going ahead.
Varun, the broad view, say a couple of months back, was this is the time to bet on large caps. And small caps went through a period of correction. From here on, would the buy still be with the large caps? Or do you think that as the earnings recovery plays out, then maybe in one's mutual fund, you should be biased more towards, lean in more towards small and mid-cap funds to make that extra money?
So good afternoon, Rima. So, of course, if you look at the valuations based on FY27, Nifty 50, I think, trades closer to 17 times. The small cap index trades closer to 19 times. But I think the important differential is that Nifty 50 will have earnings growth of 12-13% on a CAGR basis, whereas we expect small cap index as such to have a 20% kind of earnings CAGR between now and 27, and especially the base is very low. So our sense is, both the asset classes should do well. Of course, every investor needs to do his asset allocation in terms of large, mid, and small. In fact, we launched a small cap fund in January, and while the start was very volatile, I think things are beginning to look up. And our sense is for investors who have a 5-year plus investment horizon, small cap also continues to be a very attractive asset class.
Varun, how much of cash are you sitting on as a percentage of what you manage?
So Nigel, as a house, we don't take very aggressive cash calls. I think a couple of percentage points, but nothing beyond that.
Nothing beyond. All right, all right. The other sectors that were in focus, they ran up too much, and then they cooled off for the likes of defense as well as railways. I'm not sure what kind of exposure you have out there. Defense clearly has come back into play post the skirmish that we had with Pakistan on the border. But what's your view on both these two sectors? Because both of them have a long runway. Some of them have got very, very expensive on valuations, but there are very high interest levels. Your take?
Well, I also will be a believer in the defense story. I think it's a 5-year, 10-year kind of a story. And looking at the geopolitical situation that we have, I think defense is kind of a core requirement from a country perspective. So I think incrementally we would see more participation from the private sector. Of course, there are several defense PSUs which are doing quite well, and our sense is a lot more startups and private sector companies will also begin to participate. Valuations, though, of course, remain a challenge, and one really has to pick and choose companies which have visibility of growth at the right valuation. So we do have some exposure to defense space, and we would wait for some price correction before further increasing our exposure on the defense side.
Okay. All right, Varun, we'll leave it at on that note for this afternoon. Thank you very much for joining in. You have a good weekend, and we look forward to connecting again soon. Thanks for joining. Okay, let's just get back to the market and see what's going on. Not too much, 70 points down. It's still pretty much the same picture. Eternal is the big winner this afternoon, 4% higher, continues to charge ahead. I think we'll take a quick break on that note. Come back on the other side. We'll have our special segment, as always, D Street Chatter. Nimesh joins in with everything that's buzzing in dealing rooms today. And then some final trading calls coming up as well. Back in just a bit.
Welcome back. Well, the Nifty, has seen some kind of recovery. We're down only around 50 points. The bigger story, though, is in the broader markets. The Midcap index in the green and the Nifty Bank on its way towards that 56,000 odd mark, which has been a resistance for close to around 4 times in the last 45 days. That said, it's time for our favorite segment, D Street Chatter. Nimesh joins us to help us out with what he's picking up. Nimesh, what are the flows looking like? I think there's that MSCI rebalance.
Yeah, it's a quiet start to the new series, and the flow seems to be only regards to MSCI. So XF MSCI, even the flow seems to be quite muted as well. That's overall feedback. So while the number may look big because of the MSCI rebalancing, but X of that, there's not much to talk about. I've been saying consistently for the last many days that the traction seems to be clearly in the PSUs, and that continues to outperform. Whether it's good numbers or bad numbers, the stocks reacts positively. And today is a day for big breakout in the PSU bank index. And the banking stocks, PSU bank stocks are buzzing in trade, big volumes as well. I understand some bit of buying flows are also there in the PSU bank stocks. Yeah. So that's one sector which really stands out for me. And again, the trend of the block deals and fundraising, that's likely to continue. So that trend continues, but largely it's a quiet day even from a flow perspective, ex of MSCI.
All right, and Nimesh, I think the conference season is back, right? This week we had plenty of conferences. It gets busy post-work as well, and next week we have a couple of more conferences as well. But what do you pick up in terms of chatter?
Okay, in terms of individual names, the first couple of stocks where is massive delivery-based buying. Samvardhana Motherson as well as Interglobe Aviation. Despite a large block in Interglobe Aviation, a lot of funds bought, there is still buying from the open market in that stock as well as in Samvardhana Motherson. So expect high delivery volumes on both those names today. The second stock is Wokhart, up 10% and large volumes as well. I understand there are some strong flows at HNI desk, and also the street is anticipating some corporate development with regards to one of the molecules very soon. So that's a trigger for Wokhart. The third stock is Borosil Renewables. Post earnings has been in a very narrow range of late, but now understand the company is likely to raise funds via QIP very soon. So that's a fundraising trigger in Borosil. And the last stock is PB Fintech. Again, post earnings, the stock has been a bit of under pressure of late. But again, in PB Fintech, the indication is there could be a large block in PB Fintech very soon.
Thank you very much for that. The Nifty is still below the 24,750 mark. Bajaj Auto, top loser, 3% down. IT is on the back foot. HCL Tech, Tech Mahindra, Infosys, all staring at cuts between 1.5% to 2%. And you also have about a 2.5% knock coming in on Hindalco and Shriram Finance. On the way up, Eternal is the big mover. And then you've got banks like State Bank of India and HDFC Bank, which are helping the Nifty Bank outperform. That up move in the banking stocks in the last 2 hours came in courtesy SBI and HDFC Bank. Mitesh is now back with us for a few BTST calls for the weekend. Mitesh?
Yeah. I think, it's the banking pack, which I said earlier, is doing well. The rest of the pack, I think, is still dicey and tricky. So we had some long calls out there. So, we'll try and look at other opportunities where some shorting can, some negative positions can be taken, because the Nifty isn't, showing any clear strength to break on the upside. So I'll take a SCBT on Tata Power. He was talking about 395 half. Look for a target of around 385, and a BTST in Union Bank is stop at 145 to targets of 150.
Right, no, absolutely. Those are good ideas. Lots happening, right? I mean, it's a pretty vibrant screen out there. Mitesh, I don't know if you have any thoughts on IIFL. It's been slowly creeping higher. A lot of damage on the stock price. But a week after it's building a decent base, 2% today as well.
Prashant, IIFL has been in an uptrend for the last 4 weeks, and I think the strength is still there. I think it's the first target I have on the upside is around 450, 455. And in a good case scenario, even 470. So stay positive over here. I think any decline should be used to buy into this one.
Okay, all right. We'll leave it there, Mitesh. Thank you for your calls and appreciate it as always. Now, the Ministry of Statistics will announce the GDP numbers for the fourth quarter, India GDP that is, of last year and for the full year FY25. CNBC-TV18 poll sees the fourth quarter GDP at 6.85%, the full year number at 6.3%. Let's get a quick preview going. Lata is here with exactly that. Lata, over to you.
The poll gave us a number of 6.85, but some of the responses I got after the poll was done were closer to 7. So I would prepare for an upside surprise to that 6.85% that we got for the fourth quarter. The GVA is 6.5 for all respondents, and that's a more important number. Just for reference, the previous numbers are coming up for you in a table. Last quarter was 6.2. Second quarter was 5.6 and Q1 was 6.5. I'm giving you these numbers for a reason. I'll come to it in a minute. What is expected to fire well in the fourth quarter are agriculture, services like construction, finance, and public administration. That's the government services. What will not do well or is expected to lag would be manufacturing. Investment and consumption are both expected to do well, but investment will do a little better than consumption. Growth, that's the expectation. There is a large gap expected between GDP and GVA because of the lower subsidies, and that's important to note. So GVA, everyone expects at 6.5. The important part is the previous quarter's numbers may be recast. You remember that 5.6 in the second quarter? If that is recast, then the numbers can look very different. Then all bets are off. Then don't go by our poll at all. For the full year, the expectation again is 6.3. Again, if previous numbers are recast, then this can well be 6.4 also. Many people told us about that number. Upside surprise is what people are expecting.
Okay, all right, got that point. Lata, thank you very much. So we'll watch out, of course, for the GDP print. For now, let's look at a lot of the earnings reaction. We've had some outsized reactions over the course of this week and some even today as well. Stocks like Gujarat Pipavav, Sobha, Landmark Cars, Amara Raja, all of them reacting to Q4 numbers. Sudarshan is here with a quick roundup. So
we'll start with companies which are reacting positively after their Q4 FY25 earnings. And first on the list is Gujarat Pipavav, which has reported a steady set of earnings in this challenging environment. Revenue was flat at rupees 250 crore. Even EBITDA was flat at rupees 157 crore. And company has managed to hold on to margin above 62%. Next in the list is Sobha. It has reported a healthy Q4. Revenue was up 63%. Even EBITDA has increased by 52%. And collections were up 21%. And sales value have risen 32% on a sequential basis. Now coming to the companies which are reacting negatively to their earnings, and first one is Mazagon Dock. It was a weak Q4, but for FY25, company's performance remains healthy. Q4 margin was down 1400 basis points YOY and 2300 basis points on a sequential basis, but FY25 revenue and margin was above its guidance. Next is Landmark Cars. Revenue growth was healthy. It was up 26%, but margin has seen a contraction. It was down 120 basis points YOY. Amara Raja, it was operationally weak quarter. Profit was down 30%. Revenue has increased 5%, but margin has contracted by more than 300 basis points YOY. Next is Welspun Living. Growth for this company remains soft. Revenue was up 3%. Margin also remains under pressure. It was down 200 basis points, and company has reported FY25 revenue growth of 9% against its guidance of 10 to 12%. And also company has refrained from giving the guidance for FY26. Last in the list is Kire Industry. It was a muted set for Q1. Company has reported a loss of 85 crore versus loss of 10 crore in the same quarter last year. But EBITDA loss has narrowed. For Q4 FY25, EBITDA loss is rupees 5 crore versus loss of rupees 10 crore. But stock is seeing sharp downtick because in last 1 year, stock has moved higher by more than 120%. Okay, all right. Thanks a lot for that, Sudarshan. Well, let's focus on a couple of these pharma names, though. They as well are reacting to their numbers. Ekta joins us to run us through a few of those companies from the pharma pack. Ekta?
I'll start with Orchid Pharma. It has been down and out for the past couple of trading sessions, down 20% this week itself at current reckoning. Nuvama wrote a note post the numbers. They said that the base business pressure led to muted FY26 guidance, and they've cut their target price to 990 rupees. Alkem, the street seemed to be a little disappointed with the guidance. So the company is guided for high single-digit overall revenue growth in FY26. EBITDA margin guidance for FY26 is flat on a year-on-year basis, but for FY27, they're guiding for double-digit revenue growth. Wockhardt, there seems to be a turnaround on a year-on-year basis with a 6% growth in terms of revenue as well as lower losses. So revenue up 6% to 743 crores, margins 9% versus an EBITDA loss, and a profit, or rather a net loss of 25 crores versus a larger net loss of over 160 crores on a year-on-year basis. Concord Biotech, revenue up 35%, margins have expanded 200 basis points to 44% versus 42%, and Shalby, that one disappointed the street in terms of its operational performance. Margins came in at around 8% versus 16% year-on-year, and a net loss of around 11.8 crores.
Thank you, Ekta. But before we let you go, tell us about Apollo Hospitals. Numbers expected today. What is the street anticipating?
Apollo Hospitals this quarter, we are expecting a revenue growth of around 13% margins coming in at around 13.7 versus 13% this quarter. Now, and the profit should come in at around 360 crores plus. Now, in terms of key expectations, the street is anticipating around a 10% growth in terms of the hospital business, which will be led by a 5 to 6% increase in the average revenue per occupied bed, as well as steady occupancies. So the occupancy in Q3 was at around 68%. The overall growth is expected to be led by complex procedures as well as the international patient growth. That was steady in the previous quarter. International patient growth, it was up 19% ex of Bangladesh. Now watch out for Apollo 24/7 because the GMV was up around 11% in Q3 with around 2 million users. So one will want to see what that trajectory is this quarter. Overall, margins should also improve and be higher on a year-on-year basis.
Okay, all right, got that. Thanks very much, Ekta, for the details over there. Let's continue to focus on some stocks that have been in the thick of the action today, and Suzlon is definitely one of them. What a super move coming through, 10 to 11% higher through the course of the day after the company came out with Q4 numbers. We spoke with the management as well, sounding very optimistic on the current year, talking about 60% growth across financial parameters. We've got Vivek joining in with more details on what's powering the move. Vivek.
Well, Surbhi, looking at a 9% move on what is a very high market cap company with a very high equity base, 9% is a very sharp move and a significant market cap addition as far as Suzlon is concerned. But the main reason, like you highlighted, is the fact that the company has managed to have a very strong FY25, and especially Q4, they managed to end the year with a very strong quarter. Now, in terms of top line is up 73.2%, mainly on the back of the fact that deliveries for the S144 wind turbine has been very strong at 573 megawatt. On the back of that, revenues higher by over 73%. EBITDA, very strong operational performance as well, up 94% on a year-on-year basis. Margins expanding 200 basis points, coming in at 18.4%. And profitability, even if you take out the one-time deferred tax gain of close to 600 crore, even after that, it's a very significant up move, especially when you're looking at the profitability on a year-on-year basis. Now, at the end of FY25, order book quite steady. Company says it gives them visibility for the next 12 to 18 months, is at 5.6 gigawatt. And more importantly, the S144 wind turbine constitutes 91% of the total order book, implying that Suzlon now can look at a structurally higher EBITDA margin basis. As far as FY26 guidance is concerned, remember the company for the first time has actually given a guidance 1 year forward. WTG volume growth, revenue growth, EBITDA growth, as well as PAT growth, all are expected in the range of 60% on what is essentially a high base of FY25. So that is something the street clearly likes. And the WTG segment contribution margin is guided at 23%. Remember, the guidance for last year was in the range of 19 to 21%. So that too has gone up significantly. And the O&M business too quite steady, where the margins are structurally higher. So overall, a strong set of numbers from Suzlon, strong management commentary and guidance, aiding the stock up move today.
Thank you. Good time then to listen into what the management had to say.
Obviously, for the first time in our history that we gave a guidance saying that in FY26, we will grow by 60% minimum across the board. So that is not just giving a guidance of a number, and we are able to give a guidance for the first time, shows that we are now well prepared as an organization to see the future.
Okay, one more stock which has been under pressure all through the day has been Birlasoft. This is reacting to the sharp Macquarie downgrade, where they've double downgraded the stock from an outperform, and underperform, and the target price has been lowered by 45%. The new target price is at 350, which means more than a 10% downside from the current level of 400 rupees. The company, Macquarie, was bullish on Birlasoft. In August of last year, they had upgraded the stock to an outperform, and they were anticipating accelerated revenue growth and improvement in margins. But that didn't play out. If you remember the Q4 numbers, revenues were down more than 5% quarter on quarter. Year on year, revenues were down close to about 7-8%. Now, Macquarie is saying that for Birlasoft, revenue growth and margins will be subpar in FY26 and things will recover only in FY27. But, given the growth and the margin profile, the fair value that Macquarie is now attributing to Birlasoft is just a 15x multiple. Versus the 27 multiple that they had earlier ascribed. So that's the reason the sharp downgrade by Macquarie, the slash in target price to 350 versus 640 has put pressure on the stock today. Sudeep is now joining in. Sudeep, we spoke about so many companies. There was Birlasoft. Sudarshan was telling us about a whole host of stocks reacting to numbers like Mazagon, Shobha, then there was Suzlon. Anything that you'd like to talk to us and highlight?
Well, absolutely. I think Suzlon, the numbers were really impressive. And more than the numbers, I think the management commentary and management confidence was very apparent in the call. So I think this company is in for a good time. And the way they are progressing, I think, I won't be surprised if there is a significant upside from current levels as well as the time goes by. The other company I did look at and was disappointed was Mazagon Dock. I think the valuation at such a level, the company's valuation is that there is very little margin of error, and at that kind of valuation, if the performance is not as per the expectation, you will definitely be pessimistic, and that's pretty much what is getting reflected in the market today. The sharp drop in margin was disappointing. I think all these defense companies at the kind of valuation at which they are, the execution is the key, and that is where we have to focus on going forward. The other company where I think I did like the results and the commentary was Bajaj Auto. They are trying to do all the right things and ticking all the boxes. The margin is what they have focused on, and I think it's a very good thing. Export, they're getting a lot of support from the export market, and that's very, very good for a company like Bajaj. The only challenge is domestic market share and domestic sales of motorcycles, and that's where there is a bit of a challenge. They're trying to scale up stuff, but overall domestic market has seen pick up in volume in scooters and not motorcycles. So that's probably the reason why Bajaj domestic numbers were not impressive. But I think they're trying to do all the right things. Let's hope, let's keep watching the space as far as this is concerned. I think that's pretty much what did attract my attention.
In the defense, since you spoke about Mazagon and how there is no room for error, and Q4 numbers were no doubt disappointing. But even for a BDL, for instance, that's the one which came out with numbers earlier this week. I remember the stock was under pressure post the numbers. HAL, Hindustan Aeronautics, the numbers were fine, but the street was spooked by the guidance for FY26. Perhaps conservative, but just an 8 to 10% kind of a top-line growth. Now in the defense pack, given where we stand on the projections, the Q4 earnings, and the valuations, is there any defense stock which one can buy at this juncture?
Well, the only stock which I've been liking for last 1 year has been Bharat Electronics, and I continue to like that. The valuation has moved up quite a bit. And of course, post Operation Sindoor, there has been excitement in buying BEL, rightly so. And I do believe at some stage there may be a re-rating of this stock, because I think the potential here is immense. The company has been conservative and doing the right things. The order inflow last fiscal was nothing great. It was below expectations and below the management expectation as well. We probably will see a change in scenario during the current fiscal. Also, they have got into adjacencies like providing network support services for metro rail, which should help them. But defense itself is a large space, and they cater to all the three arms of the armed forces, which is Air Force, Army, and Navy. So export opportunities are opening up as well. So BEL, a re-rating at some stage is possible. And from a long-term investor point of view, I think that's a very good buy, considering their operational performance as well.
Okay, all right, got that point. Sudeep, we do have to take a quick break. Stay on, we'll have more questions for you in just a bit. But as we take this break, here's the good news for our viewers. India's business news leader is now just a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. You can download the app from the Apple Store or from Google Play. You just need to scan the code as well. You can straight away get to it from our screen. Welcome back. Okay, so it's going to end down. It's going to end probably 80 to 90 points lower. That's what the Nifty is poised for at this point in time. Quiet end to the week and slightly negative on the bias because the index has lost about 0.5% now, all things put together. So let's talk about the winner of the day and the loser of the day. The winner of the day is Eternal. The loser of the day is Bajaj Auto. And it's very clear. We, in fact, quiz the management on this as well. When will they start regaining their lost market share in 125cc plus, whether margins can sustain at 20% or not? Margins are fine. The problem is volume growth. What's your sense on the stock?
Absolutely right. I just was mentioning, Surabhi, that I think a couple of things have worked very well for them. One, they have remained focused on margins, and that's absolutely great. Exports have worked very well for them for a change. There were a couple of years back, you remember that they were struggling with the exports with challenges in Nigeria. Now I think that has been resolved and exports is doing fine. Now the whole issue has come to the domestic market, and that's where they are suffering. But look, I think the overall motorcycles were suffering and the scooters were picked up in numbers, and Bajaj doesn't have too much of strength in scooters as of now. So I think that's probably the reason why they suffered in the domestic market. But they are trying to do a lot of right things, and they're focusing on the core strength into motorcycles in domestic market as well. So that's a strategy. They're trying to gain market share, of course. Yeah, that's a bit disturbing. The market share loss in India is a bit disturbing thing, and I'm sure they will work on it. And market naturally is punishing them for that.
So buy or avoid right now?
Well, I think Bajaj Auto is a buy for me. I do keep the results.
All right. So it's a buy. You're keeping the faith on them getting back their mojo. Yes. Very quickly, Eternal. The winner of the day, what a move, 4.5%. Some of it is all strategic and tactical because of the index adjustments. But otherwise, what's your take? There's a big debate going on whether these, the expansion in the dark stores, quick commerce, whether that will keep eating into profitability and whether that will be a bit, long drawn. Your sense again?
So I think I've been mentioning this very clearly that if I have to buy one company in this particular space, I will buy Eternal. Yes, there are challenges in the short term, and that the management has come out very clearly and mentioned that margin may not be the focus right now. Expansion is the focus, and market share is the focus as far as the quick commerce business is concerned. And probably that's the right thing to do in this space. And that's what they're continuing. So if you are a patient investor, you want to be in this space, I think the opportunity for expansion for these companies is significant. And as Eternal is rightly positioned to capture that, they are the market leaders. And, in these kind of businesses, it is winner takes all. So it's better to be with the winner. So I still have faith in Eternal. Also, remember this entire correction was, kind of driven by the fact that this weightage change, and because they restricted the foreign shareholding to 49% to take benefit of some benefits in the business, which is allowed for domestic companies only. So they consciously chose that, and that's why all this rebalancing happened, which led to some selling. So I don't think I'll be too perturbed with this particular phase of selling or buying. I think we have to retain faith and remain invested if we want good results in this counter.
Got that. Ola Electric. The issue price was 76. Today, the stock is at 50 rupees. Very ballooning losses, 870 crore in Q4. The question is that if someone doesn't want to stay invested, Kotak has put a target price of 30 rupees. Can they sell at this level, or this is not the price to sell or buy?
Well, I think it is better to exit, and I've been telling this for a very long time that there are fundamentally a lot of things not going right for Ola Electric. Look at the number of customer complaints and the challenges which they are facing in the marketplace. The volumes are coming down. Of course, they would have lost market share, and they are losing market share. I don't think that's the point. The point is even the volume they're doing is having enough and more challenges. Also, the battery plant which they are putting up was a good thing at one point of time, but now considering everything, one is not sure, and that is definitely a drag on the overall performance. So at this stage, I don't think it makes sense to remain invested or buy into Ola Electric. It's better to book loss if you are sitting at a loss and exit the counter.
Yeah, no, absolutely. 4.5% lower. Seen a lot of price damage really coming through this week. Just a quick word, Sudeep. Good afternoon. on a couple of specific names here. So Welspun Corp, after a long time, moved almost 24% actually, Friday to Friday. Any thoughts on this one if you track it? A pipe maker.
I think it's a good space to be in, and overall we have seen some excitement in the entire pipe space. And Welspun Corp is also a part of that trend. We fundamentally believe that these companies will do very well in the near future with the kind of focus on construction, infrastructure, and overall capital expenditure, which the government has outlined and which private sector is also doing. So pipe companies will do well, and Welspun Corp is in a unique position to benefit out of that. And I think fundamentally it's a good script to buy from a long-term perspective anyway.
Okay. All right. Sudeep, we'll leave it there. Thank you very much for joining us. Have a good weekend, and we'll see you back next week. Appreciate it, as always, you joining in. Just to wrap out things, the Nifty is ending 0.4 lower. Nifty Bank is actually higher by about 0.6%. This is Friday to Friday. Mid and small caps, no real problems. Midcap index 1.2, small cap index 1.5. So higher. So this is the overall change that we had. And I just sorted the NSE 500 companies, NSE 500 stocks on the downside. And I really struggled to find anything anything we saw very large damage, or it's not a long list either. But lots of stuff, 10% and more, 20% and more, at least 6 or 7 names, decent names. So yeah, the broader market continues to fire and perform.
Well, in the large cap space, again, no big moves in individual stocks for the entire week. So the best performing stock for the week was Trent, with a gain of close to about 3.5%. Innocent Bank, despite the bad news about insider trading, Innocent Bank closes the week with a gain of over 3%. PSUs did well. So State Bank of India was also on the winners list for the week. So was Adani Ports, L&T, Dr. Reddy's and Bharti Airtel. On the way down, the losers on a week-to-date basis, not for the day, but it was Ultratech Cement, 5% down, Grasim, ITC, NTPC, Shriram Finance, Power Grid. These were some of the stocks with a fall of about 3 to 5% for this week. Well, we call time now on Closing Bell for the day and for the week, but don't go anywhere. On the other side is Editor's Roundtable.
Well, it's been a mixed week on Dalal Street. The Nifty and the Sensex are down for the second week in a row. But the broader market has actually fared a lot better, though the Nifty continues to consolidate. That's the headline. On this week's edition of Editors Roundtable, we'll, of course, decode the week gone by, all the trends and the top movers and shakers. We also put the spotlight on the big block deal buzz. There's no stopping those big block trades, and we saw several of them this week as well. So let's straight away get to it. I'm Surabhi Upadhyay, and with me, my colleagues Nigel D'Souza and Nimesh Shah, as always. And joining us on the show today is the lovely lady in pink, Devina Mehra of First Global. Devina, what a pleasure to see you here in person. This is a welcome change. So thank you so much for making the effort.
Thank you, and thank you for having me. And your guest relations are very persuasive, I must say.
They are.
Good to have you, Devina. And it's good times actually from a market perspective, from a personal perspective as well. And earnings season hasn't been too bad. We've come to an end of the quarter four earnings, which were not expected to be great. But they weren't too bad. What's in Nimesh? I mean, in comparison to expectations.
Oh, yeah, absolutely. Especially in the broader markets, but there was too much of pessimism and it's not disappointed. So that explains that despite, 2 weeks of flat Nifty and Bank Nifty, the broader markets have outperformed. So, Devina, your call. Have you looked at the broader market in terms of earnings? Have they disappointed? Have they done well?
Actually, I mean, in terms of what has happened in the markets, I was just looking at some of my podcasts from February because that was the time my book launched. So I did a series. And everywhere I am saying the same thing, that if you are waiting for a correction to invest, have you invested? So, and since from February, you can see how the market has done. Especially, of course, the Nifty, but even the broader market has not done too badly. So I mean, my position has not really changed. So I was never really that negative on the markets, and the kind of correction we saw is pretty much par for the course. If you look at 18, 20 years of data, every year you see that kind of move, and 23 you did not have a double-digit correction at all. So after 2 years, this much was expected. And yes, I mean, not just the earnings, I would say on the economy side also the news has not been bad. I mean, inflation has come under control for one, so that gives lots of room for RBI to do things. And for that matter, not because of so much the rupee, but the fact that the dollar has been depreciating against everything else again gives a little bit of room to the RBI. So in terms of policy, there is also a little more room than there was, let us say, 6 months ago.
So you think you've not been negative on the market. You think the correction is firmly... I mean, the question is, will we see more race towards better levels in our highs, or are we expecting more consolidation in the next few months? What's your sense?
That's always hard to say. Very short term, Surabhi, I never give a prediction. I never give a prediction in January or in the new Samvat starts that what do you expect, what's the Nifty target for 1 year, because that is something you cannot know. I mean, that for 30 years I've never given a number. So, but as I said, the point is that we are doing not badly. So it's always difficult to call the exact bottom. So nothing to say that the market can't fall a bit again. But always you have to look at the risk reward, which is that what is the probability and extent of the downside versus the probability and extent of the upside. So that's the way to look at it. And this is a data point I've given earlier also, that even in 40 plus years since the Sensex started, if you missed out on the 10 best days in the markets, you missed out on 2/3 of the return. You would think 40 years, 10 days is nothing, but that's 2/3 of the return. And the returns, that kind of mad up days don't come in a mad bull run market. They always come when people are questioning that should I be there, should I not be there, or as was the case 2 months ago, should I stop my SIPs? That was the question I used to get in open forums, that should I get out of the market? I said, you should think of getting out of the market only when things look very, very good, as was the case in 2024. I mean, not that you should, but I'm saying that's the only time you should actually think of it, because like in 2024, I had even family offices coming to me and telling me, my expectations are not crazy. I'd be happy with 30-35% compounding. I said, like,
red flag.
Very modest.
Right. But Devin, as you said, macros for India are looking pretty okay. You have the rupee that's fairly stable, crude oil prices being at very, very low levels. It's not that much of a worry when it goes up in comparison to, say, 2 decades or so ago. But it's still a positive from an India perspective. And the RBI, it appears that they're more focused on growth right now. So the macros are intact. The problem is in the globe. because we don't know what's going to happen in tariffs. We don't know what the central banks out there are going to do. In this sort of a backdrop, I think you just come back from overseas. What are your interactions with a lot of the big investors indicating? I'm not sure whether you went on personal or
no, I mean, I'm not looking for cues from other people, but as I was telling one of your colleagues that I write this fortnightly column for Mint.
Okay.
And while I generally write on investing principles, somehow in the last 4 columns, 3 have ended up being about Trump, because there's always so much news coming out of there and every day something is changing. But of course, also remember that people think that whatever US does will be reflected in the rest of the world, but that's not always the case, because the basic principle in markets is that themes change, whether it's countries, regions, asset classes, industries, the themes change. So if you look at the recent past, Europe has been outperforming US quite a bit. In our global funds and portfolios, especially since January, we've been underweight US, we've been overweight Europe, we've been overweight China for a little longer than that, we've been slightly overweight India also. So, and there can be a disconnect. Again, if you go back in history, if you look at 2003 to 2007, for instance, and it wasn't as if that US was coming off a high, it was still pretty down there after the tech crash. And still in those 5 years, it didn't do anything much. And in those 5 years, the emerging market index went up nearly 4 times. India went up 6 times. After doing nothing for 9 years, India went up 6 times in those 4.5 years. And Brazil went up 10 times. So markets can decouple. So, I mean, that's like just a story made up afterwards. So there are times, I mean, the NASDAQ high of 2000 was not breached decisively till 2015. So it took 15 years. So, I mean, people just extrapolate the recent past, ki 10 saal US has done well and everything was kind of lagging but moving along, but doesn't have to be that way. I was anyway looking that at some point the US outperformance would end. And I think Trump is hastening that end.
Yeah.
I mean, if you'd asked me last year, I would have said it's still abhi time hai, no, not that much. But like now, he's hastening the end of that outperformance, and more fundamental than just the immediate market thing. He's hurting something basic in what US has been, which is why markets have been treating US almost like an emerging market, because this is like the bond prices going down and the currency going down is a classic emerging market crisis situation. You don't expect the so-called risk-free rate of the world to behave like that.
Absolutely, but that's what perhaps when these things, it's difficult to wrap your head around it, that in the mecca of capitalism, the president of the country calls up one of the largest publicly traded companies and says, hey, you can't make your phones here, you should be making them here. This is real. This is 2025 and it's actually happening right in the US of A. But anyway, very quickly, just to recap the stats from this week. What have we done this week in the market? Absolute consolidation at the index level. And the market's been going through the fag end of earnings season. So the action has been very, very stock specific and the broader market has done well. In terms of the global setup, it's been more about dealing with this uncertainty on tariffs, because now we have a new element. The new layer is the legal layer that has been added to it, with the matter moving first in the International Trade Court in the US, and now it's gone into the Court of Appeals. So that's added a layer of uncertainty. India has underperformed both the US markets and European markets this week. That is something we cannot take away from at the index levels. The US market, by the time we are doing this discussion on Friday, they've done 4 days of trading. They're up about 2%. Likewise for many of the European markets, whereas our Nifty has been down, coming to the levels then. Down about 0.5% on the Nifty. Midcap index 1.4% higher. Small cap index 1.5% higher. Very, very stock specific action. Winners of the week, the PSU banking index actually has done really well, 4% up, and on Friday there were lots of PSU bank stocks that were gaining 4, 5, 6% or so. In contrast, the bank Nifty has risen only 0.5%, though it's better than the Nifty's fall of 0.5%. Capital market plays still fine takers. That index was up 3.5%, and the defense space still flying high for the week. The defense index has put on about 2.8%. Earnings hits and misses, just to recap, because we've actually had a good number of earnings hits as well, though it was the last week of earnings season. Suzlon, Cummins, Triveni Engineering, a lot of these stocks coming in and surprising the market very pleasantly on the upside. But then you had the misses as well, and 2 clear standout misses from the defense space, something we'll discuss with Devina as well in a bit. Mazagon Dock, collapsing 7-8% on Friday. Bharat Dynamics, very, very weak numbers coming through. So what's the focus for the defense space? We'll talk about that. There was also Amara Raja SJVN. So mixed bag of earnings is what we've had this week. And then the block deal bonanza. Just a reminder, you had Interglobe Aviation, you had ITC, BAT, British American Tobacco, coming out and selling a big stake in the market. All of it snapped up. Sagility, PG Electroplast. So the block trades have been keeping investors very, very busy as well. Going forward, it's RBI policy next week. We have to watch for that. And the direction of flows as well, which flows actually have been fairly positive. The question is, are they taking the cash markets higher, the regular markets, or is all that money getting absorbed in the block trades? And we'll watch for this as we go forward.
Yeah, that's right. I just want to add on to that because, Devina, in this month, that's the month of May, we have seen large trades with promoter catching out close to around 58,000 crores. The last time we saw this sort of a number, I think, was in August 2024 when we had 17.
How much of that was ITC?
ITC approximately
13,000 crores
So I think we'll get the breakup as well on the screen. So this is always a risk, right? Markets do well, sentiment is good. Promoters say, let's take some money off the table. So I wanted your view on that, but I'll just go through the data points first. The mutual fund industry, remember, they were sitting on very high levels of cash, more than 2 lakh crore. That was roughly around 7% as a percentage of the equity AUM. And if you look at it, a lot of large trades in the month of May. Bharati, there was close to 13,000 crores. ITC, that was another 13,000 crores, where BAT took some money off the table. They sold 2.5% or thereabouts. Interglobe Aviation, well, Nimish told us in detail. Mr. Gangwal, well, he's been taking some money off the table, but he's been taking money on the table from around 2,000 rupees all the way to 5,500 rupees. And still he's been finding buyers, and the stock price has been undeterred with what's happening on that front. There's a couple of other smaller trades. JSW Infra, we had PNB Housing Finance, Paytm, Nuvama Wealth, a lot of trades out there. So, Devina, earlier, say around 10, 15 years ago, when you say promoters taking money on the table, the street got very jittery. What's going to happen next? Is there the sign that, he's taking some money? PG Electroplast, the stock, the way it's done in the last few years, it's up more than 10 times. And now the promoter sells close to around 5%. But they're finding buyers and good amount of demand out there. What do you make of this? Earlier it was perceived negative. Now it seems it's fair. Market digests it. Okay, let him take some money off the table.
It's not just marketing digesting it. If I was advising the promoter, I would advise them to take, basically diversify your holdings. That is only prudent on how to manage your money. It is to diversify, not have all your eggs in only one basket. So it is not always a negative. It becomes a negative like last year at one point, it was not just 1 or 2 weeks, it was months of this. Then you become a little jittery. Also because last year, if you look at the IPOs, also a very big chunk used to be offered for sales, either from promoters or from venture capitalists. So when that becomes a pattern, it's a bit of a concern. But like, BAT selling ITC it is a one-off thing where I think they feel they don't control the company anyway, so they may as well cash out some of it at a good price. So if you really have to break it down. But as I said, when it goes on for months on end, that's when it becomes a bit of a concern as a pattern for the market. Otherwise, in individual cases, there is always a case to be made, usually a case to be made as to why you should diversify what you're holding.
Well, indeed, last year I was just saying in 2024, when Nimesh and me, we speak at around 3 p.m. And as Nimesh what said, he said, guess what? There's another large trade. There's another promoter wants to come.
That's what I'm saying.
There's another QIP. There's another OFS.
Somebody was telling me the other day, this is the best time to be a promoter in India. Large cap, mid cap, MNC company, you name it, and they can sell as much as they want
anything
and in cash and without any major stock impact.
Right.
You get impacted for 2 or 3 days, but then stock bounces back. I did a piece last week on Indigo. The Ganwals have sold stake from September of 2022.
That's what you were saying.
The only time this sold the previous block at a discount was the second block. After that, every block has happened at least at a 25 to 30% premium.
That's as much as that, 20-30%.
20-30% premium to the previous blocks, and they've done some 6 blocks till now. The first block at 1,800, the last block at 5,500. So, we've seen a massive, re-rating. The other thing I wanted to ask, Devina, because you've seen the markets for so long, and you've looked at a lot of history data. One thing between the leader and the incumbent, and there are so many examples. Like if you look at Indigo also, Indigo is at an all-time high. SpiceJet is virtually at an all-time low despite raising so much of money. Same is with Bharti versus Vodafone. What's your take? Should you be with the leaders?
That is not true of all industries. I mean,
which is what I'm asking.
Aviation is a particularly outlier example to take, because aviation, I say people forget history. Aviation mein, there used to be all these Damania, East West Airlines, Modi Luft, was all those gone. Then the next lot was this Jet Airways, SpiceJet, Kingfisher, which also gone.
It's a unique that Indigo is the only company which has made
but
money.
like for example, if you look at two-wheelers, it is not as if that only one company took everything.
No, but
Bajaj Auto, Hero, TVS, everything is done well.
They've carved out their space in the market.
Or for that matter, Eicher, which was actually
extrapolate to for other sectors as well. You spoke about aviation. Look at telecom. Vodafone is struggling, but it's at an all-time high.
Telecom is an oligopoly industry again.
Again, Ola versus
and then Jio came in, and that again, changed the dynamics completely. And also remember, telecom. This is something, I'd read, done some more than 15 years, probably 16, 17 years ago, which is that it has a natural limit. Telecom is because the number of people in a country has a limit. It is not something you will, in terms of number of subscribers, there's kind of a natural limit. And that's the pattern if you see in every country in the world. Telecom formed a particular pattern. So the Ps are high at one point, and then the subscriber growth kind of tapers off and the Ps compress. And so that's how it goes. So again, these are not it cannot be extrapolated to all kinds of industries, whether it is FMCG or autos or whatever, or for that matter, even banks. It's not as if that winner takes all is the story.
Speaking of FMCG, now just about beginning to hear some positive chatter around the sector, because it's been down in the dumps for I don't know how many years, right? Growth has not been coming in. But now with monsoons being favorable, etc., there are some pockets of the market that feel a revival could be coming.
Yeah, I mean...
Do you agree?
Yes. I mean, last two rebalances, our systems have liked more and more FMCG names, and we are now overweight FMCG.
Oh, okay.
Otherwise, like in 2020, when it was the hottest thing, I had done a half-an-hour program with your channel itself saying why FMCG doesn't always do well. This whole, myth that it's a predictable industry and therefore predictable stocks. Again, even if something is a predictable industry, the stocks don't always do well, so which people forget. But now the cycle, so the only company which we had bought early, I think in 21, was ITC, when it was not favored as a FMCG stocks. But now more and more FMCG stocks are coming higher in our rankings, and we have.
So anything that you'll have bought of late that...
So FMCG, as I said, in the January and April rebalance, we have added.
And what are the likely triggers that you see ahead?
I think it is not even, the stories often follow. So, I mean, of course, one good thing is that food inflation is down. So, in a household budget, food was crowding out the shampoos and the soaps and whatever else.
Yeah.
So, now that one negative is gone. Also, overall growth has, again, people were talking about consumption slowdown after the market fell. But actually, the consumption slowdown happened in 23-24. Private consumption in GDP was at its lowest level, less than 4%, after 21 years. So it actually picked up in 24-25, but people thought of it only because you need an explanation as to why market was falling. I said this year it's accelerating. So overall consumption has been accelerating. As I said, food inflation coming down is a big positive. Overall, even crude going down, generally the inflation of other things has gone down. So,
Devina, you want to give us a few names?
No, I mean, there are quite a few. I mean, there are some smaller players also. It's not just the larger ones.
Okay. All right, we need to take a very quick break, but the conversation is going to continue. We'll be right back in a moment.
That's my general
Welcome back. You're with us on Editors Roundtable. It's a very, very engrossing conversation, both on camera and off camera, as you can see. Devina was just telling us actually in the break that she's beginning to look at financials quite closely now. And Devina, next week we have the RBI policy, and estimates for the year range between, people say 75 basis points, some are even calling for 100 basis points of rate cuts from the RBI over the next 12 months. How are you looking at financials then?
See, first of all, rate cuts is, if you look at the theory of banking, when rates go up is when banking margins go up. Because what happens is that you reprice the loans immediately and the deposits get repriced slowly when they come for rollover.
But here I think credit growth, everybody is talking about whether credit offtake will really pick up in a big way or not. So your thoughts?
Yeah, I mean, I think it is more that there was a long period when banks underperformed. Long period means if you look at the last 5 years, 2020 onwards, 20, 21, 22, 23, 24, out of these 5 years, Bank Nifty outperformed the Nifty only in 22. Every other year, it substantially underperformed. In 2020, it was the only sector index in the negative. In 21, it went up, I think, 11%. Nifty went up 22%. So in 22 was the only time we, in our PMS, we were kind of market weight on banks. So as I was telling you, that my general stance is to be a very nervous investor in banks.
Which is when I heard that, oh, now you're looking at banks. My ears popped out.
I'm still not overweight, but we have added on the last 2 rebalances. We're still not overweight, but we have added definitely. And, because we think maybe the period of underperformance is behind us. And as I said, themes change. So maybe that's the thing that's coming back. But as I said, I'm always nervous because there are also many concerns on the credit side. I'm not so gung-ho always on the credit side.
What have you removed, Devina, from your, which has done so well, or maybe it's peaked out now, or fully priced?
See, capital goods, for example, we were overweight much before the market thought of it. From October 21, for almost 3 years, we were substantially overweight capital goods. Now we will not be overweight capital goods. Few other things we've kind of been out, like energy, utilities. We don't have anything much there. But FMCG now we are overweight. Auto components.
What about IT?
Pharma is one we have been overweight quite a lot from beginning of 24. Pharma and healthcare, we are. I think that would be in terms of the percentage overweight, that would be the highest.
Okay. And what do you like from pharma and healthcare? If you could just elaborate a little bit.
Quite a few. Again, I mean, there have been so many companies that have been coming up in our rankings that we have to kind of limit how many we buy, because a lot of companies are coming from those sectors.
What about Devina, on IT? What's your view?
IT, we would be, I think, just about market weight, slightly overweight. So we're not very negative, but I think it will still take time to take off. But I've never been very negative on, because that's still a predictable industry. And as per at least aggregate NASSCOM data, even if there is a slowdown in the US, India ends up adding market share over a period of time.
Devin, I wanted to ask you one more thing with regard to this marketplace, stock marketplace. Exchanges, they've gone through the roof.
Right.
You look at a brokerage, Angel One, that's up, I think, more than 25%. All of this in the last 45 days. BSE has moved up. And there is this financialization theme that is much spoken about here in India. And it could have a long runway. But at these valuations, what do you find? Where are you finding value? Exchanges, there is brokerages, there are wealth companies where there is plenty of interest as well.
Even custodians.
Custodians as well,
so
yes.
we had quite a few in that segment till middle of last year. We don't have that much now. I mean, we have some rating companies and all that, but we don't have a lot of the capital marketplace. We did have it till about middle of 24.
So you've taken profits basically on that.
Right.
Okay. Which brings me also to defense. I mean, such a wide debate because the stocks have been great wealth creators. So those who made money are very happy. Others have been watching on the sidelines feeling FOMO.
Yes.
Then we had the whole geopolitical situation in Operation Sindoor. Then again, everybody thought, okay, let's get onto the bandwagon. But when numbers come in, I mean, quarters remind us that this is not a straight line and some quarters can be really nasty.
Yeah.
What's your advice?
That is there. And the other thing which people forget is the risk of supplying to the government. So if you talk to the people who have been supplying to, and I was talking to one of the companies which is in a few other segments along with defense, and this is an older promoter, and I said, what about money getting money for your order? He said, yes, that's a problem. So this is, I mean, when I used to be a banker, and even after that, supplying to the government was always classified as a risk area. Because you don't get money first of all, you get it only when you are the lowest bidder, which means your margins are very thin. Then you don't get paid on time. Then usually in most government contracts...
But hasn't that improved now, considering there's so much focus on, now, in fact, this week was a week they've opened up aircraft manufacturing away from exclusivity to HAL. Now they're inviting more private sector participation. So, wouldn't get better?
And see, often there are overruns. You don't get paid for overruns. You are some part of the money is retained that let all this work properly, and then I'll give you and you have to sweat blood to get that money, and that's all your margin. So, I mean, supplying to the government is a big risk. In fact, I had written about this, and then one of the bank heads contacted me and said, we've started incorporating it in our credit appraisal, that supplying to the government is not a straight line. So.
All right, fair enough. So with that cautious note on defense and more cautiously optimistic on FMCG as well as on banks. Those are the sectors that they
and pharma and auto components, we are anyway overweight.
Anyway, overweight. Got that. That's an interesting mix. They've been a great conversation. Thank you so much for joining us, and we'd love to have you more often as and when your schedule allows it. Many thanks for joining us.
Thank you.
All right, well, folks, I guess it's time to say goodbye. It's a wrap. All right. So from the team that puts this show together, thank you so much for being with us. News and updates continue right here on CNBC-TV18 after a short break.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: a tepid Friday to close a lackluster week on Dalal Street. The Sensex and the Nifty end with cuts for the second week. Midcaps and bank stocks buck the trend though. A federal appeals court temporarily pauses a lower court's order to halt Trump's tariff juggernaut, allows the administration to keep collecting import taxes till the case is being litigated, also gives the US government some breathing room as it explores legal options on seeking relief from the country's highest court. The trade negotiations between US and China are a bit stalled, says US Treasury Secretary Scott Bessent, adds there will be a call between President Trump and President Xi to iron out differences. The government wants the RBI to spare small till January next year. Multinational companies under the GST scanner, sources say global capability centers and Indian subsidiaries of MNCs face inquiries on the export of services, client contracts and invoicing structures. That's an exclusive. Relief for L&T. The Mumbai Metropolitan Authority scraps two road project tenders worth 14,000 crore rupees after the Supreme Court raised concerns over L&T's disqualification. The state government will decide the future course of action. Yoga Guru Ramdev's Patanjali Ayurved faces government scrutiny for possible governance lapses. Sources say the Ministry of Corporate Affairs has issued notices seeking details of financial transactions. CBI arrests the Deputy Director of the Enforcement Directorate, Chintan Raghuvanshi, for allegedly soliciting a bribe. The CBI laid a trap after being approached by a businessman in Odisha who was summoned by the ED officials and was allegedly asked to pay a bribe of 5 crore rupees. The budget airline model is not dead in India, says Indigo CEO Peter Elbers, while adding low cost does not mean low proposition. Also says Indigo is following the law on flights to Turkey and wet leasing planes from Turkish Airlines. Promises changes to the network if the government takes a decision. Well, let's go straight to the big story that's breaking at this hour. GDP data is out and Q4 at 7.4%, Lata, well ahead of the poll.
Oh, absolutely. It's a very good number as far as the GDP is concerned at 7.4%. We did get a couple of respondents saying 7.2, but even our best respondent was not baking in 7.4. That's a very positive surprise. The GVA growth also is higher than what the street expected. My average was 6.5, and I think that's what Informist is also saying. But the actual number has come in at 6.8. Now, I'll tell you that 6.8 is more important than that 7.4 because you take the GVA, that's the output that the country, the economy actually produces. From that, you deduct net taxes and you get the GDP number. So the GVA to GDP, it all depends on how much indirect tax is collected and how much subsidies are paid out by the government. The lower the subsidy, the higher the GDP will look. So while GDP 7.4 is celebratory and, laudable, the 6.8 GVA is what I would think calls for much more celebration. It's much better. And everyone was agreed on 6.5. So it's a damn good number, 30 basis points higher. Agriculture has given a very positive surprise of 5.4. I got more like a 4 point something kind of average for agriculture. Mining sector at 2.5 was always expected to be subpar. Manufacturing 4.8 is bang on what I got from the poll. Construction sector, it gets counted in services. So that one has done very well, actually. 10.8. I did get a near double digit from some respondents, but 10.8 is a very good number. Just goes to show that government capex has kept up the pace. Real estate has kept up the pace. That's what brings a good construction number. Services sector more generally has given a 7.3% growth. And that has contributed, obviously, if the overall GVA is 6.8 and services are giving you 7.3, clearly what's lagged is manufacturing. Agriculture obviously cannot come to the 7% mark. At 5.4, it's done a very good job. But manufacture is the laggard, as our poll had indicated. Now, for the full year, the GDP number works out to 6.5%, much better than the best estimates we got. We got 6.3 average, with some people suggesting 6.4, but 6.5 is quite a good number. And that's because the previous quarter's number has been recast. The Q3 number, originally we had got it at 6.2 in February when the number came. Now it's become 6.4. So that's also adding to the overall tally. And of course, the Q4 number has brought up the average to 6.5%. So that's a very respectable number, a 6.5% growth on top of a 9.2 last year. Remember, last year's base is very high. On top of that, that's a damn good number. In terms of internals, again, it's very positive for the fourth quarter. Guess what? Capital formation has grown by 9.4%. I mean, that's very important because that's an investment in the future. It ensures better growth in subsequent years. Largely, it's government capex with private capex coming in only in some sectors like renewables and real estate. But nevertheless, 9.4, I think that's the best number for me in this entire piece. And private consumption also is not done badly, 6%. One would like it to be better, but urban consumption has stalled a bit perhaps. But 6% is something I would take with both hands. As we had said in our poll, investment will do better than consumption, and it has. What has let down consumption is government consumption. That's come in at minus 1.8. The government has done less of revenue consumption, revenue expenditure, more of capital expenditure. So all told, first cut, the numbers are extremely pleasant, very positive. If the stock markets were trading at this point in time, there would have been a cheer, for sure, a green cheer from the markets, a damn good number. But just to tell you how the bond markets look at it, if the growth is so good, why should the Reserve Bank cut too much? So what you're having as evidence from the bond markets is bond yields have gone up. Now they will factor in only 2 more cuts from the Reserve Bank and not, as some people said, 3 cuts and 4 cuts and the repo will go to 5%. That kind of expectation may get dampened, but that's immaterial. We don't want much help from the Reserve Bank. Growth is good. That's the message that the first cut of the numbers is giving us, Shireen.
Well, that certainly is the message being sent out by the GDP print. Growth is good and it's a pleasant surprise that's coming. But Lata, very quickly, just to get back to the laggard there on manufacturing, and if you can throw a little bit of light there on what that number reflects and what the expectation now is.
Well, manufacturing has lagged through the year. I mean, I don't know if you remember, 2 days ago, we got the IIP number for April. That's actually this year. That came at an 8-month low of, 2.8% or thereabouts. So something is not working as well in manufacturing. India has always been a services country. We've not been that good a manufacturing country. The 2 terms of the NDA rule has tried very hard to make India a manufacturing hub. But it's not succeeding as much. It could be that ease of doing business needs to get easier. When you speak to CEOs who come on the show, off guard, off camera, they will tell you that states are competing on unease of doing business. They are not competing on ease of doing business. It could be that. It could be that Chinese competition, which is pricing is opaque and competitive. So that could be one reason why you don't want to tread down that path. It could be a myriad reasons, but this has been, a laggard for us for some time now. I think it was last in 2012 or 13 that manufacturing was about 17% of GDP. It's now gone down to 13%. So clear services is doing very well. GCCs, all of them come under services. That may be the reason why manufacturing is static at the same place and services is taking off. That could make it look smaller. Be that as it may, our dream of making India a manufacturing hub as well and not just a services hub requires more effort, very clearly.
Well, yes, manufacturing has been a perennial problem over the last many years, but that's the big story. The pleasant surprise that's coming on the Q4 GDP print coming in at 7.4%. We will, of course, analyze the numbers threadbare. Lata will be back with us, with our experts to take us through the implications of what the number tells us. And as Lata was pointing out, if the markets had been trading, they would have cheered this number. But let's take stock of the markets and how they closed for the week. The Sensex and the Nifty closed with minor cuts after a volatile session, with the Nifty ending below 24,800, down by about 82 odd points today. The Sensex lost 180 points. The Midcap index closing flat. Banks, though, outperformed, closing in the green today. But for the week, the Sensex and the Nifty were down, and this is the second straight week that we've seen our markets fall for the week, falling though less than 1%. But mid-caps and the bank stocks bucking the trend. That's the story for the week. The Nifty down by 0.5%. The mid-cap index closing higher by about 1%, and was the case for the Nifty Bank. But let's head straight to the big global story. President Trump's tariffs will remain in effect, at least as of now. A federal appeals court in Washington has reinstated them a day after the U.S. Court of International Trade in Manhattan blocked most of President Trump's so-called reciprocal tariffs. Now, the appeals court has ordered a temporary stay on the lower court's decision while it considers the Trump administration's papers. Here's that story.
A U.S. appeals court on Thursday reinstated President Donald Trump's sweeping tariffs, a day after a trade court ordered an immediate block on them. The Court of Appeals for the Federal Circuit in Washington provided no opinion or reasoning for reinstating the tariffs. White House trade advisor Peter Navarro said that U.S. tariffs would remain in place for now.
The tariffs remain in place. The court told us, they didn't all but tell us, they told us, go do it another way. So you can assume that even if we lose, we will do it another way. And I can assure the American people that the Trump tariff agenda is alive, well, healthy, and
But the White House said the ruling had not interfered with any negotiations with top trading partners that are scheduled in the days ahead. Wednesday's order to block Trump's tariffs had given financial markets a brief boost, but Thursday's turn of events left Wall Street with no clear direction. Analysts said broad uncertainty remains over the future of Trump's tariffs.
Well, that's the latest there as far as the tariff battle is concerned. U.S. Treasury Secretary Scott Bessent has said that the trade talks between the U.S. and China are currently stalled. Bessent, in an interview with Fox News, said that a call between President Trump and officials, both nations had agreed to roll back most of their recent tariff hikes for 90 days. Here's Scott Bessent.
I would say that they are a bit stalled. I believe that we will be having more talks with them in the next few weeks, and I believe we may at some point have a call between the president and party chair Xi.
Well, that's the U.S. Treasury Secretary, and the Federal Reserve Chair Jerome Powell met with President Trump in the White House to discuss economic growth, inflation and employment. In its release, the Fed said that Powell did not discuss his expectations for monetary policy. However, he reiterated that the path of policy will depend entirely on incoming economic information. White House Press Secretary Caroline Leavitt said that President Trump believed that Fed is making a mistake by not lowering interest rates.
President and I both saw the statement that the Fed put out after the meeting. That statement is correct. However, the president did say that he believes the Fed chair is making a mistake by not lowering interest rates, which is putting us at an economic disadvantage to China and other countries. And the president's been very vocal about that, both publicly and now I can reveal privately as well.
Well, let's head back home now to the big story. The Mumbai Metropolitan Authority has scrapped 2 road project tenders worth 14,000 crore rupees. Now, this comes after the Supreme Court raised concerns over the disqualification of L&T's bid. MMRDA has told the Apex Court that the state government will decide on the future course of action. Ashmit joins us now to explain to us what transpired in court, what this means now for the MMRDA and for L&T. Ashmit.
Well, a big reprieve coming in for L&T. L&T was contesting as far as this MMRDA contract is concerned, the aggregate value being in the vicinity of 14,000 crore rupees. What's important is that at the technical stage itself, they had been disqualified, which essentially led to a challenge before the Bombay High Court. Then this matter travelled to the Supreme Court. The concern that had been raised by the L&T is that the other competing company, that was the L1, that was selected as the best bidder in this entire tender process, was Megha Engineering. And given that this was a reverse bidding process, their bid, the L&T bid, was 3,100 crore rupees lower than that of Megha Engineering. And that was an argument that was made before the Supreme Court as well, that why is it that a company, despite the disparity of 3,100 crore rupees, there appears to have been a concerted effort in favor of Megha Engineering and not L&T. Now, this inspired a great deal of shock from the CJI-led bench of the Supreme Court. He observed on numerous occasions that L&T is a name that inspires confidence. L&T is the company responsible for building the Central Vista project in New Delhi, also asking on a public money question towards MMRDA as well as to Maharashtra on the difference of 3,100 crore rupees on those bids. And that is something that we understand led to MMRDA going back to the drawing board, then coming before the Apex Court and clarifying that they're scrapping this entire tender process altogether. What they've now said, what they've told the Apex Court is that there will be a fresh process, but what means and modalities will be, that's something that the Maharashtra government will take a call on. But for now, this process where L&T was ousted has been entirely scrapped, and that has been conveyed to the Supreme Court.
All right, Ashmit. That's one of the big stories that you're tracking in court. But the other, the Delhi High Court has ruled that the amount paid by Indian companies to Amazon Web Services for cloud services cannot be taxed as royalty. Ashmit, this does come as a big win for Amazon Web Services. Take us through what transpired in court, what the order says.
Well, the order has very clearly said that, look, payments being made by Indian entities which are using Amazon Web Services, cloud services, those payments will not qualify as royalty and therefore cannot be taxed as such. That's the big takeaway. That's the assertion that the Delhi High Court has made, holding up AWS's aggregate position that they've conveyed before the Delhi High Court. Now, the issue essentially boiled down to two assessment years. That's assessment year 14-15 and 16-17. For these 2 years, the tax department had been looking at amounts that went towards Amazon Web Services. That's the US incorporated company. That amount for these two assessment years was calculated to be in the neighborhood of about 1250 crore rupees. The tax department's contention was that money being paid by Indian entities to AWS US qualifies as royalty, and therefore I will proceed to tax it as such. This is something that was contested first before the ITAT, then before the Delhi High Court. The Delhi High Court spelling it out very clearly that from their scrutiny of these documents, their scrutiny of the arguments, there is no case made out by the tax department for considering this payment as royalty and then subsequently taxing it. So on that front, a big relief coming in for AWS. This would have been a negative precedent for them if it went against them, given as how their cloud services have expanded here in the country. But this is not the final word. This is a Delhi High Court division bench judgment. The tax department does have the legal remedy of approaching the Supreme Court.
All right, Ashmit, many thanks for joining us. Now, Yoga Guru Ramdev's Patanjali Ayurved faces government scrutiny for possible governance lapses. Sources tell us that the Ministry of Corporate Affairs has issued notices seeking details of financial transactions. The probe will also scrutinize transactions at Patanjali Ayurved and is likely to take about 3 months to be completed. The scrutiny is based on information from other probe agencies alleging corporate governance issues. Now, multinational companies are under the GST scanner. Sources tell CNBC-TV18 that Global Capability Centers, or GCCs as they're commonly known, and Indian subsidiaries of MNCs are facing inquiries on the export of services. Timsy standing by with more. Timsy, what exactly is the DGGI, the GST authority, concerned about, and what is the industry response?
Well, that's right. Sources have told CNBC-TV18 that Global Capability Centers, or GCCs, and Indian subsidiaries of MNCs are currently under GST scanner. Several companies across business hubs like Haryana, Bengaluru, Maharashtra are currently facing inquiries from GST authorities on export of services, challenging the export status of these services. CNBC-TV18 has learned that summons and notices have been sent to firms that are offering back-end technology, education content development, marketing, design and R&D services to overseas clients. GST authorities at state and centre, along with DG GST Intelligence, are conducting this action, where they have sought detailed information on business models, client contracts and invoicing structures to determine whether these services are being provided as on own account or merely a facilitation that they provide. Meanwhile, industry claims that they are getting summons and notices for work done for foreign parent companies, and the government's interpretation of treating them as intermediary is incorrect. They also claim that companies are not arranging or facilitating supplies between two parties or two separate entities, but are providing services on their own account to foreign clients as exports. It is important to note that India is home to over 1,700 GCCs employing 1.9 million professionals and is expected to expand to around 2,400 GCCs employing over 2.8 million people by 2030. India is based trying to generate GCCs as the new upcoming sector, where it has generated $64.6 billion worth of revenue in 2024 and is projected to expand this to $105 billion by 2030. Now, to be seen is whether government steps in to get some clarity from the GST Council on this to iron out the issue between the authorities and these companies. Back to you.
Timsy, many thanks. Now, the CBI has arrested a deputy director at the Enforcement Directorate, Chintan Raghuvanshi, for allegedly soliciting a bribe. The CBI laid a trap after being approached by a businessman in Odisha who was summoned by the ED official and was allegedly asked to pay a bribe of 5 crore rupees. Dhananjay Khatri joins us now with more details. Dhananjay, what does the FIR say?
The Central Bureau of Investigation has arrested a Deputy Director rank officer of the Enforcement Directorate in Odisha in connection with an alleged bribery case. The accused has been identified as Chintan Raghuvanshi, who was posted as the Deputy Director at the Bhubaneswar Zonal Office of the ED. Raghuvanshi, who is a 2013 batch of the Indian Revenue Service officer, was allegedly caught red-handed while accepting a bribe of Rs 20 lakh from a Bhubaneswar-based businessman named Ratikanta Raut. The CBI had laid a trap, after which the businessman approached the agency to complain about the ED officer soliciting bribes. According to the CBI FIR, the complainant said that he was summoned for questioning at the ED office in Bhubaneswar in March this year. ED officer Raghuvanshi approached him and asked him to meet his another known accomplice referred to as Bhakti. Both of them allegedly sought a 5 crore bribe in exchange for settling a case filed under the Prevention of Money Laundering Act. Investigations revealed that the bribe demand was later negotiated and settled for Rs 2 crore. In this complaint to the CBI on May 28th, the businessman alleged that Chintan Raghuvanshi asked for a bribe to settle the case against him, but he does not have the means to pay that amount. CBI laid a trap and detained Raghuvanshi while he was allegedly accepting initial tranche of the bribe worth Rs 20 lakhs. The Enforcement Directorate has registered a case against Odisha businessman in 2020 for an alleged money laundering case. ED officers allegedly promised to close the case against him if he paid the bribe to him.
Dhananjay, many thanks for joining us. On to CNBC-TV18 exclusive. Indigo's CEO Peter Elber says the budget airline model is not dead in India. Speaking to CNBC-TV18, Elber said that low cost does not mean low proposition. He added that Indigo is following the law on flights to Turkey and wet leasing planes from Turkish Airlines, and said that the company and the airline will change its plans if the government takes a decision to bar any such arrangement. Take a look.
Well, I think there's two different elements. One is our flights operating into Turkey, connecting Indian customers to the rest of the world. And that operates within the boundaries and the framework of the air service agreement and is governed by the two countries. And Indigo is always compliant with whatever happens in terms of government regulations and framework. And if that were to change, we will adjust our flights and schedules accordingly. We have the 787s. The first one is in operation. More are coming by the end of this year. And those we're using for direct flights into Europe, contrary to the flight to Istanbul and then connecting to parts of Europe. So, of course, we keep a close eye on what's happening. We keep a close line with the government in making sure that we continue to be compliant.
Very recently, the CEO of a leading American airline said that the budget airline model is dead. There are no budget airfares. What is your view on that?
Countries and markets develop at different stages. The domestic US aviation market cannot be compared to the domestic Indian aviation market. First of all, I would say India is probably the most competitive market in the world. And we still have millions and millions and millions of travelers who travel by train today and want to go by plane. And if you go from the northeast to the southeast of the country, which takes 2 days by train, and now we connect directly from Guwahati to via Delhi to Chennai, I mean, that demand is still there. So cost leadership for us is important in order to make sure that we continue to offer affordable fares. But with that, we build on that with the aspirational travel.
Well, that's Peter Elbers of Indigo. With that, it is time for us to wrap up this edition of Business 360 with the big story coming in on the macros. A pleasant surprise there on the Q4 GDP print, racing to 7.4%. We will keep you updated on all the top stories of the day. But for now, a break. Back in a moment.
Hello and welcome to this very special Indianomics, where we are going to celebrate actually the state of the economy. India's GDP growth in the fourth quarter has raced ahead of estimates. The growth has come in, GDP growth has come in at 7.4%, well above the CNBC-TV18 poll of 6.85%. With this, the growth for the full year has also been upped to 6.5%. Our forecast was 6.3%. Now 6.5 was the central government's target. There is a lot more to celebrate in the full year numbers. If one looked at the way in which capital formation has maintained its pace, the way in which private final consumption continues to be robust at 7.2%. I mean, we were all cribbing about urban consumption. For the full year, a 7.2% is a damn good number, you will have to say. And even for the quarter, the private final consumption expenditure at 6% is a fairly decent number. Of course, capital formation has done even better. To take us through the numbers, we have a panel of experts: Kaushik Das, the chief economist at Deutsche Bank; Subodip Rakshit, the economist from Kotak Institutional Equities; Abhishek Upadhyay, senior economist from ICICI Securities PD; and Aditi Nair, chief economist at ICRA. Aditi and gentlemen, thank you very much indeed for your time. I know some of you are personally very pressed, and I'm deeply grateful that you all have made time in spite of your personal engagements. Kaushik, I'm going to start with you. First cut, what's the key takeaway from Q4?
So Lata, I mean, I did a show with you about the expectations of GDP as well, where I highlighted to you that the risk is to the upper side. And, you know, we had a forecast of 6.5% for GVA and 6.8% for GDP. But I wrote in my report clearly that the risk of, you know, getting a 7.5% GDP number is very high, given that, you know, subsidies have contracted by 45% in January-March quarter. So GDP, I'm not surprised. But if you look at GVA, we were expecting that momentum to improve to 6.5 from 6.2. But we see that October, December has also been revised up to 6.4. So from 6.4, we have gone up to 6.8. And it is quite a good, you know, momentum if you think of it, what was happening 2 quarters before that. So I would say overall, it's definitely a positive surprise, not just from the GDP statistical point of view, but even from the GVA point of view, that we are close to 7% in January, March of 25, which very few people would have expected.
Yeah, I agree with you, Kaushik, that very few people expected. After I finished my poll, I got a lot of numbers north of 7. Within the poll, I got 7.2 as the best number, and that was from Abhishek. So Abhishek, over to you. It is still better than what I would have considered optimistic estimates in my poll. You tell me what did you take away? As Kaushik points out, probably everybody was expecting an upside surprise on GDP, although they gave me their stated number. Everyone, like Kaushik, told me there is an upside surprise because the subsidies number is very small. So I wanted to ask you what you meant, what you made of the GVA number as well, which has come higher than your expectation of 6.5.
Well, Lata, so numbers are very close to what the government had estimated at 6.8 and 7.6 when they put out the second advance estimate. GDP at 7.2, we were predicting GDP at 7.2%, so slightly higher. Also, GVA at 6.8 compared with 6.5 we were penciling in. Most of the surprise coming from construction sector on the GVA side, which has grown much strongly, not just in the last quarter, but even in the third quarter, where the growth data has been revised higher slightly. Big picture, the fact that government spending is estimated to have contracted 1.8% in the Jan-March quarter versus government's earlier estimate that it would have grown something like 4%, and still we got similar headline numbers, indicates overall better underlying momentum than what we were thinking. Still, the big picture view still is that perhaps growth is not as strong as the GDP number indicates, and perhaps it is not as weak as what the first half growth was at 6%. It's likely that underlying growth would be somewhere in between at 6.5% or so in our view. That is because last quarter, again, there was a big surge in government capex, which has pushed up the overall gross fixed capital formation number very strongly. That was growing at around 9.6% in the Jan-March quarter. That growth will not sustain, but a normal level of government spending and a reasonable agriculture growth next year should still mean that we get a number somewhere around 6.5%. We are slightly lower, mainly because of risk from the external sector front.
Okay, come again. You're saying that there is a chance you will revise your current year's number?
We are at 6.3%, Lata, but that is mainly because of the risk from exports. From the consumption and capex growth outlook standpoint, we broadly expect growth to more or less flatline in the current fiscal year. The big question is how big the drawdown from exports is. As you would know, exports was the key driver of growth in the recent years in the COVID period, because advanced economies gave a lot of stimulus and we benefited from these exports. Exports could slow down this year. Just that we have two buffers here, if I may point out. One, services exports is a key driver of our overall exports, and they can be more resilient even if global goods trade slows down. And second, commodity prices have declined, crude prices are lower, and that offsets some of this drag from weaker exports. Therefore, we are slightly lower than 6.5% at 6.3% in terms of our growth forecast for this year.
Okay. I can understand that the global headwinds are keeping everyone a little wary, but the kind of gross fixed capital formation that we are seeing clearly should throw up greater productivity and output in the coming quarters. And private final consumption as well in the fourth quarter has grown by 11%. I mean, we were all worrying that urban consumption may have stalled and it's only rural consumption. But the gross macro numbers are clearly indicating that private final consumption expenditure has actually done very well. Government has lagged, but it was always expected to. Suhadeep, what would you take away from the consumption angle, from the expenditure side of the data?
So, Lata, I think one point that I would like to mention is that if you look at the third quarter, that print has been revised. So yes, the third quarter data has been revised. And hence, if you look at a momentum-wise, the fourth quarter number, that obviously moves up. So I think the difference between a 6.8 or a 6.4, 6.5 that we would have been expecting, I think much of it would be covered with the revision that we see on the third quarter front. However, and coming back to the point in terms of the consumption versus the investment side of things, I think the investment growth has been a very good print in that sense at a 9.4% in the fourth quarter. And that is reflective of the fact that there has been, the government has spent a lot in terms of the capital expenditure. This was a kind of a pent-up spending that was there, transfers to the states, etc., which went in the last quarter. Consumption, I think, and my view has been that consumption continues to be on a weaker footing. 6% growth after 8% growth in the third quarter is not something that's extremely strong. It's mostly being driven by the rural and a bit of the informal or unorganized segment. Urban consumption is still weak, and I think the 6% is kind of symptomatic and kind of reflecting that fact. And I think going forward, there should be a cyclical pickup, some moderate pickup that we should see in the urban consumption. But the fourth quarter number is not reflecting a strong consumption growth as such. It's mostly being driven with the investment side of things.
Okay, but the number I get is pretty strong, isn't it? If you only looked at the PFCE, it is 51.38 lakh crore compared to 46 lakh crore. That's a growth of about 11%. You're still not impressed?
Sorry, Lata.
Private final consumption expenditure.
No, so what you're seeing is, I think you're looking at the current prices. Okay. That's the nominal GDP. Okay. If you look at the real GDP or the real...
Sorry, yeah, go ahead, yeah. If you look at the real number, perhaps it's a different...
It's a 6%.
Okay, I'm sorry. I was looking at the wrong table, too many numbers. Aditi Nair, your thoughts. Are you convinced that now you may have to revise the GDP numbers upwards?
So, Lata, let me put it this way. We were at a 6.9% GDP growth for this quarter, and the upside surprise is equal both for the GDP and for the GVA growth numbers. So it's an interesting quarter. Both are 50 basis points higher than what we would have thought. So it's not that the net indirect taxes has grown faster and therefore there is a large wedge between the GDP and the GVA growth numbers. The wedge is the same as what was expected. However, when we compare the sequential quarters, you've got GVA growth going up by 30 basis points to 6.8%, which is a good number, no doubt.
Yeah.
The GDP growth is going up to 7.4% from 6.4%. So that's where, you know, the dissonance in terms of how solid the growth numbers are.
I get you. I get it. I mean, that's exactly what Subhadeep is also pointing out. In a way, he's only looking at the, I mean, since I asked him about consumption, if you look at the momentum from Q3 to Q4, it's not looking very great for consumption and it's not looking very great for growth, is what you're saying. You're therefore not going to, I mean, even from 6.5 going up to 6.8 is not a bad momentum, especially if you look at it from the second quarter. Second quarter GVA is 5.8, third quarter 6.5, fourth quarter 6.8. It looks like you're in the right direction, aren't you?
Yes. So my view is that when we look at the private final consumption expenditure growth over the 4 quarters, there is a lot of oscillation. You've got like a 6%, then an 8%, then back to a 6%. So this has been a very uneven year, even on a quarterly basis. Forget about the rural urban, which we keep talking about, that unevenness. Now, on the discrepancy side, also the numbers are quite odd. So typically when we get the first round of the expenditure side data and the discrepancy number moves a lot, we tend to expect that there will be large revisions going ahead. So some things which may not really be clicking very well with what we feel the narrative that we have for how the economy has been, it could well turn out that the revised data will be closer to what we were thinking before this set of information came out. So, for instance, I did not think that this was a quarter where there was such a strong momentum in the investment side. There again, the high frequency indicators are pointing to quite a lot of unevenness. So I think, you know, some of these things, maybe the revised data will be more in line with what we were thinking.
Yeah, no, revisions obviously make us rethink a lot of numbers. But I wanted to invite your attention, Kaushik, to net exports also. That has done extremely well. You just look at the imports number, that's fallen by 12.7% year on year for the fourth quarter, whereas exports have grown by 3.9%. So net exports clearly has contributed. I mean, do you think that that is one big point to note?
So there are a lot of data issues about double deflator and all, how imports are calculated. But generally, if you see the last few quarters, the net exports contribution to GDP is quite positive. And, you know, that's why we have got a GDP number close to 7.4 even in this quarter. Yeah. But Lata, the point is, if you cut through all the noise, real GVA growth is at 6.8. RBI, for all it's worth, would be looking at the headline number and, you know, reacting on the basis of those numbers. So I think 6.8 is a very good number compared to the last few quarters when people thought that India's growth has gone very low and, you know, we are much below potential. A 6.8% GVA growth is pretty good. And as I told you in the previous show as well, that we are not as pessimistic, you know, like others for FY26 growth. Our growth forecast is 6.5. And I'm telling you, probably there could be upside risk going forward, also because of a technicality of GDP deflator, where this year you're going to get WPI inflation only about 1 percentage point average, and CPI inflation is supposed to be around 3.5. So your GDP deflator could be 2.5%. FY25, I think nominal GDP growth has come at 9.8. Even if you take a lower nominal growth of 9%, and if you have a GDP deflator of 2%, you can end up with a real GDP growth of 7% just mathematically for FY26. I acknowledge that there are a lot of downside risks from the global, you know, developments that have been happening. But if you look at the domestic story, you know, April, September, the government would be spending a lot of capex, and compared to last year when they did not do anything, you'll get a very good year-on-year increase in April, September because of government spending. RBI has, you know, infused a lot of liquidity, changed their, you know, policy rates, 50 basis points, another 50 basis points will come. They've changed the macroprudential tightening. Inflation has fallen, tax cuts have been given. These are all very positive for consumption going forward. So, and consumption, by the way, is close to 60% of GDP. So if you get this consumption right and government is spending, even if private investment is low, I can't see how India's growth could be lower than 6.5%. If anything, there could be an upside risk as we go forward in the next few quarters. So that's my optimistic take.
That's a neat wrap on all the optimistic factors that are providing a tailwind for the economy. To it, I would also add higher than expected monsoon. And today I had Dr. Ramesh Chand speaking to us, and he believes that he was forecasting that the current year's agricultural growth also will be well over the FY25 growth will also be well over 4%, and he expects a repeat of that, given that the early signs from the monsoon are good. So given all this, yes, there is an upside risk. So we have to take a break, but thereafter my questions to all of you will be, is there an upside risk to your own forecasts for the current year? And secondly, should we tone down, therefore, the expectations of more rate cuts from the Reserve Bank? Those questions after the break. Welcome back. You're watching a special edition of Indianomics based on the GDP numbers for FY25 that have just been announced. The numbers are an upside surprise. Both the fourth quarter numbers and the full year numbers are better than the polls thrown up by CNBC-TV18 and other agencies. I've been speaking with economists Kaushik Das, Subhadeep Rakshit, Abhishek Upadhyay and Aditi Nair. Gentlemen and Aditi, thank you very much for waiting on, for your patience. Abhishek, first cut, is there a likely upside risk to your numbers, growth numbers for the current year?
We are taking balanced risk. Again, I come back to the global growth viewpoint. This year, exports would have contributed roughly 80 to 90 basis points the additional growth in the last fiscal year.
That's correct.
FY24 exports growth was around 2%. Last fiscal we got around 6% growth, which was a meaningful growth support. If we see a sharp slowdown here, then it will be difficult to get stronger growth. That said, assuming US economy doesn't enter a recession and global commodity prices stay soft, other factors are more benign clearly. Two points here. One, we are thinking underlying growth at the start of the current fiscal is 6.5, but it could well be stronger. In the past, what we have seen is whenever the informal sector of the economy is doing well, the tendency for growth is more towards upgrades rather than downgrades, which is possible again. And second, consumption has been the key weak point for us all through, last few years. But what we are seeing now is rural demand, which is the bigger part of the overall consumption pie, has started to do well. And with additional tailwind from, a weaker inflation that we anticipate this year, it is likely consumption growth could surprise higher. Finally, urban consumption, which is more global demand sensitive, but it has some tailwinds, as Kaushik mentioned, from income tax cuts, as well as the interest rate cuts from RBI, which should support that part of the economy. So yeah, the one way I'll put this is the downside risks at this stage appear limited, assuming global growth is not very, very, very weak.
Yeah. No, that's a nice way to put it. Let's not speak about upside risks when there is still a big global uncertainty. But Subhadeep, it'll be very difficult to argue for 4 cuts with such a growth, wouldn't it?
Yes, Lata. Argue for 4 cuts, it depends on the perspective, right? When we say 6.5% growth, from a policymaker's perspective, is it a good growth or a bad growth is a good question to ask. If you aspire for a 7.5% growth, and if you have inflation which is favorable, and when I say favorable, it is below your central target.
A mandated, yeah.
Yes. And then I think that's the point where you try and push growth as much as you can, because eventually a point will come cyclically. And that's the nature of cycles, that you will have to move the other side. But when you can push for growth, when you can support growth, you will work with the inflation growth mix that we have. Now, the point is that if you have a 3.5% growth in FY20, 3.5% inflation average, which is our estimate for FY26, and even if you have, let's say, 1.5% as a natural or a neutral rate, you have space to cut rates. If not by 4, you can have another 3 for sure. But my point is that whether it's another 75 bips cut or whether it's 100 bips cut, the context is, if we believe that 6.5% is good enough, then yeah, maybe 50 bips. But if we think that 6.5% is not what the potential growth of the country is, and the monetary policy, along with the fiscal policy, has to move towards at 7%.
Got it. Sorry, unfortunately out of time, so I'll have to rush the comments from Aditi and Kaushik. Aditi, take from Reserve Bank, how many cuts?
So Lata, I think we also need to focus on the fact that when we look at the annual GDP growth data, there is a very sharp slowdown between FY24 and FY25. Now, with CPI inflation averaging close to 3.5%, which is our forecast, and several months ahead where we want to have sub 4% monthly prints coming in, I do think that we could be in for another 75 basis points of rate cuts. 50 is, I think, a minimum. 75 is certainly possible at this point.
Oh, 75 possible. Kaushik, last word. You have the last word from RBI.
So Lata, since I'm the most optimistic on growth, therefore I would say only 2 more rate cuts. And that also 25 basis points in June, after which in August, I expect RBI to pause and they give the final rate cut probably on 1st October in the October policy, where the policy rate comes down to 5.5. Remember that RBI has infused so much liquidity, and with this dividend transfer, your effective easing has happened already another 25 basis points. So in June, if RBI cuts rates, you're probably going to see 50 basis points actual rate cuts because of liquidity. And I don't think you need to go below 5.5 on the repo rate. As I told you before, in 2019 calendar year, our GDP growth was below 5%. That is the time when RBI had cut policy rate to 5.15. Today, we are saying that growth could be 6.5 or between 6 to 6.5. Why should the repo rate go to 5.15? So I think 5.50 is the terminal repo rate.
Fair point. Actually, you're not alone, Kaushik. I think Abhishek shares that point of view.
But with a pause in August, I think people are just doing extrapolation every week.
At the moment, the market also may be on your side because the bond yields have moved by 5 basis points after the GDP numbers have come. So the new 10-year is at 6.22%. It was at 6.17 yesterday. And the old 10-year, which is really the 9-year, has gone up to 6.25, if I'm not mistaken. So clearly, the market believes that the good growth could put a leash on Reserve Bank's largesse. That's it on this edition of Indianomics. Kaushik, Subhadeep, Abhishek and Aditi, thank you very much for analysing the GDP numbers.
Hello and welcome. You're watching News Center. I am Ashmit Kumar. Now, India's GDP growth in Q4 has raced ahead of estimates. Growth of 7.4% was well above the CNBC-TV18 poll, which had forecast of 6.8%. With this growth for the full year touched 6.5%, which was the government's target. Lata now joins us with the full report card. Lata.
it is a much better than expected number with the GDP coming in at 7.4. Our poll was 6.85, but the later respondents were looking at a 7% and 7.2, but no one came with a 7.4. The important number to watch is GVA, because to GVA, when you add subsidies and subtract taxes, you get the GDP. And subsidies was very low. So it was expected that, that will make the GDP look good. But GVA also has come in at 6.8, whereas our poll was only 6.5. So there is clearly a momentum upside surprise to the growth. Q3 has also been revised higher from 6.2 to 6.4. So on a higher momentum, the momentum has been kept up in the Q4 economic growth. That means the overall picture is very good. 6.5 is the full year number. Our poll was 6.3. In fact, the poll across agencies was 6.3. All across, this is a better than expected number. The prime contributors have been, of course, agriculture, which was expected to do well. The full year number is 5.4%, and the quarterly number is a handsome 5% growth. So that's a very big contributor. Services also have done well, construction in particular. For the full year, it is 9.4%, and for the quarter itself, it's a solid 10.8% growth in construction. So clearly, government capex, real estate, all these have been firing well, and the rest of them have also chipped in terms of, public administration and financial services. What's not come good is clearly manufacturing, only 5.8%. That would remain a disappointment. And power and utilities also have not done too well, about 2.5%. The story really is services, which have done extremely well. You can look at GDP from the expenditure side as well, not just from output. Expenditure, you want to find out whether it was consumption or investment. Actually, both have done reasonably well. If you look at investment, that has grown by, about 9.4% for the full year. And consumption also has come in at 6% higher. 6 is not a laughable number. You would want it to be better. But, a year ago, we were struggling with just 4.4%. So clearly, rural consumption has picked up. Urban is still stagnating. But for the full year, we can be happy with a 6% consumption growth. Now, what all this means is when you have a 6.8% last GVA number and a GDP number of 7.4, it becomes difficult to expect that the Reserve Bank should be very large-hearted with both liquidity and rate cuts. So now the rate cut, a large part of the market is expecting 2 more cuts. So from the current 6%, the repo is expected to end at 5.5. But there were a lot of people expecting 5.25 or 5 to be the terminal rate. Those expectations come down now because the economy doesn't seem to require that much of crutches. So what has happened is that the bond yields have gone up by 5 basis points. The old 10-year has gone up from 6.25 to 6.29, almost 6.3%, and the new 10-year has gone up from 6.17 to 6.22. So expectations of rate cuts have receded a bit, but on growth itself, things are better than expected.
Right, Lata, thanks so much for that. An interesting analysis there. The numbers are impressive, 7.4 for Q4, but that could make the job of the MPC that much more interesting, that much more tricky. But on that note, let's go ahead. Chief Economic Advisor Anantha Nageswaran is addressing the media on the GDP numbers. Let's go across to him.
In the private sector, you can see that fourth quarter GDP numbers are at 7.4% year on year compared to the previous final quarter of FY 24, and then again on the right side you see the comparison between India's growth rate in January to March quarter compared to other countries, and India has again performed better than contemporary economies. In terms of the growth drivers, in trade is off season, so to speak, whereas industry has picked up quite significantly after the first 2 quarters of slowdown, and monetary policy may also have played a part in terms of boosting liquidity and credit conditions. Growth has maintained its overall growth rate throughout the 4 quarters. And as we showed, in Q4 in particular, again, private final consumption expenditure did quite well, and so did, in fact, the big improvement was in the case of capital formation in the fourth quarter. These are also, once again, as a percentage of current prices rather than constant GDP. We also want to show you, in general, there is a perception that, India's growth rate has slowed down after the first 3 years post-COVID, FY 22-24 and FY 25, 6.5%. I think it's important to understand that globally, it is a growth scarce environment. Some of you may recall that in the annual World Economic Outlook, semi-annual World Economic Outlook, that the IMF, International Monetary Fund, brings out April-October. The April edition came out badly a month ago, and global growth numbers have been revised lower for current calendar year 2025 and 2026. Now, if you look at India's growth differential in real terms, what we show here is that real GDP growth of India, the blue colored bar, real GDP growth of what IMF calls about 30-odd advanced economies, and the difference is the green line that is charted. So now the interesting thing is India's growth in comparison to the average growth rate of advanced economies was on the lower side in the boom era between 2003 and 2010, despite one COVID year in which Indian economy did quite well, even compared, not the COVID year, the global financial crisis year. Even then, the Indian economy did much better than advanced economies. And in 2009, advanced economies suffered a contraction. India's 2009-10 growth rate was actually on the higher side. But the point is, the growth differential in this period, post-COVID, the black line shows you, is higher than the growth differential in the boom era period. In other words, India's performance in a relatively growth scarce environment post-COVID, and in spite of the rising uncertainties due to geopolitical conflicts and trade tensions which predate 2025, I think India is actually holding up its growth numbers better than many advanced economies as well. I think that is something that we need to internalize quite a bit. That is why we put this chart together to show you that it is not the absolute growth numbers alone that matter, but how growth is holding up in an overall growth scarce environment is equally important. In the economy itself, as we now move into 25-26, how are things holding up? Because we are now 2 months into the new financial year. Actually, what is interesting to note is that both manufacturing and services, the purchasing managers indices on your top left, they are firmly in the expansionary zone. Then you look at the e-way bill generation, picked up year-on-year growth rate, actually improved to 23.4% compared to 20.2% in the previous month. And then on the bottom, you look at the average hotel occupancy rate in April was slightly better than March 2025. And then if you look at the port cargo activity, again, was much better than what it was in April 2024 and in April 2022. And growth in air cargo is 11.5% compared to 10% 1 year ago. So, or even for that matter, minus 4.5% in April 2023. So clearly, the momentum of the economy, which picked up in the fourth quarter, is continuing into the first quarter, and that's a good sign. Also, steady urban and rural demand. We covered many of this in the monthly economic review, but we just wanted to use this opportunity to share with all of you. If you look at the fast-moving consumer goods, in the fourth quarter in FY25, rural consumption was high single digits, urban consumption was slightly on the lower side, and domestic air passenger traffic in FY25 was consistently across all months above the previous 2 financial years. And vehicle sales overall, 3-wheelers, passenger vehicles, and 2-wheelers have been maintaining their steady upward momentum. We are giving you the year-on-year growth numbers for April 2025 in the small box tucked in between the 2 charts. And the tractor sales performance in FY25 was 9.4 lakh tractors sold, almost as high as 9.5 of FY23 and better than 8.7 of we all know very well that the headline inflation rate is converging towards the target, and the food inflation has eased. And it is a good news that the Met Department has predicted both spatially and temporally well-distributed monsoon in the course of the next few months, and that also augurs well. So I think the conditions are in place for a low inflation, steady growth environment supported by monetary policy and also the fiscal stability, which is resulting in a very, very record tightening of India's 10-year bond yield vis-a-vis the American 10-year Treasury note yield as well. And in terms of the external sector, core merchandise exports, what we call core is basically non-petroleum, non-gems and jewelry exports. Core merchandise exports was $344.3 billion compared to $320.2 for a growth rate of 7.5% compared to the growth rate of 0.1% in FY23 and 1.4% in FY24. So there was a pickup in the core merchandise goods export growth. And if you look at the performance in April 25, it is definitely doing much better than the previous two Aprils. In terms of services sector activity, the balance of services trade, the surplus of $189 billion, higher than 143.3, 162.8 surplus in the previous two financial years. These are FY24 is a provisional number.
Well, that was a chief economic advisor helping us decode those numbers. Of course, the headline numbers are very clear, 7.4% for Q4 of last fiscal. And as far as the entire year is concerned, it stacks up to 6.5%. Impressive numbers. That's the target that the government had been aiming for. With that, we're now heading into a very short break. But when we come back, India opens doors to foreign lawyers and firms with caveats. We decode the move with founding partners of Indus Law, the first Indian law firm to join CMS. Welcome back. Now, Indus Law has become the first Indian law firm to partner with CMS, a confederation of international law firms. It is expected to complete the onboarding by the end of this year, 2025. CMS has a network of over 6,800 lawyers operating across 45 countries. Now, the move comes just days after the Bar Council of India amended its rules to allow foreign law firms and lawyers to practice in India with certain caveats. Now, as per the rules, their activities must be limited to advising on foreign law. They can only operate in areas of cross-border transactions and international law. The firms cannot engage in litigation or appear before courts or tribunals. They also cannot establish any office or maintain a regular presence in India. Now, to discuss all of this and more, joining us now on the show are founding partners of the Indus Law firm. That's Avi Mukhtar and Suneet Katarki. Gentlemen, thank you so much for joining us. Mr. Dar, let me come to you first. As far as this integration with CMS is concerned, give us more color on that. Firstly, tell us what CMS exactly is for the benefit of our viewers and why this partnership is significant for you.
Thank you very much, Asmit. So CMS is, as you rightly called it, it's an organization which is a network of firms across the world, about 20 member firms with about 7,000 lawyers operating in 45 jurisdictions. So as a network, each firm is independent in its own form. You run your firm yourself, you are managed independently, but at the same time, you share goodwill in terms of the brand and you come together to work together across border transactions. So the CMS organization aims to seamlessly work across jurisdictions with CMS lawyers, but each member firm being independent in its own form.
Sure.
And what this means from an India perspective is that us joining CMS will now allow a lot of Indian clients to be able to do cross-border deals more easily. They would be able to locate lawyers in Latin America, East Asia, Europe, pretty much in every major jurisdiction outside of North America and Japan, where they can work together and give the best knowledge base for those clients looking out. And of course, this will help in bringing in fact, earlier in the show, you're talking about FDI. This will help in a lot of inbound investors coming into India and seamlessly navigating Indian rules, where we will be there as the member firm to help them.
Wonderful. Let me go across to Mr. Katarki now. Mr. Katarki, again, thank you for joining us. Next question, what I wanted to ask you is that at a time when we're looking at global value chains spread across multiple geographies, at a time when we have capital being mobilized from multiple jurisdictions, from a lot of tax haven island countries, how significant is this partnership? Is this the first of many? Are you planning more as an industry trajectory? Do you see more law firms tying up with their global peers?
I think it should happen. Look, at the end of the day, as you rightly said, global supply chains are global. There could be a client in Singapore who has a data center in Europe, who could be processing data of an Indian company. And therefore, when something goes wrong, you have to be able to advise across these jurisdictions in a seamless way, right? Anything can go wrong anywhere in the supply chain, and to be able to advise clients in the way that they would want, you would want to be present in all of those jurisdictions, so that every nuance of that jurisdiction you take into account while you give the right advice to the client. So that's the reason we did this. This is, I think, as an industry trend going forward, if you want to really service global clients, and more companies, Indian companies too, are becoming global, and that's a great thing to happen. You have to then follow the clients, and for an Indian firm to establish offices in 50 jurisdictions, 60 jurisdictions is going to take years and years, and clients, unfortunately for us, will be much faster than that, and we can't possibly keep up. So the best way to do this is to have this tie-up and with international law firms, where you can provide legal expertise across multiple jurisdictions.
Let me then ask a follow-up question. Intuitively, the first thought that you would have is that since you're speaking of greater integration, perhaps there is also a strong case for allowing foreign firms to India as well. Now, we've seen the rules being amended by the Bar Council of India. There's a window within which foreign law firms and lawyers are now allowed to participate, but it's not without apprehension. What's the big concern in the legal community about allowing foreign law firms and lawyers in India?
So I wouldn't think of it as a concern. See, the rules have been made to ensure that we start liberalizing, right? I mean, there is definitely a need to liberalize. It is important, like we just discussed, that even foreign clients feel comfortable that they have an international law firm whom they are comfortable with, also available to advise in India, but with Indian lawyers, with the expertise in Indian law. This is an enabler. Of course, the rules need more clarity. There is going to be more clarity. There's going to be more discussions, I'm sure, with stakeholders. International law firms will have more questions about, what we need to do, what are the requirements of registration, reciprocity, etc., etc. And we will, all these discussions will lead to more sort of progression on these rules and more clarity. And but this is a good first step.
Good first step. Mr. Dar, let me get your thoughts on it. Good first step is what Mr. Katarki is saying. But there's a very limited window within which foreign lawyers are allowed to operate. No Indian law, no litigation. They're required to register, required to get an NOC from the Law Ministry as well as from the Ministry of External Affairs. This, in principle, nod that has come from the BCI, the Bar Council, is this more tokenism, or do you see meaningful participation by foreign law firms?
Yeah, no, that's a very interesting point. I'll just clarify first that our arrangement with CMS is not based on this opening up that the BCI has done, although we are very happy to see that the government and the BCI are liberalizing. But our arrangement is independent of this. As I mentioned, it is more of a network alliance as opposed to a foreign law firm. So we remain very much at Indus Law, an Indian law firm, not a foreign law firm or an Indian foreign law firm. Having said that, I think this is not tokenism by the BCI. I think the BCI is very keen to allow, just like we saw in manufacturing a couple of decades ago, it is keen to allow best practices, upskilling, better training for Indian lawyers so that we can become world beaters. And as Sunit mentioned, it is very difficult for Indian law firms to become global on their own. So we will need to all join hands and grow along with our clients, because Indian companies are also becoming global increasingly.
Wonderful. Let me also ask you another question. In the spirit of more liberalization, that's the message that I'm getting from both the gentlemen on the panel. One opportunity that was in fact termed as a rather missed opportunity was the India-UK FTA. There was a lot of conversation, a lot of push from both sides for allowing greater legal trade. But that's not really reflected in the text of the document, in the text of the FTA. Do you see this as a missed opportunity? Perhaps more could have been done beyond just the rules that we've seen changed by Bar Council of India? Mr. Dar?
I don't see this as a missed opportunity at all. Indeed, for the UK, legal services is perhaps you can say disproportionately important for the economy. They have been pushing this for at least 2 decades. I think the timing of the BCI rules and the FTA are not an entire coincidence. But of course, the rules are open for everyone. So all reciprocating jurisdictions and territories, the rules are open for them. So it would be actually wrong to put it only in the UK FTA, if you see what I mean. It is open to even US firms to open law firms. So I think the government did the right thing by definitely discussing it a lot with the UK interlocutors, but not putting it into the text of the FTA itself and allowing us to chart our own legislative course in terms of this opening up.
We're running out of time, Mr. Katarki. I'll just come to you for a final comment. You said this is the first big step, the first important step that's been taken by the Bar Council of India. Where is it heading? Tomorrow, can we see a situation where we have a barrister from London perhaps fly in for a hearing in the Supreme Court? Is that the trajectory that we're on?
Could be, yes. And it'll be wonderful to see, as you said, more and more. And the reverse also, right? One of us going there and arguing before the Supreme Court there now, yeah? So hopefully all that will happen. I mean, ultimately, we must remember we are service providers. What we need to do is be able to provide the best possible service to clients. And if the client feels that the best service will come from a London lawyer, for whatever reason, arguing something in India, so be it. And if our clients feel that we should go there and represent them in the UK Supreme Court, and that's the best representation that they will get, so be it, right? So I'm very happy about this, and this is definitely the right direction. We are going global, and law services and law firms can't be exempt from it.
That's an interesting point, gentlemen. Thank you so much for joining us and giving us more light on directionally where liberalization in the legal field is heading. Thank you so much for your time. But that's all the time that we have. It's a wrap on this edition of News Center. More news and updates will continue right here on CNBC-TV18.
Who's the maverick and who's the goose, since we're talking about the
he's
wing?
the maverick. He's the maverick.
You're both pointing at each other.
I think we have more conversations with each other than our wives.
You've known each other longer than you've known your wives, so it makes kind of makes sense.
That is true.
People talk about the Flipkart mafia and all the startups that came about.
I think you're part of the mafia.
I think it's the startup university. Equal number of good decisions and bad decisions.
Yeah.
But the fact is that looking back, vision is always 2020. And I think we have that advantage building PhonePe after having seen the Flipkart journey.
I want to have the ability to look somebody in the eye and say that I have a clear path to profitability before I can say that I will IPO.
I think the business is in a good place, the org is in a good place, the sector is in a good place. If you're a market leader in the growth sector, I think it's a good time.
What are the top 3 things that you would tell a young entrepreneur today, which you believe are the non-negotiables?
If you're a first-time entrepreneur or you're below 30, you gotta swing for the fences.
And so how soon can we expect PhonePe to build from India for the world?
Ask the CTO. It's India's time to build for the world.
How do you look at competition?
Shamelessly, I think in our sector over the last 10-15 years, the most innovative by far and away has been Paytm, and we talk about this.
The right to win comes in from how we execute, but the right to play comes in from whether we have the building blocks to be able to enter a new business, even if we are entering late.
The Tatas empire, I see the Birlas or the Ambanis, or more recently the Adanis and the Mahindras. They have things that every new business can take for granted.
Hello and welcome to the Young Turks podcast. I'm Shireen Bhan. We're here in Bengaluru to talk to someone who bet on India's digital ecosystem well before India had its UPI moment. Digital payments was where it started, but the story of PhonePe is more diverse than that, and they're attempting to build it even bigger. Joining me now to talk about PhonePe and the road ahead and that much talked about IPO, Sameer Nigam and Rahul Chari. Gentlemen, thanks very, very much for joining us here on the Young Turks podcast. I'm going to start with exactly that. You, on stage in August of 2024, said that I want to have the ability to look somebody in the eye and say that I have a clear path to profitability before I can say that I will IPO. Can you look me in the eye and tell me what's changed today? What gives you the confidence of wanting to go for an IPO today?
I'm not sure I said exactly that, but...
Paraphrasing, but broadly that.
I think the profitability part of it, we reported we shared our annual report for FY24 already, and we were adjusted PAT positive for the first time, so I'm very happy about that. I think directionally too, I think the company's at a stage where I feel like the core payments business, consumer and merchant combined, is at a stage of maturity and market leadership where we should, hopefully from here, remain sort of very, very stable and hopefully quite profitable in years to come. Conditioned well enough to say without setting any targets or goals. I think it's the right time. I think the business is in a good place, the org is in a good place, the sector is in a good place. Payments is still growing very rapidly. So if you're a market leader in a growth sector, I think it's a good time.
So Rahul, did the two of you sit and have a conversation about it makes sense to do it now, this is the right time, this is the moment, and we should go all in?
Oh yeah, we have a conversation about everything. I think we have more conversations with each other than our wives.
Well, you've known each other longer than you've known your wives, so it kind of makes sense.
That is true. No, we did have a conversation. I think like Sameer mentioned, just given the current state of the org and the business, specifically on the core offering that is payments, given how exciting financial services and payments in India is, and the fact that we also have a few new businesses that we are diversifying into, we felt that this is the right time where the core business on the path to profitability, being able to actually nurture new businesses, is the right time to take PhonePe to the public markets. It is also a reflection of our maturity as a company from a compliance and governance perspective, that we are ready to actually take on this larger role. So yeah, we did have the discussion and felt that it's perfectly the right time to actually push forward.
I think we knew that we'd want to actually eventually list
because
a few years back, because we moved to India with that whole view.
Exactly. I mean, to pay a hefty bill of 8,000 crore rupees to reverse flip and move back to India, I would imagine had its roots in this eventual decision, right?
Of course.
I think directionally, if the right answer for a business like ours is to list, then this is the right market. I mean, I think we're very proud of the fact that we are a household name or brand in the country today. It doesn't make sense to list anywhere else. So I think the reverse flipping was a precursor towards an eventual listing someday.
But, I want to understand for the two of you, what's the motivation to list? I mean, we've had this conversation with several founders. Some have decided to go the IPO route and some have decided not to go the IPO route.
Sure.
Another one of your peers next door, Zerodha, choosing not to go down the IPO route, even though that is a very real possibility for them. What is the motivation to IPO, besides, of course, providing exits to whoever would want an exit?
So I think that last part is a big motivation for companies like ours that actually have outside investors. So Zerodha is a good example where
they have
wildly profitable and the family owns the entire company. So I think they can get the liquidity that they desire through dividends, but more importantly, they can keep investing in the future of that company also through their bottom line. We took a path which is, well, the sort of tried and tested path of getting outside in capital.
Yeah.
And it's also a very fiercely competitive market when you're actually trying to build on microtransactions at population scale. So we needed that capital. We didn't have it. So I think in this case, you have to have a steady liquidity environment, not just for us, employees, shareholders, current and future. I think that's one part of it. We're blessed. We don't have a rush on that front. We have the money to invest in all the businesses that we need to. We have really good investors, both. I think for us, it's more the nature of our business. We're just so heavily regulated across all the financial regulators now.
Yes.
Wanting to operate not just in payments but in other sectors also at population scale. I think the governance the stamp that comes with public governance standards is a higher order stamp than being privately governed. I think that's a big reason.
So, do you believe that because you're now regulated not just by the RBI but also by SEBI, and of course the insurance regulator as well, since you're now in the insurance business as well, that this need to IPO kind of gives you the added legitimacy as well?
I think that's the right word.
I think it's not just the legitimacy, just given the scale that we operate at on the payments business that is regulated by RBI for sure, but also on the other businesses, the scale that we expect to get to. It becomes more of a responsibility, like moving back to India, having a jurisdiction in India was one aspect of it. But going public, I think, becomes another responsible action by the company in terms of ensuring that being in the regulated space, we're taking all the right steps to give confidence to the regulators as well as the public who have placed the trust on us and our platform that we are the company that we stand for. Yeah.
But could you not have IPO'd even if you were still domiciled in Singapore? I mean, it doesn't stop you from listing in India. It does come with added constraints, but was that ever a consideration?
Not for the two of us.
No?
So when we started PhonePe 10 years ago, we actually had incorporated here. It's when we merged with Flipkart.
Yeah.
Because they were domiciled in Singapore, we became a sub there. I think to Rahul's point, we want to play in financial services, not just in payments, but in lending and insurance and broking and whatnot. And I think these are all not just sensitive sectors. These are, I think, sectors where the regulatory norms and the laws in every major economy in the world require you to abide by them.
Yeah.
And I think there's an expectation that you will list in that like sort of home market. So I think from the governance standpoint, the argument for the IPO, it just makes so much more sense in India.
Yeah.
I think even in terms of creating shareholder value, the number of my extended family members and friends and others who come in and ask, hey, can I ever buy PhonePe shares? That's what I want to solve for. If you're going to create shareholder value in the public market, I'd rather create it in home market, right? Why would I actually list and open up to HNIs and retail investors or DIs in some other market? I don't want to. I mean, there's no
Plus, I think we are a company, we take a lot of pride in the fact that we are a company that has been built in India for every Indian.
Yeah.
And used by quite a few Indians, right? Our ambition actually takes us to say that we'd like to be used by every Indian. We always talk about population level scale. With that, I think trying to take any other route, if we are going to be a listed company, I think falls short of the expectations we have set for ourselves and for the company, really. So we love the fact that we are a product that is recognized, used and trusted by so many Indians. And in that scenario, to actually list outside versus list in India, I think it wouldn't be as much fun at all.
So made in India, by Indians, for Indians, that of course is the ethos as far as PhonePe is concerned. But since we're talking about expectations, let's talk about the timeline. What is the likely timeline as far as the IPO is concerned? What's this process been like of putting everything together, preparing yourselves for an eventual listing?
I can't, unfortunately, speak to the timing just yet. I think we're working towards it, and I think we've said that formally now. Sometime in early Feb, we got the approvals that we needed from our board to start the process. it's been an interesting process, to say the least. I mean, just all the scatter gather of all the paperwork and all the participants. It's been like it's like launching another startup. So we're enjoying the process. I think like everything else we do, we go a little slower, but I'd like to believe a little more purposefully about the process. We're trying to make sure that we cross all our T's, dot all our I's, do it slowly enough. That's why I'm not putting a timeline to it.
Sure.
Hopefully not too far away, but I can't say yet. And before you ask me about valuation, that's a discussion that's not even started. That I'll answer after we're done with roadshow somewhere down the line.
In terms of the opportunity to grow, what's the kind of headroom for growth that you see in each of these businesses? They're nascent today. What could they look like 5 years on?
From a size, I think just because of the fact that payments reaches practically every Indian, our opportunity to create out of that cohort multiple Indias that deserve different kinds of financial services products, that's the opportunity. So that's what really excites us, right? Even in insurance, we've taken the path of trying to actually build out insurance distribution purely on the digital platform.
Right.
We've seen success with two-wheeler and four-wheeler, and we hope to replicate that how much of a time it takes on health as well as life. Today, we believe that the traditional modes of selling insurance are broken for a variety of reasons. They are either selling the products that is the easiest to sell, not necessarily right for the consumer, or it's being sold through the physical channel where the commission dictates which is the product that should reach the consumer. We want to solve for both, which means that get the right products and get them at the price that is right for the consumer. And that can be done only if you potentially take the digital-only route, let data dictate the terms, and then let the consumer make the choice. So I think that's really the opportunity on financial services.
The opportunity on financial services, but I also want to understand from you the opportunity as far as PIN code, which is more your baby, and how you see that playing out given the competitive landscape.
There's a national supply chain that reaches the last mile in every city in India. Goods already reach there. The pricing is really attractive. It's not like natural, the MRP doesn't change from a dark store to a white store. Capital being used to discount prices lasts only so long. We've seen the e-commerce cycles play out. Ultimately, you have to make money. So when you take the price discounting out, it's really the quality of service that they offer which is better, and the ability to actually find a large selection. That's the thing that digital platforms do better. But the model is to reinvent the entire supply chain. And I think the same is happening with quick commerce. I mean, there's dark stores in every neighborhood next to the retail stores, right? And I think what we are trying to do is say, hey, again, just like our insurance approach, can we go in there and build every single piece of technology required for a store to become real-time available?
Okay.
And I mean scanning your barcodes to get a digital catalog, and then having a pick and pack app, and then having an app integrated with third-party logistics, and having a full ERP so that all your orders go through this ERP and you know what inventory you have. And these are the real problems on the ground. They're not fun. They're very hairy problems to solve because every store has a different level of capability. But I think what gives us comfort is the fact that we can do these as skunk projects at a low-cost basis. You can work with 5 stores for 6 months. See, I think where we are blessed, again, going back to one, quality and patience of our investors and our own capital efficiency, we have the reserves to go slow and do it right. We're not rushing to our Series A and B and C. These are all businesses incubating within the umbrella, quite like multi-platform players in the West.
But this is not a skunk project for you.
Oh, no. I'm just saying that each of these experiments of trying to integrate a pharmacy store or a network of pharmacy stores in one PIN code in Bangalore, while I'm separately actually experimenting with, say, florists in Pune, I can run multiple experiments on the cheap. That's part of the reason, I think, why we're very excited about things like PIN code or in this. I mean, you don't have to start with a winning hand, but as long as the market's large enough and you have time, you either need time or capital, right?
We look at all the building blocks that it takes to build the business. We evaluate whether the IP that we have already created or the data that we have plays an important role or not. That becomes a decision to enter a business. Because that's our right to play. Right to win comes in from how we execute, but the right to play comes in from whether we have the building blocks to be able to enter a new business, even if we are entering late. And then we actually say that, do all of these add up to value for both the consumer as well as the partner that we're bringing on board? If those questions are answered, I don't think we really let market or time, in most cases, dictate when we actually launch and when we amplify.
I think there's learnings from the sort of conventional family business houses or the big ones, right? If you see
good ones or
the good ones.
Okay.
I mean, if I see the Tata's empire, or I see the Birlas or the Ambanis, or more recently the Adanis and the Mahindras, they play across so many sectors. I don't even mean verticals, like sectors, right? They all started with one that started making money, then built the second, and so on. But I think they all also have a common infrastructure. They have common corporate services. They have things that every new business can take for granted. Your starting point is also further along. It's not like PIN code is starting zero base. It's not like Indus or lending or insurance is starting zero base. The building we are in is available. The cafeteria is there. All of the HR and finance and other functions are around. So if PhonePe is 10,000 employees, there's the standalone PhonePe payments business would have needed, say, 1,000 people in the corporate functions. The incremental cost of 5 other business projects, maybe just another 100 or 200 on top. So the cost of incubating new platforms is also lower. Where it spirals out of control, if we decided to say, play the quick commerce game right now, I'm seeing the cash burn happening in the market. If we decided to play the quick commerce game with the cash discounting coming into play, then there's no end to it, because then you're going after market share. You're not necessarily...
So you draw the line there.
I think we've only once, and for a period of about 18 to 24 months, fought that battle. I think we got seduced into it somewhere around 2018 in payments. This is when Google and Paytm and Amazon Pay and others, everyone was going ballistic with cashback. We entered, and I think hard date, December 31st, 2019, we just said we are done.
Cold turkey.
We had we literally, like, we was burning $10 million a month. And we spoke to our board and said, we're going to test the metal of our product. We just went literally cold turkey, like just stop on the first. The partners were upset because we were fueling cashback for the ecosystem as an industry.
Yeah.
The entire industry was spending. I'm seeing that cycle still repeating out.
In quick commerce?
In payments
In
today.
payments.
I mean, now it's the new players who are doing it, right? The Navis, the Supermoneys, the Creds. The new players are doing it. There was a phase where Paytm and us and Google Pay did it. There's a phase where the wallets did it. So we did. I'd be a hypocrite to say we didn't play that game. We played it for the first platform we were setting up. Luckily, as Rahul mentioned, in lending, you don't have to discount. It's a category that always makes money if you play it right. Same with insurance, same with broking. So financial services anyway, luckily you don't have to burn cash. Commerce, you could theoretically burn cash. I've seen it now for a while. Not the game we want to play.
You know, if I could pick up on what both of you are saying and the example that you gave of how we've seen this conglomerate model as far as large legacy companies are concerned, is that the ambition of creating a digital conglomerate? I mean, the organizational structure certainly seems to suggest so.
I mean, I think one thing that both of us and a third co-founder, Boris, and we are very clear about, when we started PhonePe, this was not our first gig together. This is a second or third stint together. And we're old entrepreneurs, so we said, we want to build a legacy company. We don't want to be valuation chasers. We want to be legacy chasers. In that, like, we want to create an institution that outlasts us. Multi-generational is not a word you hear in the consumer tech space.
No, you don't.
So we said we want to try and do
a
that.
multi-generational great company.
Yeah.
Yeah.
You know, does it help? You talked about VCs, and very often we've seen this sort of play out. You bet on the short term as opposed to betting on the long term. And we've seen that sacrifice being, and it's a fine balance as well. But does it help then to have, Walmart parentage in that sense?
It definitely helps. I mean, they're 70 years in. They're massive. They're public. Families still got a very large share of Walmart. So in that sense, I think they're as patient capital would get in this space, right? So that definitely helps. I think they themselves have invested into multiple markets where they've taken long positions. So they're invested in that sort of long multi-generational play automatically. So that definitely helps. I think there's a meeting of the minds there for sure. Much more than we would have had if we were talking about early stage VCs. Especially during those cycles where there's hypergrowth, right?
Yeah.
It's very hard telling a VC who's put a third of their fund in your Series D, I'm going to stop cashback tomorrow because I want to test capital efficiency.
You wouldn't have been able to do it.
You wouldn't, because they'd be like, but I'm all in. I'm like, but I want to get all out of this game and play the long game, right? So I think it was the right time for us to actually get more sort of sovereigns and strategics in. We have Microsoft on the cap table. We do a lot of work with them. Qatar, Tencent, GA more recently. TVS. I think all of them are very, very patient. So I think, and it's a cozy small cap table today of very high quality investors.
But, does it worry you? Does it concern you? Because we're seeing this play out at this point in time of how companies are going to be viewed as far as their foreign shareholding is concerned. And, whether there is likely to be any regulatory change, any regulatory pushback.
I think for India to be globally competitive, we will need to compete with global players. So there's going to be an FDI entry route. Now the question is, am I competing with Google and Amazon and WhatsApp only, or is capital coming in? I don't think you can have one without the other. So I think we'll have to make a choice as a market. Do we become insular or do we compete? And I think for the last 15, 20 years, they've chosen the path of compete.
Yeah.
So to that end, I think this is irreversible, and I think we're better off for it as a market. I think the only limited concern that I have, obviously, not an ostrich, just looking at the world. I think there's a global trend against globalization right now.
Yes.
And I think that's the only one that I'm a little worried about. But I'm an optimist. I think this is cyclical. I think once people have met across borders, across shores or whatever, I don't think you get enough of each other. So I think the market will keep opening up from here.
I think India, for its scale of population, diversity of population and diversity of problems, we should take a view of what allows us to leapfrog the lack of infrastructure in the various domains, segments that we have, and choose the path that allows us to get there the fastest. Within that frame, if there's a choice to be able to say take local capital versus foreign capital, I think it makes sense.
Yeah.
But to actually elevate the conversation about capital and investors being local or foreign, at the same level of whether the problem to be solved for is right or wrong, I think is that's the issue.
Speaking of regulation, the other overhang, of course, now pushed out to 2026. But you've lived with this for the last many years. It's a 2-3 year cycle that keeps playing out. How do you deal with this? Are you now working with the fact that, look, we'll wait till 2026 and see what happens then? Or are you working with the fact that, look, we've got to be prepared for 2026 to actually happen?
I wish this were an app update that I could sort of work on, right? Some of this is just because the deadlines are cyclical, some of the build-up is. I'll say this. I think because this was the third cycle that just finished in 24 December, and because I think there's also, I think the media really starts dialing this up as you get closer, right? It's almost like this...
Are you not checking your WhatsApp every few days?
No, actually we don't.
And
I think honestly the ecosystem has become it. I genuinely think that media, because NPCI was reporting monthly numbers for all the players, unlike a lot of other segments, the attention to the leaderboard on UPI. Right now I see people reporting this person jumped to number 7 and that one jumped to number 9. It's like,
because 1 and 2 is done and dusted.
No, can you tell me? E-commerce is a decade older. Could you tell me who the number 7 and 8 player in e-commerce are? Could you tell me in food tech? Could you tell me in cap tech?
Or
could
do
you tell me in any
report
sector?
it?
You can't. Now the point is, because the data is there, it's a talking point.
Yeah.
And because they put this cap circular out, it's a larger talking point. I think this time, I think the comfort that we got, the comfort we were seeking was when we spoke to the policymakers, the regulators, ecosystem. I think one assurance that was provided was that whatever they do, I think there is a desire by the regulators to actually create a more diversified market. I agree with that.
Sure.
The fact that that burden is somehow falling on us did not sit right by us, and we express why. It can't be the entrepreneur's burden to actually reduce market share, and I think they agree with that at some level. But I think the approach to then get past this impasse has to go from circular to something else. And I think that broad understanding after 4 years of dialogue has happened, and it sort of it's translated into two things. One, everyone's agreed, no matter what happens, you don't hurt the customer. Not phone pays, not GPays, not ATMs, not the 10th persons. You just don't hurt the customer because payments is sacred. Second, newer players have to stop calling themselves smaller players you're small because you're new. And if you want market share, you can't just say, I want that. You got to earn it by differentiation.
Yeah.
And I think even Dilip at NPCI said this now. I think people need to give users new reasons
to move,
buy their toys.
Yeah.
So otherwise, it's aggregation theory, the rule of three, or whatever you want to call it. If these are free apps to the consumer and there's 100 of them, over time you have to trust consumer choice will converge around the best 2 or 3. That doesn't make the 20th app or the 25th app disadvantaged. That just means in perfect competition, you didn't prevail. And in the context of sort of this overhang, I'm hopeful before 26 arrives this time. There's been so much discourse around this publicly, privately, at the ecosystem level that I think they will unleash, hopefully, the next wave of innovation on basic interoperable UPI paradigms. You need one QR in any app to work. You need one app to work. Beyond that, everyone should be able to innovate. I think because of the cap, what's happened is innovation significantly slowed down. Because now what's happening is, the large players can't launch first, okay? The small players don't want to launch first. They want to get growth. So no one's launching. And I think that's actually the only way in which you change the market.
But, do you worry? And we're seeing this the world over at this point in time, including in the mother of, the capitalist markets like the US, where they're talking about breaking up large tech companies because of competition-related issues. So do you believe, while I get what you're saying, that you see this as a perverse regulation, anti-entrepreneurship, anti what you're doing, but do you believe that it's something that perhaps environmentally is gaining momentum?
So couple of things there. I actually don't think it's perverse regulation. I understand the intent.
Yeah.
I think the approach needs more thought. In the West, particularly in the West, nobody is going and saying ChatGPT should not have a lion's share of AI or Gemini can't, as long as neither of them does something to prevent the other's usage. Majority of the lawsuits are in the Google ecosystem or the Facebook one. And they're of two kinds. Facebook is staring at regulation or not regulation, I think activism around the fact that they bought out pretty much all their principal theoretical competitors.
Yeah.
Right? So they have every major social network in their stable. We've not acquired anything in payments, life till date. We built everything we have, and slowly and painfully, as we just discussed. So that argument here doesn't hold. We've not muscled anyone out using capital. And the Google argument, which is now playing out in 50 states and they're paying penalties left, right, and center, again had to do with abuse of monopoly, not monopoly. India had a anti-monopoly law. We removed that in law and took a position that abuse of monopoly needs to be demonstrated, and that lies with CCI.
Yeah.
Because if you don't remove that, you remove any incentive for anyone to innovate. If being the leader of something or being large in a sector in of itself is inherently bad, somebody then publish these leaderboards on day zero so that I know I don't need to actually go past some number, right? I'd like to believe that we trust our markets and our innovation cycles more than that.
Secondly, I think specifically to UPI, there's no barrier to entry. You still have new TPAPs, apps coming in practically every month, right? NPCI is trying to create a more vibrant environment. It is a completely interoperable platform, which means effectively the consumer is not tied to any specific app, but it's a choice that they can easily migrate from one app to the other. In fact, many consumers have multiple apps.
Fair enough.
So it isn't a monopoly by design or force. It is, first of all, it's not a monopoly. We talk about
a closed loop system.
It's not a closed loop system. It's consumer choice that is ultimately playing out. There is no barrier to entry. You have some of the largest conglomerates like the Tatas entering.
Yeah.
You have completely new startups that are getting funded on the back of their play in UPI.
Yeah.
In such an environment, it's very difficult to actually see why consumer choice playing out with one or two apps is really a problem.
There's another very important element here. It's not that any of the tech conglomerates in the West are just really large or they're abusing monopoly power. there, China, other markets. I think the activism is coming about because they also have pricing power in the advertising market or in particular like device markets. Who are we charging in UPI? Who's anybody charging? I mean, we are waiting to actually make some money. So I think that
like to charge
that's central.
But that's gone cold, right? That discussion has gone cold.
I know, but I'm just saying, if the entire industry is saying we need a direct monetization vehicle, clearly the problem is not that we are sort of price gouging. PhonePe is free, GPay is free, the 10th app is free, the 50th app is free. They're all free.
How many do we have, by the way, as of today?
I don't track these, but I know that it's well over 30 at this point. I mean, last I checked, there's more.
There's more.
More.
There's definitely more.
Right
I think if you put together all the bank apps, you put together the other apps, they're significantly larger, but they're all options. They're all options for the consumer.
Yeah.
So there are quite a few apps that actually work on UPI.
this is not your first rodeo. You've both have been around the block and you've done this several times over. And I want to go back to the Flipkart days and the Flipkart Association, because I was telling Rahul before we started that in many ways, you know, what HUL is to sort of the legacy companies as the CEO factory, Flipkart kind of has done that for the digital ecosystem, has it not? And you're kind of part of that story in many ways.
Flipkart, I think
over 100
people talk about the Flipkart mafia and all the startups that came about. I think
you're part of the mafia.
I'm saying I don't think people understand. It's not just in Bangalore. I think the change in psyche in 20-year-olds and even late teenagers today, where everyone wants to actually get out there and ride the sort of startup wave and try their luck at building something, being innovators, that fearlessness you see today, which I think we all celebrate. I think so much of it can be mapped back to that one company. And I think the two Bansals, but they also had a phenomenal group around them. They're early believers.
Yeah.
We joined a little later. We were missionaries, but we were late missionaries. They already had a very strong core. I tell people at PhonePe this often. I have a tremendous amount of pride in the talent and our bench strength. But there was a point at Flip where the caliber of the bench strength was actually scary good. Right? I mean, every IIT graduate and every IIM graduate was working there, and every lateral, like, peak of their career sort of smart person that I know of. And I think the country, forget markets and IPOs and all this stuff. The country owes companies like that just as much as we do in this generation, just as much as you do for the Tatas for creating haloed institutions. Definitely the OGs in this space. I mean, there's no doubt in my mind.
I think it's the startup university.
Still
equal number of good decisions and bad decisions.
Yeah.
But the fact is that looking back, vision is always 2020. And I think we have that advantage building PhonePe after having seen the Flipkart journey, because there's so many learnings, right? There's so many learnings in terms of, you're talking about incentivization, cashback, use of data, building for scale. I think a lot of us who have graduated from that startup university called Flipkart enjoy having that 2020 vision when it comes to actually building a
You learn
startup.
from our mistakes there. But the boldness to go after $1 billion, I mean, I'm sure you've met both Sachin and me.
Yes.
25-year-old Sachin had that. I mean, the way he used to talk about creating a $20 billion and $100 billion company back then, I'm like, he's either crazy or he's brilliant. Probably some combination. I mean, the first reaction when you meet somebody like that, right?
Yeah.
And you're seeing that now. There's some entrepreneurs today.
Yes.
They're just so wildly ambitious. It's awesome. So I think...
Recently moved to Bangalore.
That's one of many, actually. I think that's the... But like the one that moved to Bangalore, I think the world's their oyster, and I think we're all better off.
And all power to them.
Yeah. But and here's what I want, because this is essentially not just a show about entrepreneurship, it's also a show about paying it forward. So what I want to understand from the two of you, of all the lessons that you've learned over the years, over the course of building your previous startups and now building out PhonePe to becoming a multi-generational institution, what are the top three things, yes, fingers crossed, what are the top three things that you would tell a young entrepreneur today, which you believe are the non-negotiables? You draw the sort of red line there.
First-time entrepreneur?
Yeah. First-time entrepreneur, and then someone who's sort of mid, 5, 6 years on and then going for scale.
I think the first-timers, definitely, I think integrity/ethics above anything else. I think the second is, if you're a first-time entrepreneur or you're below 30, you gotta swing for the fences, because if you don't do it then, you're not going to do it with baggage later. Or you'll do it on the other side when you have no airline left, right? So swing for the fences, because I think India's time has come. This is not about whether there's a market you could get to. This is now a connected 800 million people market with all the infra and the capital available. So if you don't aspire for massive and global today, you're not even playing the game. You're playing the wrong game. So I would tell anyone between 25 to 26, 27, swing for the fences. You can, because you can do it multiple times over.
Yeah.
I didn't know that coming in. I started my first venture at 29, 30. 29, 30?
30, 31,
Yeah, I mean, middle class, go to school, go to grad school, work.
4G kid.
4G kid.
Were you a 4G brat, though?
I was a 4G brat.
He's still a brat.
Like, I mean, I'm still a brat.
He's still a brat.
But the idea of like quitting your job and working in a startup was such a pain when I worked in my first startup. That if I told my parents I want to actually like start up at 21, my dad would not know how to react, right? Whereas today, if my kid told me that I want to go and work more than a year or two, to apprentice, I think that's important, but said, I'm scared of starting up, I'm like, dude, I'm throwing you on the deep end of the ocean. Like, you got to try. And I'd say the third one is you really got to be clear about why you're in it. I think in India, making money is still a dirty word at some level, whereas when you're young, sometimes it's just change in lifestyle that you're seeking, and that's okay. But somewhere along the way, you get trapped in that rat race and actually your priorities change and everyone's still telling you to chase it. So you got to know at different stages of life.
How do you look at competition? Do you look at competition from the perspective of focusing on your competitors' strengths or your competitors' vulnerabilities?
Definitely not the vulnerabilities, because that's a perverse game, right? I think even on the strengths, I think we definitely look at whether they're innovating in interesting ways.
Who's innovating today, to your mind?
I think shamelessly, I think in our sector over the last 10, 15 years, the most innovative by far and away has been Paytm. And we talk about this. I think it's fair to say that.
Yeah.
They brought the wallet to market. They got the QR to market. They got the soundbox to market. They've done a lot of things. I think that's perfectly all right. Like, I should be able to say that my competitor is actually very innovative, right? I think Cred got gloss to design. It's glossy. It looks like really polished. I think each of our competitors, there's certain things that they do better. BillDesk is the OG in payments for 20, 25 years. They've gone in the hardest work in the entire sector. They've gone and taken state utilities and digitized them, right? So huge respect, because we all benefit. There's no BBPS if there's no BillDesk. Simple. So I think you have to first respect what their strengths are. You have to acknowledge the innovations, and you should shamelessly say that I'll create a variant of it if I think I can do better, or even just try and actually sort of create more of the same if there's a market out there for two brands.
What is it that we will not see on PhonePe? You've given us a glimpse of what we could possibly in the future see on PhonePe. What would we not see on PhonePe?
Well, it's never say never, but I can give you an example of what you haven't seen so far on PhonePe, just to give you a reflection of how we look at things. Cryptocurrency, right? There have been many times at which whether we create our own crypto, whether we distribute cryptocurrencies has come up. One of the things that the reason we've stayed away, apart from the fact that RBI has been very clear about their position on crypto outside.
Unequivocally, they hate it.
But there's a legal representation of crypto that still allows it to operate and exist and trade.
And be taxed.
And be taxed, right? We believe that the way crypto has been positioned and interpreted by a large set of the population as being an investment vehicle, many times marketed as safe enough to actually put in and grow your money, putting something like that out on PhonePe at the scale that we've operated at would be just socially wrong, right? And that's why we've never actually taken a view that we would never put crypto out on PhonePe.
What is the global ambition? Because I know it's made in India by Indians for India largely. It's an India first ethos, but do you have global ambitions?
Absolutely. So today, Indians traveling to those UPI peer countries or partner countries can spend, if they're traveling there. We will definitely, for the core payments business, we will definitely venture out and start building operations in other markets. I think we publicly already announced we are entering the UAE. We are going to be entering Singapore.
The IPO side of the brain is working overtime.
Birdies trapped in my hair. I don't have hair left, right? So it's like, so we are applying to enter the Middle East. We are applying to enter Singapore. For right now, that's all I know I can share. But we absolutely do believe that certain products that we've developed will find appeal in consumer markets or even merchant markets in other geographies as well. Yeah, it's India's time to build for the world.
So how soon can we expect PhonePe to build from India for the world?
Ask the CTO.
Now he's pointing a finger at you.
When it comes to timelines, he points at me. But I think we just applied for the license. We'll have to actually wait for the license approval. And as and when that comes in, we'll be able to actually offer a timeline on when we go international. Yeah.
Okay. So it's been a pleasure speaking to the two of you, and we wish you the very best of luck with all of PhonePe's plans, and of course your journey to Dalal Street as and when it does take shape and when it happens. But are you going to give us a broad timeline before we let you go?
I'm getting better. I'm learning. No.
Well, but thanks very much, Amir, and thanks very much, Rahul. We wish you both the very best of luck, and thanks for having us here at PhonePe.
Thanks, Shireen. Thank you so much.
Well, with that, it is time for us to wrap up this edition of the Young Turks podcast here from the PhonePe headquarters in Bengaluru. From all of us here on the team, for now, goodbye. Thanks for watching. Stay tuned to CNBC TV18. There's a lot more coming up. Hello and welcome to Startup Street. I'm Shruti Mishra and with me are Arundhati Ramanan and Ritu Singh. These are the top headlines from the startup space. Kirana Pro, a fully ONDC integrated AI-powered quick commerce platform, has acquired Lyco, a startup specializing in augmented reality powered virtual try-on technology. With this strategic move, Kirana Pro is bringing Lyco's immersive trial room experience directly into Black, a fashion-forward commerce platform built for Gen Z and tech-savvy shoppers.
Oyo is gearing up for a pivotal investor engagement with SoftBank, its largest shareholder, as the company explores its long-anticipated public listing. Sources tell CNBC-TV18 that Oyo has roped in a consortium of 5 investment banks to present IPO plans to SoftBank executives in London this June.
Ola Electric's net loss widened to 870 crore rupees during the March quarter compared to a net loss of 416 crore rupees during the same quarter last year. Revenue also declined by 62% from last year. However, for the June quarter, Ola Electric is expecting its adjusted revenue to grow between 23% to 31% from the previous quarter last year.
IVCA has called on legacy venture capital funds to promptly act on the SEBI's migration framework before July 19, 2025. The framework, introduced on August 19, 2024, offers a one-time window for venture capital funds operating under the now repealed SEBI regulations 1996 to transition into the more current AIF regime under a newly created subcategory known as migrated venture capital funds.
Top Flipkart executive Ankit Jain has joined Instamart as Senior Vice President. He will lead the quick commerce platform's end-to-end operations, including supply chain management, dark store operations, the delivery experience, as well as network expansion. Jain will take over from COO Sairam Krishnamurthy, who joined Instamart last August. Well, those were the headlines we've been tracking for you this evening on What's Brewing Today. Quick service platform for on-demand home services, Snaptit, has raised $19 million in its Series B round, led by Lightspeed, with continued backing from Elevation Capital and Nexus Venture Partners. Now, this comes just 4 months after its $5.5 million Series A round, and the company now plans to expand to over 200 micro markets across metro cities in India in the next 9 months. Joining me now to talk about the road ahead is Ayush Agarwal, founder and CEO of Snaptit. Ayush, welcome to Startup Street. What gap in the market is Snaptit solving? If you could take us through your offerings. You know, you've built a full stack model from training and sourcing to managing talent in-house, and that's quite operationally intensive, Ayush. So why not opt for a lighter platform-only approach like others in the gig economy?
Thank you. Thanks for having me, Shruti. I think the first question that you asked is what is the problem that we're solving? Well, what we realized is that in today's world of convenience, you can very easily get a cab, or you can get food or groceries delivered in minutes at the tap of a button. But if you want any simple help at home, it's relatively very, very inconvenient. And that's a personal problem that I found multiple people were grappling with. And that's how we basically said that let's make it as simple to get home helps as simple as it is to probably book a cab or to order food. So I think we're basically India's first and the largest hyperlocal home services platform, and we're completely revolutionizing a space that has seen zero disruption over the last few decades. And the reason that we've gone full stack is because in the world, in the category of services, service quality is extremely important. Trust and safety is extremely important. And the only way to actually be able to ensure that we're able to provide quality service, a consistent service to our customers at scale, is by owning the entire supply chain. Hence basically the efforts on sourcing, training, and onboarding and full stack supply system.
Okay, so $19 million in Series B just 4 months after your Series A. What drove this rapid follow-up, and what made investors like Nexus and Elevation to double down so quickly? And also, Ayush, if you could take us through how you plan to allocate this fresh capital.
Yeah, so we launched early last year, and we spent 12 months working out of just one micro market and basically perfecting the business model. We raised Series A once we were confident of the business model working, and we basically cracked playbooks on both the demand and supply side. What we've seen over the last 5 months has been unprecedented growth. So we've grown 5x in the last 4 months, and we've basically proven out the same business model across multiple micro markets. We launched Bangalore, we launched multiple clusters in Bombay as well, and we've seen really encouraging response. For example, it took us 150 days to get to 100 orders a day in Hawaii, which is our first micro market. but it took us just 8 days to get to the same milestone in Thane, which basically talks about the fact that we know that we're executing well, and we basically need to double down on this momentum, and hence we've basically gone out and raised more capital to fuel this expansion.
Okay. You know, Snaptit promises trained experts at your door within 10 minutes. How does the logistics of that actually work? And you have introduced a time-based pricing model. How has that shifted consumer behavior or expectations?
Yeah, so I think it's the entire supply chain management is about designing very efficient networks, which are based around dense neighborhood clusters. And then it's all about just very accurate demand prediction so that you can actually place supply very close to demand. It's more of a network design and a demand prediction exercise as opposed to a logistical issue. And I think the quick commerce infrastructure that's come up has obviously helped us in designing this very efficiently.
Sure. Ayush, you know, you're aiming to launch in 200 plus micro markets across top metros in India in just 9 months. First, tell us what makes you bullish on this aggressive scale up. And then if you could also talk to us about how do you view competition from legacy players or local networks? Is Snapit's vision to be the Swiggy for services? If you could tell us what's your moat in such a high frequency, high trust category?
So I think the reason why we're very bullish on scaling this extremely rapidly, as I said, is because we've spent a lot of time just going very deep into the micro market that we launched in. We spent 12 months just operating out of one micro market, understanding the customer, understanding our experts, as we call them, and understanding what's really working, and also building a path to profitability. And then over the last 4 months, we've actually managed to replicate the same business model across multiple other clusters as well. That's the proof of execution is basically what is driving our momentum and our commitment into this category to say that what we've done in 10 micro markets can be leveraged across 200 more.
Sure. One final question, and if you could quickly answer that, you know, you've said Snaptit is as much about speed for customers as it is about dignity for your workforce. If you could elaborate on the social architecture you're building, and as you scale across cities, how do you ensure consistency and quality across such a fragmented sector?
So I think the way we look at it is we don't call them maids. We don't treat them as gig workers. This is a very different supply chain for us. We inherently internally address them as experts, ensure that they're dressed properly, focus a lot on training and sourcing. So I think just having a very different approach, which is not purely transactional across the value chain, is what drives this entire feeling. Because for the longest time, this entire cohort has been marginalized and operated in a very offline industry. So I think that's the way we're looking at it. And I think, I think the fact that we will be able to maintain the quality and consistency across is because we've spent a lot of time in building really cutting edge tech powered by artificial intelligence that can actually ensure that the same models can be leveraged across multiple micro markets.
All right. On that note, I'll have to wrap up our conversation. But Ayush, many thanks for your time. Appreciate you joining us on Startup
Thank
Street.
You so much, Shruti.
Moving on, manual finance ops might soon be a thing of the past thanks to a new AI-native platform that's automating everything from invoices to audits. Meet Hyperbots, a US-headquartered startup with roots in India that's raised $6.5 million to shake up mid-market finance teams. Now, the Series A round was co-led by Arkam and Athira Ventures, built by former insiders who've seen the pain points firsthand. The company is now rolling out AI co-pilots trained exclusively on finance data. Joining me now to discuss this further is Niyati Chaya, the co-founder of Hyperbots. Niyati, thank you so much for taking time out and being here with us on Startup Street. You know, before we get into the nitty-gritties of the fundraise, right, if you could sort of take us through the problem that you're trying to solve at Hyperbots, what's on offer, and what's the impact that you're trying to create here?
Sure. So Hyperbots is about 2 years old, and our goal is to automate end-to-end finance processes. There's a lot of manual work, a lot of analytical work, and we believe that AI and, in fact, the finance and accounting platform that we have built can extremely automate several of these processes end-to-end, and which is actually a gap in the market. So imagine, say, 80% of invoices going through touchless, or orders getting processed with no one touching it at all, maybe 80 to 85 of those out of 100. So the goal is to free up everyone in the CFO's office of the mundane repetitive tasks that they do, and replace that with the finance-specific agentic AI that we have built.
Right, and how does this agentic AI platform differ from traditional finance automation tools?
Just sheer focus on extreme high accuracy achieved by intelligence, which is modern age, trained only on finance data and focused only on finance data. So extreme high accuracy, achieving end-to-end business automation, and not being generic about it. So that's our USP.
So extremely focused is being the keyword there. But you've raised the $6.5 million for go-to-market efforts in the US to build new AI co-pilots for finance teams. And also that includes the launch of HyperLM, right? If you could sort of elaborate on your plans and how you plan to use these funds?
Sure. So the first 2 years or year and a half is where we focused on building the product. We worked with several CFOs in identifying, in fact, their problems, nailing down the PMF. The next stage now is about selling that, right? So our focus is to grow in the US markets. In fact, we're starting with the North America market and we'll then expand into other markets, expand the product itself. So right now we cater to procure to pay, which is an end-to-end process with the highest amount of manual work. We are building order to cash and expense processing, which are equivalently tedious from the finance perspective. And something that excites us the most is we are bringing in HyperLM, which is industry's first finance vertical specific LLM. Imagine a ChatGPT just for the finance folks and the CFOs. That's what we are building.
Right. And, can you tell us the kind of traction that you're seeing in terms of customer adoption, average deal sizes or growth metrics? Any plans to expand in the Indian market?
Absolutely. So let me give you a sense of a little bit in terms of numbers. The TAM for us is around 1 lakh companies. Penetration today, even within a small geo, is less than 5%. So the idea is to start bringing in that automation over there. Like I mentioned earlier, our way of selling is build the product first and then establish the PMF, which we have already achieved, and now start growing in terms of the revenue. Over the next year, we'll hit around 4 million in revenue. And definitely, we are looking at India market as the next step. In fact, we are already talking to several GCCs as being our partners, who both sell for customers in India and customers outside. Obviously, you have the banking sector, which can leverage Hyperbots for the several tasks that are happening over here.
And, speaking about automating all these tasks that, agentic AI can do, how do you, sort of foresee how agentic AI will transform the workplace? What does the future of work look like with agentic AI?
Yeah, that's very interesting. Let me share a vision from the CFO's office perspective. Imagine the CFO, instead of looking at the Excel or the accounts payable clerk, instead of doing anything manually, just logs into a dashboard and maybe asks questions or has ready reports available to them to work with. So essentially one-stop shop place for them to do everything to do with finance. And this comes with a lot of customization. So what I mean by that is Hyperbots is where you can bring your own ERP, bring your own data, and we build on top of that. So it's not that you are asking enterprises to move completely away from what they are doing today. It's just that you are aiding them through the agentic AI piece to do it quickly and not focus on the strategy rather than focus on kind of doing daily stuff.
All right, Niyati, thank you so much for taking time out and being here with us on Startup Street, and we wish you all the best going forward.
Thank you.
Well, on that note, it's time for us to head into a short break. But coming up next, EV maker Ola Motors raised 638 crore rupees in its Series D round. We put the founder on the hot seat to talk about the company's synergy with Hero MotoCorp, product roadmap, and what's next. Stay tuned.
Well, EV manufacturer Ola Motors has announced a successful closure of its Series D funding round, raising a total of 638 crore rupees. This fund infusion was led by Hero MotoCorp, along with participation from existing investor British International Investment. Now, that takes the company's total funds raised to date to about 1420 crore rupees, and the company says this latest infusion is going to be instrumental in expanding its sales and service network while advancing new product development to accelerate India's commercial EV adoption. On that note, let me bring in Saurav Kumar, who's the founder and CEO of Ola Motors, to understand how this capital is going to boost the company's growth and more. Saurav, thanks very much for your time here on CNBC-TV18. You've raised more than 1,400 crores, and now with this latest one, what specific expansion plans do you have, over the next 12 to 18 months, geographically, operationally, and in terms of production capacity with the money?
So first of all, thank you, Ritu, for having me on the show. Definitely having HMC and BI, they being the marquee investor, is a very strong confidence in what Euler is doing. This particular 638 crore that we are raising, this will primarily will be used in the retail expansion. We are already present in like roughly 40 cities. We would want to go to 100 cities by end of the year. In our revenue, we would want to at least grow by 2x or 100% from the last financial year to this year. And in terms of like, if you look at Euler, we are focused on the electric light commercial vehicle segment. So we'll continue our focus in the three-wheeler and the four-wheeler cargo segments.
This Hero MotoCorp is, of course, joined as a strategic investor, but beyond capital, what sort of synergies or collaborations are planned between Euler and Hero, whether that is technology, supply chain, or even distribution?
So, Hero MotoCorp is a leader in two-wheeler industry. They have been looking at the electric vehicle ecosystem over the last couple of years. They have made their own forays. They have made investment in other startups. I think this is an investor that has backed, entrepreneurs like me, and also have looked into the future mobility trend themselves and have made their own investment. So I think it would be wonderful to work with them. I believe that other than capital, we would be able to expand our synergy in terms of distribution or supply chain, and even look at some of the ecosystem opportunities.
What is the roadmap from here? How does this funding support your future R&D, and what's lined up in terms of products for you?
So we are looking to electrify the three-wheeler, four-wheeler product ecosystem in the country. We believe that in the next coming year, majority of this percentage of commercial vehicle will shift to EV, and Euler would be one of the top 3 players in these markets.
How do you plan to defend and grow your market share amid rising competition, both from startups and also from the traditional OEMs?
Three-wheeler cargo, when we entered in October of 2021, we had around like 4% market share, and majorly around Delhi market. Today, we have roughly 11 to 12% market share in the three-wheeler electric cargo. And in the next couple of, I would say, quarters and year, we would be expanding to almost like 300 to 400 touch points across the country. So that will have push our volume. So that will help us go from what we are today, let's just say a top 3, and at least make sure that when large percentage of the market shifts to EV, we continue being the top 3 player and take around 20% market share in some of these category. And something similar, if I'm looking now at as we have expanded to four-wheeler, which we announced the Storm EV last year, from January, when we have started shipping, we have seen the similar trajectory where in the cities that Euler sells, we typically take 20 to 13% market share.
Let me ask you then how close you are to profitability then with all these financial metrics that you're sharing. And also, after this flurry of fundraising you've had, is a potential IPO on the cards as well?
Okay, so in terms of profitability, I think next 3 to 4 years is where we are looking to make sure that we go from the material positive as a company to EBITDA neutral as a company. That's that's one of our single, I would say, fundamental line that we are pushing, is that instead of growth at all costs, to how do you make sure that you're sustainably growing the company. IPO is definitely, like, I think every founder, when you are building a company, being public and winning the trust of retail market is like one of the important milestone is definitely there. I think over the next couple of years, as we show our growth and also path to profitability, I think that will be something definitely within an Euler board that will be a topic that we'll chat about.
All right, Saurabh, we'll leave it at that. Thanks very much for joining us here on CNBC-TV18. It was a pleasure speaking with you.
And moving on, at the Select USA Investment Summit in Maryland, my colleague Aishwarya Anand caught up with Adam Phillips, the managing director at Athletes Innovate, with over 70 global investments. Adam shared why India is firmly on his radar, calling it a must for any serious investor. He spoke about the power of sports-led ventures, especially from India, expanding into the US. Take a look.
I want to understand from your portfolio, have you looked at investing into any Indian startup or is that conversation on the radar?
Yes, well, first of all, yes, absolutely. Have invested in 2, I think, Indian startups.
Okay.
Out of 72 investments, basically, I've made in the last couple of years, 2 of them have been in India. Probably about 25% of my whole portfolio is international for sure. I think if you're not investing in India, it's a problem because it's one of the fastest rising young populations in the world. So absolutely.
Another thing I wanted to understand with you is that you're also working very closely with athletes who are transitioning into entrepreneurship,
yes,
right?
Absolutely.
Now with sports tech and with the rise of sports tech that we are seeing, especially in the Indian market, I want to understand that how do you see founders from there tapping into the US market? What's the potential here, especially to get strategic capital?
I invest wherever sports makes a difference. So like the Indian market, especially when it comes to cricket, of course, kind of that's number one. So sports is so sticky in a way that's so great for so many different kinds of investments. So it doesn't have to just be tech. It can be CPG. It can be restaurants. It can be, it can be anything. Because the fandom from sports really sticks to those products and sticks to those businesses in a great way when it comes to investing.
Given your background in both law and innovation at US Dot, what regulatory frameworks are we talking about, especially in terms of foreign startups who are coming to set up their base there, based here in the US, and especially we've seen a lot of Indian startups, they've set up their domicile here because fundraising in US is comparatively much easier than it is in India. So considering all of that, what is your take on that?
It's a great question. So I think when companies come into the United States, investors can be a little bit hesitant if they don't think that that company's coming in to plant here. This is my advice to any company who's trying to go to any other country, including the United States. If they know you're building a legitimate piece of your business here that's big and investable, like there's no question they'll invest if there's traction. Like the traction overseas then really, really helps.
The funding winter is thawing a little bit. But the momentum is still not as it used to be.
Yeah.
So tell me, where do you see the end of 2025? What pace do you see it picking up? And also, like if I have to, you told me you've made 2 investments in India.
Yeah.
By the end of this year, what does your investment portfolio look like and how many more Indian startups are you evaluating at that time? And which sectors would they be from?
That's a great question. So I'm not currently vetting any. I should be vetting more. I want more. And my 2 investments were in logistics sector over in India. And I think that is a massive sector over there, massive potential for that sector. Because there's, just in terms of the people movement, the ability of commerce to kind of work together, like India is one of the most fervent countries in the whole world for that. Like we need to be, people are going to consolidate that market in ways that are going to be really, really successful, I think. So, so what does it look like in terms of overall venture capital? I think that's a tough question right now. I don't, honestly, 2 things I think are happening. Money is consolidating. I think, bigger funds are getting more money. So that usually means companies have a harder time getting access to that money because they don't have those connections to those bigger funds. So I think it is consolidating. And I think there's enough unrest in the world that people are a little scared right now to sort of spend their money, right? So people are worried that, the U.S. economy looks like it's sliding a little, and so people aren't cutting checks as fast. So I don't see 2025 thawing very much, if I'm honest. I think it will continue a pace. I don't think it's going to 0. I think it'll continue as it is, but slowing down a little bit into 2025. The hope is that we sort of flush all the uncertainty out of the system in 2025, and in 2026 and 7, it speeds back up.
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
The Gates Foundation, one of the largest charitable foundations in the world, is marking its 25th anniversary. Now, the Silver Jubilee comes with a big commitment. Bill Gates is pledging to give away, in his words, virtually all of his wealth over the next 20 years, which means the foundation plans to spend $200 billion over the next 2 decades. Now, this accelerated timeline has meant a change to the foundation's charter, which had stated that the organization would sunset 20 years after the death of Bill Gates. The last big change to the foundation had come in 2021, when Bill and Melinda Gates announced their divorce. Melinda Gates resigned as co-chair in 2024, which left Bill Gates as the sole chairman of the Gates Foundation. Now, from combating infectious diseases to agriculture research and reproductive health, the Gates Foundation has been at the forefront of solving some of the biggest issues in the world today. And joining me now to discuss the foundation's future and his pledge to give away virtually all of his wealth is the man himself, Bill Gates. Bill, many thanks for joining us on CNBC-TV18. And let me start by congratulating you on 25 years at the Gates Foundation. But Bill, why this decision to set yourself a new deadline of 20 years to give away virtually all of your wealth? What has prompted this decision? Why this change from the original position?
Well, looking back on these 25 years, it's amazing what we've been able to accomplish. You know, together with partners, the one statistic of cutting the number of children who die every year in half has been phenomenal to be part of that. And so as I was thinking about that, I decided that we should essentially double down and spend all the rest of the money I'm lucky enough to have through the foundation on these causes over the next 20 years. And that'll allow us to be very aggressive, make some fantastic progress, and, we'll have real clarity. A lot of resources for 20 years, and then others can step in with whatever we haven't been able to finish off.
If I may, Bill, is this decision to accelerate or speed up the giving that you're doing linked to the overall environment that we're currently seeing, where there is a retreat from multilateral institutions, from multilateral arrangements, from development aid? How much of this acceleration perhaps is also linked to the change in the environment as we see it today?
No, this decision was made before all of these reductions were clear to us. I would say in the short run, it means the work we do is going to be challenged. Although I expect every year we'll have progress in India and some of the countries we work in. In Africa right now, these cuts to the aid budgets, the debt situation, some of the instability means the next 4 or 5 years will be difficult. But over the time period that all my money will be given, I still expect to see pretty incredible progress. So in the short run, I am very disappointed that aid generosity is down. But with the innovations in the pipeline, with, I think, going to people and saying that those aid budgets should come back to some degree, I'm, super excited about what we can achieve in these next 20 years.
Bill, you talked about doubling down on the significant resources that you've already committed. $100 billion was the previous amount that you did over the last 25 years in spending. You're doubling down on that, $200 billion between now and 2045. So help me understand, these are big numbers. Prioritize for me how you intend to use this money and what are you hoping to achieve in terms of impact?
Well, the first 25 years, we got childhood deaths down from 10 million to under 5 million a year. And we also took the 2 other diseases, HIV and tuberculosis, and the deaths were cut substantially for both of those. We also came up with ways to save mothers who are giving birth. And so we're really putting most of the resources into the global health work. We hope to be able to cut the number of children who die more than in half. Again, and also to make dramatic reductions in all infectious disease. We need to finish our polio eradication. Still a lot of hard work left there. And we also think some other eradications, guinea worm, malaria, a number of diseases could be taken all the way to zero. And so by having, for the next 20 years, over 200 billion in resources, double what we spent in the first 25 years, we'll be able to partner with scientists, and we have a great partnership with the Indian government to help them achieve their ambitious health goals. And this field, the field of global health, will be able to perform miracles, and our resources will be a meaningful part of that.
Bill, you spoke about the ability to deliver miracles. What have been some of the hardest fought battles over the last 25 years? You talked about some of the important outcomes, especially on the global health front, that you've been able to achieve. What's been the hardest part of making those a reality? Resource is one thing. Execution is another thing altogether. What's been the tough part on the execution front?
Yeah, so for the foundation, we both work on the R&D side, so like creating new vaccines. And so, with Serum, a great Indian partner, a meningitis vaccine was one of the first new ones the foundation did. Later, a rotavirus vaccine that was very low cost, a pneumococcus vaccine. Then with other partners like Bharat, a rotavirus vaccine that also brought prices down. So it's the vaccine work, both in the R&D and the delivery, is probably at the top of the list of the impact that we've had. Vaccines, you need to keep them refrigerated. You need to make them cheaper. You need to convince mothers to bring their children in. So, there are plenty of challenges just in that one area.
Bill, you talk about India. Now, you've been spending a fair amount of your time here in India. And of course, the foundation has been working in India for a good part of the last 25 years. Let me ask you about what excites you about what's happening in India today. How important is India going to be for the Gates Foundation over the next 20 years?
Well, certainly India's a very, very important place for us. It's our biggest overseas office, and it plays two big roles. One is that the Indian government has very aggressive goals for improving health, and so we get to partner and try out the latest advances in medicine, and that we've seen great results from that. But the actual creation, the R&D of the new tools, whether it's diagnostics, vaccines, drugs, new seeds to help farmers, or ways of taking AI and helping with health and agriculture as well as education. India is going to be a place where there's so many smart people, so much desire to see these improvements that will pioneer a lot of things first in India, and the brilliant work there will then benefit the entire world. Paradigmatic of that is the work in digital finance, where Aadhaar and the ability to pay digitally, India really did an amazing job on that, and now we work with the Indian government to make that available to all countries.
But Bill, you've been spending more and more time here in India and doing lots of fun, interesting things, not just linked to the foundation, but even outside of the work that the foundation is doing. What about being in India, about making the connections here in India, the people that you're spending your time with inspire you today? I mean, is this a new romance with India that started over the last few years?
No, I've always been fascinated by India. And of course, Microsoft has had a fantastic relationship in terms of the huge development offices that we have in India, as well as amazing people like Satya Nadella that have come and made huge contributions to the company. And so as I moved from Microsoft to the foundation, I took that understanding of the great talent that's there with me And so, I get to India on a regular basis and get to meet with the partners there. The majority of the world's vaccines by volume are made in India. We've had, so many important partnerships with that, and that's really growing. The quality of research in India, its desire to go even beyond vaccines with the tools that are provided, it's very timely. And, part of that is Prime Minister Modi's been very generous at sharing with me his goals, and so we can talk about how the foundation helps with that.
Bill, you've referenced vaccines, and I want to ask you this in the context of the last conversation you and I had, which was in September in New York last year. Now, there you had talked about being a salesman for Gavi, the Global Vaccine Alliance, in its quest to raise funds. You've been central to Gavi's ambition and aspiration of providing affordable vaccines to the world. At this juncture, with the very real possibility of funding drying up, specifically from the US, how concerned would you be about Gavi's future?
Well, I'm very, very concerned. It would be tragic if Gavi weren't able to raise as much or more money for this next 5 years as it's had for the last 5 years. And yet, it's pretty clear that we're going to see a reduction. I continue to talk to all the governments about the impact. There's nothing more amazing than making sure all the children of the world have these miraculous vaccines. So we'll see what we're able to raise, but it's looking tough. I'd say the next 5 years, the whole aid picture, whether it's Gavi or Global Fund, are going to mean that we might go backwards a little bit before we resume the progress we've seen since the turn of the century. And that's just a mistake, and I'll be speaking out very loudly, try to get the U.S. back in, try to get others to maintain or even increase, in some cases, their giving.
But do you feel confident or optimistic about that? You said you're going to try and draw people back to the table. But at this point, with the global retreat that we are seeing, especially from development goals, Bill, how much of a slide back do you believe we should be prepared for? Are we set for?
Well, we have two forces. One is the power of innovation, that is new tools, whether that's new drugs, new vaccines. We have AI to even help with the delivery, to talk to patients and give them advice about care seeking, things like the ultrasound that'll help figure out about the whether a pregnancy needs special care. So the innovation side is, if anything, going faster than ever. The generosity on resources for the delivery side, the next 5 years are going to be tough. And that might mean some of our statistics that have been improving, we might have a period where they'll get somewhat worse, particularly in Africa. And that's tragic. That should